Hello everyone, good afternoon, good morning, good morning and good evening to all of you. आज है 9th of April 2025. वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। क्रूड ऑयल को देखोगे, यूएस में कल जब मार्केट क्लोज होने वाला था सपोर्ट के अराउंड था, बट उसके बाद टैरिफ की न्यूज आ गई। वाइट हाउस की ओर से अनाउंसमेंट किया गया कि चाइना पे एडिशनल 50% टैरिफ लगाने वाले हैं। मार्केट उस वजह से और गिर गया क्रूड ऑयल। नेचुरल गैस देखोगे कल सपोर्ट एरिया पे था, वहीं पर अभी भी है। थोड़ा वेट करते हैं फ्रेश ट्रेड के लिए। एक कल सेलिंग का ट्रेड अब काफ़ी अच्छा चला था। कोई नया ट्रेड बनता है तो वी विल सी। अभी और कोई ट्रेड नहीं है इसमें। नीड टू वेट वेट करना पड़ेगा। क्रूड ऑयल में भी वो जो गैप डाउन हुआ है उसके बाद से लेवल थोड़े चेंज हो गए। इतने नीचे अब दिख भी नहीं रहा है प्राइस। जहाँ पर प्राइस अभी ये चल रहा है, यहाँ पर एटलीस्ट 15 मिनट का चार्ट देख नहीं सकते, बिकॉज उतने पीछे प्राइस एक्शन ही नहीं है। कुछ नया लेवल बन जाए तभी कुछ कर पाएंगे, अदरवाइज वेट करना पड़ेगा इसमें, या फिर थोड़ा और टाइम फ्रेम छोटा कर जाना पड़ेगा। 9 PM मुंबई सेशन, लंदन सेशन ओपन हो चुका है। देखते हैं, वॉल्यूम थोड़ा आना चाहिए अब। बाकी न्यूयॉर्क सेशन और यूएस मार्केट की ओपनिंग है। एंड शाम को एफओएमसी मिनट्स भी रिलीज होंगे, तो वो इम्पोर्टेंट रहेगा क्या सोच रहे हैं रेट कट के बारे में। बाकी इंडिया में रेट कट कर चुकी है आरबीआई मॉर्निंग पे। एंड जीडीपी का जो फोरकास्ट है वो भी उन्होंने रिलीज़ किया है कि उनका एक्सपेक्टेशन कितना है फोरकास्ट के लिए, इस फाइनेंशियल ईयर 2026 के लिए। तो एज़ पर द आरबीआई सबसे पहले तो उन्होंने 25 बेसिस पॉइंट का रेपो रेट कम किया है। तो जो पहले 6.25 था, अब 6% हो चुका है। तो एक तरह से आप कह सकते हो, अगर आपकी ईएमआई चल रही है या फिर लोन है तो लोन की ईएमआई डाउन हो जाएगी। अगर नया लोन लेना चाहोगे तो उसमें कम इंटरेस्ट देना पड़ेगा ओवरऑल। बाकी जीडीपी का जो प्रोजेक्शन है 2026 के लिए 6.5% है। देखते हैं एग्जैक्टली कितनी आती है। एंड सबसे इंपॉर्टेंट हमारे लिए जो रहता है विच इज़ इन्फ्लेशन इंडिया का। यूएस का इन्फ्लेशन का डेटा कल आएगा। तो इंडिया का जो इन्फ्लेशन का डेटा का जो टारगेट उन्होंने रखा हुआ है 2026 फाइनेंशियल ईयर के लिए, वो 4% रखा हुआ है। तो लेट्स सी ओवरऑल कितना रहता है 2026 में। 4% ही रहता है, नहीं रहता है। फाइनेंशियल ईयर 2026 की मैं बात कर रहा हूँ, ना कि 2026 मतलब अप्रैल 2025 से मार्च 2026 तक। तो ओवरऑल साल का रहेगा वो 4% रहेगा। बाकी बैंक्स पर इसका इम्पैक्ट जरूर पड़ेगा। बाकी देखते हैं अभी कुछ और नया ट्रेड बनता है। बाकी बैंक निफ्टी को देखोगे मॉर्निंग पे, बैंक निफ्टी भी ओपन हुआ था, फ्लैट ही ओपन हुआ था। कोई बहुत बड़ा गैप अप गैप डाउन नहीं था। थोड़ा बहुत गैप डाउन था फ्यूचर, बट फ्लैट ही मानेंगे, इतना बड़ा गैप डाउन भी नहीं था। थोड़ा बहुत वहाँ पर रुका स्टार्टिंग के 1 घंटे के आसपास, फिर सेलिंग आई। एंड देन अभी थोड़ी रिकवरी चल रही है। अगर प्लान करना चाह रहे हो बैंक निफ्टी में, लेट्स सी कुछ और नया ट्रेड बनता है, बिकॉज सेलिंग का ट्रेड तो निकल गया उसमें ऑलरेडी। मॉर्निंग पर एक सेलिंग का ट्रेड अच्छा था। कोई फ्रेश ट्रेड बनेगा तो विल सी। बाकी देखो, नेचुरल गैस में एक चीज़ प्लान करेंगे। अगर प्राइस यहाँ कहीं क्लोजिंग दे दे 305 के ऊपर, अगर क्लोजिंग दे देता है ना 15 मिनट टाइम फ्रेम पे, तो एक बाइंग का प्लान करेंगे। अदरवाइज मत करना अभी बाइंग का प्लान। क्लोजिंग आने दो 305 के ऊपर। कोई क्वेश्चन है तो कमेंट बॉक्स में पूछ सकते हो। लेट्स सी कोई ट्रेड बनता है तो देखते हैं। लाइक करना मत भूलना गाइस, लाइक करते रहो सभी लोग। नहीं, इंडिया पे तो नहीं, चाइना पे इम्पैक्ट पड़ेगा उसका। 104% टैरिफ बहुत ज़्यादा हो जाता है। लाइक आप सिंपली ये मान के चलो, जो चीज़ पहले यूएस में 100 रुपीज़ की, 100 रुपीज़, $100 की एक तरह से मान लो यूएस में सेल होती थी, चाइना से जो माल आता था, जो भी प्रोडक्ट आते थे, तो 104% टैरिफ, मतलब वो सीधा सीधा 200 की हो गई ना एक तरह से, क्योंकि पहले से और भी टैरिफ लगे हुए हैं, सबको ऐड करके 104% बहुत ज़्यादा हो जाता है। मतलब एक तरह से मान लो, डबल टैरिफ कौन लेगा भाई भाई, डबल टैरिफ में कोई भी बाई नहीं करने वाला, तो फिर उस वजह से जो और भी सप्लायर होंगे वो सीधा सीधा लेना ही बंद कर देंगे चाइना से, या तो थर्ड कंट्री के थ्रू लेंगे या फिर कहीं और से लेंगे। दैट इज ओनली वे दे कैन डू इट। ठीक है, यूएस ऑयल 59.60 से बाय है, क्या करें यार, फॉरेक्स का चार्ट में देखता नहीं हूँ, एक बार देखना पड़ेगा अलग से। लेट मी चेक। ये कौन सा ब्रोकर का चार्ट आप से आपने ट्रेड किया है अजय कुमार जी? एफएक्स ओपन ब्रोकर या फिर टीवीसी ब्रोकर? बिकॉज क्रूड ऑयल फॉरेक्स के मेरे पास दो चार्ट हैं, या किसी और ब्रोकर का चार्ट यूज कर रहे हो बाई करने के लिए, सेल करने के लिए फॉरेक्स में? एक बार कंफर्म कर देना। गोल्ड, हाँ गोल्ड देख लेते हैं फॉरेक्स में। ओवरऑल तो बुलिश ही है। कुछ प्लान करना चाह रहे हो? वैसे कोई डेटा तो नहीं है अब, एक बार देख लेते हैं लेवल्स। कोई ट्रेड चल रहा है क्या रनिंग, अनमोल जादव जी? या फिर फ्रेश ट्रेड का प्लान कर रहे हो? अगर कोई ट्रेड चल रहा है तो बता देना पहले, ठीक है? अखिलेश सिंह जी, 5100 के पास रेजिस्टेंस है। 5100 के पास, अच्छा वो कल का सपोर्ट जो ब्रेक हुआ है उसका, और रिटेस्ट जोन कह रहे हो? रिटेस्ट जोन की बात कर रहे हो क्या? एक बार पहले मैं गोल्ड देख ले रहा हूँ। गोल्ड में मैं फॉरेक्स की बात कर रहा हूँ, फिलहाल करंट लेवल पर ही रेजिस्टेंस है। रेजिस्टेंस क्या, वो एक सपोर्ट था, ब्रेकडाउन हुआ है तो रीटेस्ट है। बाय द वे वो रीटेस्ट दो तीन बार कर चुका है, प्राइस ओवरऑल व्यू बुलिश है। थोड़ा बहुत इस रीटेस्ट पर रुक सकता है, रेजिस्टेंस एग्जैक्टली देख लेते हैं, बट इट इज़ अ रीटेस्ट जोन जो कि पहले दो बार कर चुका है। ठीक है, तो फॉरेक्स में 3055 से लेकर 3075 इज अ रीटेस्ट जोन। सपोर्ट था, ब्रेकडाउन किया, एक बार रीटेस्ट कर चुका है 7 अप्रैल को, सेकेंड टाइम आ रहा है। सेल करना चाह रहे हो कम क्वांटिटी में करना, ठीक है? रीटेस्ट अगर नहीं हुआ होता एक बार पहले तो फिर थोड़ा सा ज़्यादा स्ट्रॉन्ग कहते, बट अभी कर चुका है एक बार, तो सेकेंड टाइम रीटेस्ट करने आ रहा है। बाकी अगर मेजर रेजिस्टेंस देखोगे, वैसे अगर इस रीटेस्ट को मैं रिमूव कर दूं गोल्ड फॉरेक्स चार्ट में, तो ऊपर रेजिस्टेंस मेजर एक 3124 टू 3133 के बीच में ले सकते हो, दैट इज अ रेजिस्टेंस, एक्चुअल रेजिस्टेंस, वो रीटेस्ट नहीं है। बाकी करंट लेवल पे तो अब रीटेस्ट मान के चलना। ओवरऑल व्यू बुलिश, रीटेस्ट जोन, थोड़ा बहुत सेलिंग। में देखते हैं कुछ अगर ट्रेड बनता है, तो अभी कुछ है नहीं क्रूड में, थोड़ा प्राइस एक्शन बिल्डअप होने दो।
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be
We're
important.
going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
companies in Asia are betting on tech.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning. I say that advisedly. We have equity markets that are down pretty sharply. You are seeing US futures bouncing around all over the place. European equities, though, are kind of playing catch up to the downdraft we saw yesterday, so you've got to factor that in. So kind of that's there. And then you get the bumpiness in the futures, which you've got to kind of think about maybe for the rest of the session. Bond markets are all over the place as well. What comes next, I think, is the key question. We're beginning to get kind of an understanding of the fact that China wants to fight. How does Europe react? Playing it very cannily at the moment. We've got obviously an early set of tariffs that are coming through. That's just a marker, it feels like, in terms of where we go next. Ollie Crook joins us now from Brussels to give us a sense of the picture from there.
Yeah, Guy, I think it's just a moment here to mark the moment that we're experiencing. We're talking about the trade from the EU, that 20% tariff now in place. There's about 500 billion euros worth of goods that go from Europe to the United States. 20% on that is 100 billion worth of euros that somebody's got to pay for. It's going to be the producers on this side. It's going to be the consumer on that other side. And who is going to pay that is happening right now. That is being determined as we speak. And for the Europeans, they need to determine how to respond. What we are going to get a little bit later today is the list of retaliatory tariffs, Guy, not to the tariffs that were imposed today by the United States, but by those that were imposed a few weeks ago on steel and aluminum. That is going to be fairly limited. That's going to target only about $20 billion worth of goods. And this is all part of the EU strategy. They want to leave maximum runway open to have negotiations with the United States. What we will get, though, next week is when they start to build the architecture of what the actual full retaliation could look like. That is when we start to talk about targeting U.S. services, targeting U.S. tech companies, not just with taxes, but possibly also with regulations. And that is what we throw into next week.
Give us the likelihood of a deal here, Ollie.
That's not I'm not sure I can give you that. I asked all the trade ministers a couple of days ago, because they have plan A and plan B, what the likelihood of plan B retaliation is going to be. No one is really willing to give an answer on that. What we do know is that Giorgia Meloni will be heading to Washington, D.C. a little bit later next week. She will be talking to Donald Trump. She will be serving as a sort of emissary to try to get some concessions from the Trump administration. But if that meeting with Benjamin Netanyahu is anything to go by, that is going to be a very tough discussion. We should also mention that right now, as we speak, Pedro Sanchez is in Vietnam. He touches down in Beijing on Friday. There has been a lot of conversation coming from the Spanish side about potentially reevaluating the European relationship with China. China, for its part, trying to cast itself as a much more reliable partner. The ministers I have spoken to, they are not ready to sort of rethink the relationship with China just yet. But in an era where the sort of unthinkable comes to bear, it is a conversation that we're going to have to be paying close attention to.
Oliver Crook, thank you very much. That's the European side of things. Let's get back into the market action. A huge amount of volatility in U.S. futures. Valerie's back with us. What's driving this?
Look, I think what we saw, the positive reaction to those China headlines is the market is just really desperate for some good news. It's almost wanting to cling to the best news it can see, because those China headlines that crossed, there were some fair few negative ones, but we flipped into the positive on the one positive that they are, that the Chinese officials are resolving to, I don't know what's driving that, but I think the price action we also saw a few days ago just on some random posts on Twitter is just showing you how desperate the market is to want good news. It really wants good news, and I think if we do get any solid good news today, we could see quite a decent equity market rally.
In terms of what comes next, therefore, what are we watching for? The 10-year auction today. What are the catalysts that we're watching for today?
The 10-year auction is going to be a big one. I think there is a big question out there about balance sheet availability, given the blowout and swap spreads. The 10-year auction is going to be a good test for that, even the 30-year the day after. Yep. I would be watching swap spreads as well as a measure of just how able are market participants to access liquidity, because you need that dealer balance sheet in order to take that down and offer that.
Yes, I was just looking at the wording of that headline that says that sent the U.S. futures to your point about what algos do with it. It included the word dialogue. I don't know whether that is a word that AIs might associate with risk on in this strange world we now inhabit. Valerie Tytel, thank you very much for bringing us that on the volatility in these markets. U.S. futures are pretty flat right now. European stocks are anything but. We're down by 2.7% on the Stoxx 600. We'll come back with more on the markets shortly. This is Bloomberg.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
The countdown countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
In case you missed it, on The Pulse.
You know, it's not the headline-grabbing $15 billion bankruptcy. It's not Lehman Brothers. It's not that. But what is happening underneath the surface is just frantic activity. There's a moment in time when real estate gets really interesting.
Now or soon?
Now. It's here.
Don't miss The Pulse, live every weekday.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
This is the opening trade. We're at 30 minutes into today's session. Red across the screen. Some margins of green here and there. You really have to dig for it to see where there is some positivity. Briefly in defense, briefly in the futures picture, a market that is desperate to buy this morning. But broadly, you are seeing pain to the tune of 2 to 3% across the European benchmarks. We are still awaiting, of course, some news potentially when it comes to the pharmaceutical sector. And perhaps that's where a lot of the pain is concentrated this morning. Novo Nordisk is, I think, a great example of that, down about 5.5%. AstraZeneca right on its heels of about 6% there, Anna. So it's continuing to see quite a bit of pain.
Yeah, absolutely. Some of these European equity markets, I know, losing all of their year-to-date gains, which is quite a big deal when you consider how much we rose on the back of the defense spend, infrastructure spend impulse out of Germany. Let's return to the tariff news flow as President Trump pushes ahead with 104% tariffs on China. There are concerns over what industries could be hit next. I'm joined now by Brendan Murray, who leads our global trade coverage. Brendan, very good to have you with us on this very busy day. What's been the impact of these tariffs then? We're in, I don't know what round we are, well, multiple rounds, depending how far you go back.
This is round 3 or 4, depending how you're counting it. There were 2 rounds of 10, then the 34 reciprocal, and the 50 extra that President Trump laid out just a few days ago. So we're at 104%. That will trigger what a lot of people talk about is a decoupling. The Trump administration in the past has talked about strategic decoupling from China, the sort of slower pace, not at a big scale, but 104% tariffs will do a lot of damage to that trading relationship that's worth $500–600 billion. So we're waiting to see China's response. They haven't retaliated as of yet. In the past, they like to retaliate right before the U.S. financial markets open for maximum impact. So we've got some time yet before that happens, but China will respond. It's just a matter of how large and how cleverly they would.
So you're expecting more counter tariffs from China?
You would imagine that tariffs
or just
would
domestic
be,
support for their economy.
It could be a package of things like tariffs or export controls where they would really hit the U.S. hard. Would be in critical minerals and things like that. They could target American companies that are based in China. So there's a whole range of things that they could do. Chances are they'll pick a basket of things to strike back with.
So you kind of hinted at the pharmaceutical piece there. The markets are certainly pricing in. I'm curious, though, does that mean that are you seeing any evidence of people pausing shipments? Are people doing that yet?
Yeah, well, we've seen some evidence. So American importers have spent the past couple of months anticipating today. They have front-loaded a lot of orders. The ports have been running at capacity for 2 months now. The question now is, what do you do? Your warehouse is full. You're looking at tariffs that are sky high. A lot of people would say, just wait this out. This will blow over in a few months, and don't pay that extra tariff if you can afford to wait. The question is, are those tariffs coming down anytime soon? It doesn't sound like the U.S. and China are close to talking at this point. So we're looking at a scenario where inbound cargo into the U.S. basically freezes. The Port of Long Beach CEO talked to Bloomberg TV yesterday and said we could crash 20% in the second half, given the volumes that we've seen build up, and heading into the second half, if the U.S. economy is in or near recession, those could come crashing back down. He said 20% they could fall.
Wow.
And that's it. That would have happened. Some of that would have happened even if we hadn't seen the tariffs imposed then, because of all that pulling forward of the shipments.
Exactly.
Yeah.
Now, some of that trade will be rerouted, and it won't disappear. But there is definitely a sense that things could, in terms of demand for overseas goods, could come to a halt.
It's going to be interesting to watch the ISM and the PMI data, just to give us kind of clue as to what is maybe happening with some of that inventory story. Brendan, thank you very much indeed. Nice to see you, as ever. Brendan Murray, leading our trade coverage. Let's carry on the conversation about how this all impacts markets. BlackRock's Ursula Marchioni, who is the EMEA head of investments and portfolio solutions, joining us around the table. What's the conversation at BlackRock right now? What are you guys talking about?
Good morning. So paradoxically, we all focus on uncertainty and volatility, but there is one thing that is very clear at the moment, and it's the fact that many of our clients' portfolios haven't quite transitioned and embraced the fact that we've entered a new phase.
Yep.
If I look at March, exchange-traded product flows still very much risk-on, despite the fact that the S&P peaked on the 19th of Feb, so we had quite a bit of signals coming through. And so again, 150 billion coming in, 112 in equities, of that 53 in US. I think it's time now to move to the next stage. We held one of our client calls on Monday and surveyed 1,500 clients, European clients, around what are you doing? And 50% of them said, well, we're waiting for more news to come. I think the time to act is now. We need to address...
What is ACT looking like?
Absolutely.
What do you do?
What do you do? So couple of things. One big bucket around managing drawdowns. Anna, to your point, we're looking at having erased everything that we've done in European equities, which was a huge component for our clients given home biases. We need to handle that. And so ideas there for equity exposures, thinking about minimum volatility strategies, quality factor exposures. Yep. Another idea is to look at portfolio from a total return perspective. So high income strategies, focusing on basket of stocks that have good high dividends, potentially coupled with called overwriting.
Are those dividends safe? How much reliability do I have on those kinds of factors right now?
I agree that the earnings season kicking off on Friday, if that's where you're going, is going to be pivotal, because we still have good consensus estimates. US 7-8%, Europe is at 3%. But again, what I will be watching is the forward guidance in terms of how tariffs and everything that we are discussing is transmitting through. But definitely the drawdown space for me is a massive priority.
Do you think, Anna, we're going to get guidance?
Well, we live in hope. we need hope. So we need hope. I want to ask you about so that's sort of in the moment, and you're saying time for action is now. What assumptions are you making that underpin that around growth? I mean, lots of people factoring in weaker growth expectations. That's no secret. But what about inflation? We had a conversation earlier this week with PGIM, who talked about actually a lot of the inflation impulse staying in the States and other geographies at least being much less impacted. Do you think that's going to be a concern here in Europe as well? Do we need to worry about inflation, or we just worry about growth?
Look, tariffs will be stagflationary, and given that we don't have clarity about the duration of this negotiation, neither the magnitude of how the transmission will happen across the world, I think we do need to worry in general in terms of looking at how the picture is going to unfold. I guess taking a step back in terms of, the growth inflation balance, I can tell you for sure, Anna, that I haven't seen in, a long time the level of requests from clients to test their portfolio under a 1974 stagflation scenario. So you can see that people are starting to think about those components. And again, that's where gold, we've seen a lot happening both in terms of flows and in terms of price. But again, strategically, it has a place in our portfolio. It's a good, it's delivered over the last 18 months in terms of geopolitical diversification. A second big component is liquid alternative strategies. So I'm seeing a lot of demand, particularly around absolute return systematic strategies where, again, people are trying to lock in streams of returns that are based on something else than beta. So that's definitely another element. Another area where we see a lot of demand is the short end of linkers in the US. And in general, if I go back to equities, a lot of attention to selectivity. So I did mention earlier taking down risk through mean vol and quality, but there's also a lot to be said around opportunities in specific areas, geographies, sectors. Think about European banks. We're seeing indiscriminate selling, to your point earlier, but profitability is excellent. And so again, why can't we think about that? Or UK, where there's a very low exposure towards global trade.
Well, Guy was asking whether we can rely on dividends. I guess I would ask, can we rely on the profitability of banks if corporates are going to get into distress? Do you see that distress we're seeing signalled by some of the iTraxx crossover, iTraxx Europe? Do you see that having an impact on banks in the end, undermining that sector?
Yeah, no, and that's a fair question. But I think that from a European bank's perspective, a lot of the risks from a macro perspective have been hedged. And again, the path forward for the ECB is supportive. And so I would feel that that is a space whereby, obviously, the level of volatility and uncertainty will require to be nimble, to be granular in portfolios. But if I have to pick an area, that's certainly one.
You talk about this desire for liquidity. We're seeing it quite literally everywhere. What is the tell for you that there isn't enough liquidity or that there is structural stress in the plumbing?
That's a very good question. We've been watching relentlessly. There's nothing critical coming through yet. So if I look, for example, at Monday, in the US, we hit the all-time high in terms of ETFs trading 40% of the overall tape. The average year-to-date was at 28%. Everything is behaving orderly in a normal manner. In Europe, we're seeing volumes around 1.5 to 2 ADVs. And these applies across asset classes. So I'm using ETFs as a vehicle because, again, you can, through a proxy, look into fixed income and equities as underlined. So for now, the message is stay invested and stay calm. But I do agree we live in very, very unusual times. And so being alert is the mantra.
So I'll ask the opposite question then, in that you mentioned the ETF story. Our colleagues over at Bloomberg Intelligence, James Seffart and Eric Balchunas, posted a chart yesterday. I'm kicking myself for not having it with me right now, but basically showed the use of ETFs in terms of some of these market trades that you're referencing. That kind of usage that hasn't come to the fruition since 2008. They're calling it a signal of capitulation. Are you seeing that in the market?
No, I don't think we are there yet in terms of, client demand, areas where attention is going. Just to give you another element, on Monday we saw 19 billion going into the S&P. So again, I think there's a lot of noise that we need to cut through, going back to the mantra of managing drawdowns, selecting pockets where value can be found, thinking about recession scenarios and how do we hedge those tails that have become fatter.
Are we moving into a world, just going to think of your world, where capital stays at home? And what does that mean for BlackRock in Europe? What does that mean for your funds in Europe? What does that mean for European equities? An awful lot of European money currently lives in America. Is that money going to come home, and is it going to stay at home? Are we going to end up with a more balanced world? And what does that mean in terms of the gap between US equities and European equities, global equities, rest of the world equities going forward from here?
That's a very good question. So when I talk to our pension fund clients and our wealth clients, so say the large private and retail banks, everybody is crystal clear around their job, which is to deliver to the end investor, being a pension scheme member or an end retail client. delivering to an end investor, if you keep that as a North Star, means acting across the globe, across asset classes, across regions, to the best interest of that end investor. So for me, look, there's a lot of uncertainty, and I do agree that we've entered into a new phase, but at the same time I have hope, and to your point, that North Star will prevail. Opportunities are aplenty.
Are you signaling that money stays in America? If the North Star is returns on investment, is the best investment still going to come from America going forward, or is it going to be a more balanced picture?
So my point was, I think clients will continue to act on a whole portfolio basis and assess opportunities, so there won't be barriers. The opportunities will be assessed at the whole portfolio. But to your point, look, do I believe in a 12-month period the US will regain its leadership? Yes. You know, AI, there's like big transformative mega forces there. We are going through a very specific phase where, as previously mentioned, I think there's a need to manage drawdowns. There are pockets of diversification opportunities. European banks win an example, where some diversification out of the US, where so much has been done throughout Q4, is a good way forward.
Nice to see you. Thank you very much for coming to see us. Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions, joining us from BlackRock.
Coming up on the programme, emerging market assets have slumped as Trump's tariffs continue to upend global markets. Carlos Carranza from Allianz Global Investors joins us with the EM perspective. That's next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Welcome back to the opening trade, 8:48 here in London, and the London market is down by 1.9%. The CAC and the DAX both down by 1.8% or so. So pretty heavy selling across European equity markets. But if we look ahead, US futures do point higher. E-minis now up by 0.4%. There's been a huge amount of volatility there. We've seen reports earlier on this morning. Well, we've seen news flow coming through from China, but we've also seen reports about meetings that are taking place in China. So we'll watch for any retaliation, further retaliation from China. China is guiding the yuan weaker at a carefully orchestrated pace as the central bank seeks to blunt some of the economic impact of the trade war without destabilizing financial markets. That would be the rationale. Let's discuss all that and other emerging market themes with Carlos Carranza, Portfolio Manager for Emerging Markets Debt at Allianz Global Investors. Carlos, nice to have you with us. Let's start with China then. There's a slow and steady, slight devaluation of the currency. Is that what we're seeing here? And what other tools would you expect China to employ?
The first one is definitely allowing the currency to devalue, increasing what they call the crawling peg of the currency. So basically it's a very controlled, very gradual devaluation, but they increase the pace on a daily basis of that. If the market gets too uneasy, they slow down the pace. If the market is a bit relaxed, they accelerate the pace. But definitely I think that the first tool for fighting against these trade wars is allowing a weaker currency gradually. And that is, I think it's definitely happening.
What's the big worry when you talk to all of your clients? I mean, I've read conflicting things about emerging markets. Depends on the asset class, depends on your currency, depends on a whole lot of things at this point. But in terms of debt markets, emerging market debt markets, some people are talking about this as an incredible haven in a sea of volatility elsewhere, and others are just nervous about all EM assets. So what are the conversations like, big picture, that you're having?
Risk number one is U.S. deceleration, undoubtedly, right? U.S. deceleration and U.S. inflation are clearly one of the drivers of the main concern, because generally emerging markets tend to be a beta to whatever happens in developed markets. So if you see this huge amount of volatility in developed markets, naturally that translates into risks into emerging market, right? So now, interestingly, there are winners and losers of these recent announcements, right? The implications of tariffs are very different across emerging markets, right? Regionally, some regions like the Latin American region are favored by this, relatively speaking. I mean, nobody's favored by this in net, but relatively speaking, there are winners and losers. Latin region, for example, Mexico is not subject to this. The Central America and Caribbean, they have a trade deficit versus the U.S., which means zero tariffs. And then Latin America has low trading balance with the U.S., and Brazil runs its own show. So basically, that's one region that wins. The region that is out of favor the most is the Asian region, which goes back to your point about devaluing currencies in Asia. Why is that? Well, very high tariff rates, very high tariff levels, and open economies which are small and very dependent on exports to the U.S. So that's the question number one. Clients are asking us, okay, so in emerging markets, where are the pockets of value? And then we go to the differentiation.
So it's identifying those.
Yeah.
Kristalina Georgieva, a couple years ago, had said that we were at a risk in the emerging market world of a real sovereign debt crisis. That hasn't really manifested, and a lot of that was at its core because of the inflationary pressures and the commodity pressures at the time, 2021, 2022. Are we circling back there?
Short answer, no, we're not, because emerging markets is in a much stronger position to face what's happening. For example, central bank reserves in EM are up. EM GDP growth is not slowing down as much as US GDP growth, so this is a US-centered slowdown. Whereas in COVID, for example, it was the world. In this case, it's a US self-inflicted policy slowdown, which is larger in the US than in EM. And the third point is that if you look at balance of payment dynamics, and many countries in EM that already defaulted and they're no longer at default risks, that put the asset class in a stronger position. The same way, China, this time, seems in a stronger position to fight this trade war than in 2018 to 2020, which was, let's call it trade war 1.0. This time it's in a stronger position to push back, which is why I believe some kind of retaliation of any form might be coming.
So let's focus in on Latin America for a moment, because a lot of the outperformance is driven by the reshoring in anticipation of Donald Trump. In Mexico, for example, a rise of the middle class. How sustainable is that, though, if you're looking for a lot of that manufacturing growth that has been concentrated in Latin America, in theory, to shift to the United States, hypothetically, in the next couple of years in response to these kind of measures? Is that the Achilles heel of the outperformance and that stability you're referencing in the region?
Here's an interesting point, right? The trade war is mostly focused on Asia, and already some Asian businessmen are discussing potentially transitioning into Central America, which has a trade deficit against the U.S., so U.S. exports more than import, as a way to consider planning for being smart about how they manage these tariffs, right? So, if anything, you could argue that some industries in Central America or Latin America go to the U.S., but at the same time you have other worldwide big production centers moving into Central America or even into Mexico because they're still under USMCA, right? So keep in mind that these announcements, Mexico and Canada are out of it, right? So because they have USMCA, and USMCA was actually negotiated by Trump.
Yeah.
Before Trump, it was NAFTA, the North America Trade Agreement, right? So it is Trump's creation, this USMCA, which might be why also the incentive to keep it running is different than from others, right? So it is a risk. It's definitely a risk.
Yeah.
But keep in mind that relatively speaking, if you have Asian corporations considering businesses in Central America, then that offsets the Central American businesses into the U.S., right? So, yeah.
And we've seen evidence of that in the Panama Canal, for example. China, of course, having quite a presence in the area.
And who's there right now? Yes, the Americans trying to make their presence felt. A couple of headlines in the South China Morning Post this morning, one of which is China prepared to strike back. That's going out of state media. How quickly does that happen? The second one is China's looking to strengthen strategic ties with neighbours, according to Xi Jinping. What does that look like? How far could that go? How friendly will China be in terms of what it can offer to some of its closest neighbours right now? So are we going to see a reordering of trade in Asia?
So right now China is in a stronger position because the entire world believes that the way the U.S. is managing this trade war is a bit unfair. There's a huge pushback against the way the tariffs were calculated, so the famous formula of imports minus exports divided by imports. Huge backlash against that. So China is not perceived right now as the one generating all this noise and the one driving global distribution, right? So that puts them in a more solid position to find partners, to find neighbors. Now, the real issue is, politically, that makes sense, but economically, the other economies in Asia don't have really the demand power for Chinese products that the U.S. has, right? So U.S. is a society where consumption is really, really high, and you really don't have on those Asian partners the ability to sell those products because there's no demand. I mean, GDP-wise, it's much smaller.
Right, so one doesn't compensate for the other.
Yeah, exactly. So I think that politically they are in good terms and they're definitely looking for partners everywhere, even in Europe, probably. But then it comes to the economics around it, and that's the real challenge, right? So because we may build strong relationships, but the business side of it, it's much more challenging given GDP sizes.
Carlos Christie, thanks for talking about us to us. Carlos Carranza, Portfolio Manager of Emerging Market Debt at Allianz Global Investors. Markets moving pretty fast.
Yeah, futures are up again. We're on high alert, I think, for anything coming out of China. Carlos has mentioned it. We talked to Brendan Murray earlier on trade. He was talking about it, just how China retaliates here, supports its economy, retaliates against the United States. All of that in the mix.
There's a huge spread emerging between Italy and Germany this morning. German debt, 10-year down. Italian debt up. The spread widening in Europe. We're not talking anything like kind of the crises we've seen in the past, but it's kind of worth keeping an eye on to see what is happening there.
Spread widening, that's not being reflected in the currency market. We're looking at a 110 at euro dollar. That does it for the opening trade. The pulse is up next. This is Bloomberg.
The names that move markets are on Bloomberg.
U.S. consumers are flexible. We have options. We can produce stuff at home. We have a variety of countries we can import stuff. We can substitute into home production. Whereas countries that sell to the United States are inflexible. They've only got the United States to sell to. There's no alternative. So they're the ones who will bear the burden of these tariffs, which means that there's going to be very limited pass-through into downside economic risk or into higher prices. So I think that a lot of folks have got that wrong.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
In case you missed it, on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
The market sell-off resumes as higher U.S. tariffs kick in, including 104% on China, but there's no immediate retaliation from Beijing. The Spanish Prime Minister calls for the EU to review its relationship with China in light of the trade war. He's set to meet the Chinese president on Friday. Plus, yields on 10 and 30-year treasuries soar, threatening the status or the asset status as a haven. So let's get straight to the markets. I warn you, it's going to be a big market day just to try and understand exactly some of the reaction function from some of the treasuries. Now, we look at FX. I need to tell you a couple of things in terms of what we're seeing. For example, European stocks opening lower following declines, of course, in Asia. It's extremely clear that the fact that they're taking place today, the tariffs, is doing something also to Treasury. So we'll really zoom in and have a look at that. It's also impacting or infecting which way you want to see it. For example, the UK 30-year yield at 5.482. So cross asset, let's have a deep look about this kind of vicious sell-off that we're seeing in what's supposed to be one of the safest assets in the world. Again, investors grasping for reasons behind some of the steep declines in treasuries. U.S. government bonds, we all know, traditionally a primary haven in turmoil times. Maybe there's a worry about stagflation, that the Fed cannot cut rates as fast as certain participants in the markets expect. S&P futures getting some 0.3%. They've been fluctuating quite a lot in the last hour or so. The 10-year yield at 4.3548. And then finally, look, the European markets map. If you look at Europe, it's really following what we're seeing in Asia and what we saw yesterday in the U.S. A whole lot of red on your screen. The DAX down some 1.8%, similar losses for the FTSE and the CAC 40. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump's so-called reciprocal tariffs are now in place, dealing a thunderous blow to the world economy as he pushes forward efforts to drastically reorder global trade. Now, China is yet to retaliate to the latest levies, which Washington's tax on Beijing's imports to 104%. This, as President Trump says, there are more tariffs to come.
we're going to tariff our pharmaceuticals. And once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals.
Let's bring in Brendan Murray, who leads Bloomberg's trade and supply chain coverage, and Grace Peters, global head of investment strategy at JP Morgan Private Bank. So thank you both, as always, for joining us. Grace, I guess when you look at treasuries, what's happening with treasuries right now? What are the concerns?
I think there's a few concerns brewing underneath the surface. I mean, obviously, with all the tariffs kicking in today, fears about growth, downside risks to growth continue to grow, and we know that a recession doesn't shrink the deficit. So I think that's one thing that the market's concerned about. The other thing that I'd say is this risk premium that's increasingly being attached to US assets. And obviously we had a Treasury auction yesterday. There's another one coming up today. Signs that perhaps demand is a little bit weaker. And all of that is resulting in this steepening of the curve that we've seen, particularly at the 10 and the 30-year point, whereas the front end is slightly more anchored, I think, around some of the nearer term dynamics, but indicative of growing degrees of stress and concern, on a cross-asset basis, and that is flowing through into some of the equity price action that we saw as well.
Yeah, and I guess, Grace, the real worry is that the plumbing doesn't hold up.
I think so. At the moment, a lot of the sell-off that we've seen across markets has been reasonably orderly. And we would say if we had to characterise, we're hovering in the S&P around a bear market territory, if we had to characterise, the anatomy of bear markets, we'd put this down initially as a shock. Right. But obviously shocks, and depending on how long they stay around, can manifest into something more systemic. And so when we think, to your question around the plumbing, that does need to hold in order for, markets to remain reasonably orderly, whilst obviously the moves have been significant.
Because there just seems to be a lot of volatility and a lot of stress out there, right? So you don't 100% know where it ends up. Like, if you take lessons from the past, what ends the sell-off?
Exactly. I mean, the range of outcomes is so broad. And so on one hand, you could quite easily say if we kept this effective tariff rate of around 25%, you could quite easily mathematically see US GDP fall to minus 1%, perhaps even more than that if you take on some of the sentiment channels as well. That could easily wipe $50 off S&P earnings and see the S&P fall below 4,500. On the other hand, I think the market is desperate also for some good news, and we can see how quickly that snaps back. So you can quite easily build a case where the S&P still ends the year at around 6,000. So I think there's an element of using historical data, and that would actually tell us that this is not a bad time to start nibbling at the markets. When you've seen a 20% drawdown on a one-year forward basis, you've got around an 80% chance using historic data that the market's up. On a 3-year forward basis, it's almost 100%, even in some really, sort of deep shocks that the market's seen. So historic data is helpful, but there's no doubt that there is more happening below the surface, particularly around how investors are viewing, US assets, the intentional and unintentional drift that we've seen towards US assets over the last couple of decades. And so that is most definitely at play here.
Brendan, as our tariff guy, there doesn't seem to be any, idea of backing down from the White House, or is there that we're just not hearing about it?
Yeah, I think that's the big question is will the White House listen to this kind of analysis and say, maybe we bit off more than we can chew here. The big question coming up for today is how strongly China will hit back. They have been quiet as of now, but they have a tendency to come with their retaliation right before U.S. financial markets open for maximum impact. The range of things that they could hit extend well beyond American imports. They could go after American companies. They could put export controls on key inputs to U.S. products. So it's yet to be seen whether Liberation Day from last week turns into Retaliation Day today. But I think that will set the tone as to whether we're headed toward talks or we're headed toward an extended trade war.
Yeah, and Brendan, this is what Donald Trump had to say yesterday about the tariffs.
And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say.
Again, it's quite difficult to see whether he's willing to take the pain short term, no matter what cost, because he really thinks that this, at the end of the day, in a couple of years, will benefit the U.S. or whether this is a mistake.
Exactly, and let's not forget that the European Union is meeting today. Those trade officials are about to come out with their retaliation for the steel and aluminum tariffs from a couple of weeks ago. So we could have 10, 20, $30 billion worth of American products that have EU tariffs on them. How would Trump respond to that retaliation? Would he take the European Union tariff from 20% and put it up even higher like he did with China? So I think we're in a situation now where things could spiral out of control relatively quickly unless cooler heads come to the forefront and say, look, the damage is too great already, and we need to rethink how we're executing these tariffs.
And Grace, we keep on saying, for the moment, China is speaking strong words, but they're actually trying to use, cool heads. We just have a piece of news out of Reuters, which basically says China PBOC has asked state lenders to cut their dollar purchases. I mean, could it be wider than we're expecting? This is not tariffs, but it's actually going after the dollar.
I think there is an element of that, which I'd put into the comment earlier about the premium being attached to U.S. risk assets. I think if anything is going to widen, when we think about how that manifests in the client conversations that we're having at the moment, typically that falls into three categories. We've got clients who are looking to defend, we're looking to diversify, and there is some instances where we're looking to dip in because of some of that historic analysis and where markets have got to so quickly. In the defending camp, I think fixed income really comes in, to our conversation earlier around the steepening of the curve. We want to keep it short dated, but you can still get good yields, 6%, if you're thinking about, say 4 years of duration. Structured notes is also really important because in that way you can reduce the directionality of your bet and build in downside protection. Gold, we've spoken a lot about in the last year, Francine, but gold and hedge funds also really important. And as I say, there are elements you might want to dip in as well. But I think in the dipping in, back to the question about dollar diversification, I think that's where people are looking to reduce those overweights and diversify currency as well as equity market exposure.
And Brendan, I ask you this every day, but actually we haven't really got a firm answer on who Donald Trump listens to. I know yesterday there was a very public spat between Elon Musk and Peter Navarro. At the end of the day, it seems that the White House is really split when you look at the impact on the economy.
Yeah, exactly. So the 104% tariffs on Chinese imports is really Peter Navarro's dream scenario. He would probably even go bigger. Elon Musk, on the other hand, has a couple $2 billion invested in a gigafactory in China. So he's looking at the impact, the blowback that could come his way by this. So you have this tug of war going on. The ideology of should we really go all out against China in this trade war, or should we be more strategic about it and try to get to a deal rather than try to blow the whole relationship up?
Yeah, and again, I mean, we talked, Grace, about the impact of the Fed. I think Larry Fink said, by certain measures, the U.S. economy is already in a recession. Then yesterday, we also spoke to Larry Summers. This is what he had to say.
I think it's more likely than not that we're going to have a recession. We're very likely, in the context of a recession, to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems.
Is the market too optimistic about how many cuts the Fed can do?
Yeah, I mean, I would agree with the comments that the market can go lower if we're in a recessionary environment. And then I think if we are in that environment, probably the Fed would have to cut more. I mean, the Fed is not going to respond to a market down 15 or 20%. It's going to respond to the data, particularly the data around the labour market. But we're already seeing small signs, that unemployment is increasing. And I think whether it's May or June, that the Fed will absolutely immediately respond to the data. So there's a degree of the Fed put being there, but I think whilst the market is very focused now on downside risks to growth, we shouldn't get complacent still about upside risks to inflation, particularly as we think about, retaliatory action as well.
Brendan, when you look at the timeline for tariffs, and there's a lot to keep up with, I think May 2nd is also when consumers will be taxed if they buy from, mainland and Hong Kong, the kind of the consumer goods that you buy, right, the cheaper things. Does that make a difference to Trump's thinking?
Yeah, I think it all makes a difference. The situation, I think you're referring to the de minimis exemption. Yes. Yeah, of course, Americans have gotten very used to buying cheap goods from China, and that loophole is closing as well. So those goods are going to have to find a way. They're going to migrate to other markets, but the demand for sure is going to be curtailed to some extent just by the sheer uncertainty that the economy is undergoing. Businesses now have to say, is this a long-term thing or a short-term thing? Should I just stop ordering and see how this plays out? So that cloud weighs over both consumers and businesses.
Yeah, and basically de minimis, we love a Latin word, especially on a Wednesday morning, is the fact that if you basically buy a good that's less than $800 for the moment, you're not taxed. We have a great viewer question. Grace, for you, basically, this person's writing in and says, do you think China was a heavy seller in treasuries long end yesterday?
I think it's possible. I don't know definitively, but when we think about, sort of where central banks have been allocating to, we've certainly seen an element of their dollar exposure come down, and a lot of that has gone into gold. The EM central banks in particular, but central banks at large, have indicated in various surveys and in their flows over the last 12 months that they plan to allocate more to gold. That's what's pushing the price up. I mean, our price target for gold is 3,500 because we very much think, the demand is there, and obviously this is a commodity where supply is limited, and therefore we think this is a very strong geopolitical hedge.
Brendan, I know there's a number of press conferences, there's a number, of state visits, or at least visits from White House administration. Is there a couple of points that you're watching out for today and tomorrow?
Yeah, I think, look, we shouldn't forget the fact that some countries are coming to the negotiating table, as President Trump has indicated, Japan, Korea, India. So these are big export economies, and so we shouldn't underestimate the ability of the administration to secure some better trade deals. But in the meantime, the question is, for every job they say that they can create with those better deals, how many do they destroy in the process? A lot of companies would say that they're going to be hurt by these tariffs as opposed to protected by them.
Okay, thank you both for joining us. Grace Peters there from JP Morgan Private Bank and Bloomberg's Brendan Murray. Now, coming up, oil sinks to a 4-year low. We'll be discussing the implications of that with Amrita Sen, founder of Energy Aspects. This is Bloomberg.
A multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
European stock markets resuming their sell-off this morning as President Donald Trump's sweeping new tariffs came into effect. Now let's bring in Bloomberg's Michael Msika, Deputy Team Leader for EMEA Equity Markets and Strategy. Michael, I mean, I can ask you a million questions because the market is just volatile and very stressed, and so that sometimes does these odd moves where they're up a second but down. What are the industry groups that are reeling the most?
So yeah, the markets is very volatile. The reason is the liquidity is really poor at the minute. So you will have a lot of those moves, rip higher, some dip lower. It's a very complicated market to trade. In terms of groups, industry groups, because that's what I wanted to mention. It's funny, those sectors that were defensive in the past are not really defensive anymore. We talked about pharma this morning in taking stock. This is the reality we live in. Every single group that is targeted by the Trump administration will suffer, whether they are a defensive sector or not. And that's what we are witnessing right now.
What about consumers?
So that's down the line. The problem with consumer is how much the consumer is going to be hit by the tariff, how much the inflation is going to shoot up, how much the job market is going to be affected by those tariffs. And when those consequences really hit the market, then we will see a drop in consumer, a drop in consumption generally in the US and in the rest of the world. But that's down the line.
We'll also be speaking to Amrita Sen in a second on energy, on oil, but we also look at miners. I guess how much damage will the tariffs do to global demand and therefore some of these companies?
So that's the main problem for those groups. So you see already today big drop in oil prices. This is a repricing of global growth, generally speaking. So demand for oil, for commodities generally, is expected to drop if those tariffs stay in effect. So again, it's all a bit of a if, because at the moment it's like we are pricing the worst case scenario. Tariffs are in, it's 100% on Chinese goods, the growth is going to drop, but of course if we get negotiations in the next few months, if we get trade deals, that will change.
What is the one thing that you're looking out for? I mean, again, we look at this, stress a little bit everywhere, and there's genuine questions about whether the plumbing breaks because you don't really know where stress or risk goes to. I know Bloomberg is like on high alert with all of our reporting team, but is there anything in Europe that we should be watching out for?
So really, what we see in the market is how much asset managers are willing to de-risk at the moment. Yeah. This is the key. I was reading some notes from Goldman Sachs partner earlier about the S&P 500 especially. We are now at a level where long-term investors are willing to step in. They're not going to step in straight away at that level. They will scale it down and slowly getting in. But we are at that level where the drawdown that we had in equity markets is getting attention from long-only investors, for sure.
And that's very diplomatically put, getting attention. Everything is getting attention today. Michael Msika, thank you so much for joining us. Bloomberg's EMEA Equity Markets and Strategy Deputy Team Leader. Now, oil sinking to a 4-year low as intensifying global trade wars threaten to batter energy demand. Brent tumbling towards $60 a barrel, WTI falling for a 5th straight day as a fresh wave of U.S. levies went into effect. Now, for more on the energy space, let's bring in Amrita Sen, Founder and Director of Research of Energy Aspects. Amrita, thank you so much for joining us. How much damage do you think these tariffs will do to oil demand?
Well, I think, look, we believe if the tariffs stay as they are, without any negotiations and without accounting for either the currency moves or even domestic stimulus, because I'm sure a lot of countries will go ahead and stimulate, then the demand loss in oil could be over 1 million barrels per day. In some cases, you could argue that's almost the worst case scenario, but that's obviously not going to pan out in reality. It will be less than that, given, again, China will stimulate, for instance, but it is still going to be significant second, we are putting through about 500,000 barrels per day of cuts for our second half of the year demand numbers already, particularly focused on the petrochemical side, LPG, ethane, because that's where the tariff war is going to be at its worst between China and the US when it comes to energy. And then fuel oil and diesel takes a bit of a hit. Gasoline less so, because again, it will take time to see how the consumer reacts and how deeply it actually affects them. It's much more an industrial recession first.
Yeah. So, Amrita, what do you think is the real reason behind the Saudis actually pushing OPEC Plus to raise supplies?
It's been about undercompliance by some of the laggards, and they have been, His Royal Highness Prince Abdulaziz has been kind of highlighting this for a while, right? He's been very patient over the last, I'd say a year. And he has multiple times stated that the cuts need to be equitable. They haven't been, and I think in the last couple of months, particularly with Kazakhstan's production, not just 150,000 barrels per day higher, they're like 400, 500,000 barrels per day more than what they need to be, forget the compensation cuts. I think that's where the change really came about. The first warning was when they started to unwind for April. And again, this is a warning shot. This is not a price war. A price war would entail millions of barrels per day coming back from spare capacity. This is a warning shot to say get in line. If not, I do think you could continue to see another round of faster than expected increases, especially because when we spoke to the Kazakhs yesterday, they are saying they haven't even reached an agreement with their energy companies to figure out a way to cut production. So I think even in May, you could get a decision by OPEC that accelerates cuts further.
Yeah, so Amrita, so you don't see this as the beginnings of a new OPEC Plus price war?
No, because the price war would be significantly larger, right? Remember 2020, we had Saudis going to, over 12 million barrels per day, Russia kind of doing the same thing. This is very much saying, listen, we need to get in line. Everybody needs to contribute. And again, the 400,000 barrels per day of increases that are in theory coming in May can be offset by compensation cuts. So the net impact on balances should be zero as long as the laggards comply. So to say, get
crude oil create resistance in crude oil create resistance. अभी कुछ बना तो नहीं है, देखते हैं. कोई लेवल बन ही नहीं रहा है अभी इसमें क्रूड ऑयल में. 7 अप्रैल का लो. ये इसी की बात कर रहे हो ना, फिर एज अ रीटेस्ट. नेचुरल गैस भी बिल्कुल ऐसे साइडवेज हो गया है आज. ओके गाइस, थोड़ी देर पहले एक न्यूज़ और आई है चाइना की ओर से. चाइना का जो सेंट्रल बैंक है, ठीक है, जैसे हमारे वहाँ आरबीआई है, तो सिमिलरली जो चाइना का सेंट्रल बैंक है उन्होंने भी अपनी जो सेंट्रल बैंक है उन्होंने भी अपनी पॉलिसी में शिफ्ट किया है और भी वहाँ पर गवर्नमेंट बैंक है, मतलब स्टेट ऑन्ड बैंक आप कह सकते हो, गवर्नमेंट बैंक्स, उनको ये इंस्ट्रक्शन दे दिए हैं कि जो यूएस डॉलर आप लोग परचेज करते हो उसको कम कर दो। ठीक है, एक सिग्निफिकेंट मूव है जो टैरिफ लगाए हैं 50% एक्स्ट्रा उसके रिस्पॉन्स में। देखते हैं इसका क्या इम्पैक्ट पड़ता है। दैट इज़ ऑलरेडी अ मेजर शिफ्ट कह सकते हो बिटवीन द यूएस चाइना ट्रेड, बिकॉज अगर देखो कम बाइंग होती है यूएस की, तो अगर मेजर शिफ्ट होता है, अगर यूएस डॉलर कम परचेज करता है चाइना के जो बैंक्स हैं, तो एक तरह से जो यूएस की करेंसी है उसमें एक डाउनफॉल और देखने के लिए मिल सकता है, इम्पोर्टेंट रहेगा। लेट्स सी ओवरऑल क्या इम्पैक्ट पड़ता है, देखना पड़ता है। क्रूड ऑयल को ऐसे देखोगे तो एक रेंज है, छोटी सी, बहुत स्मॉल सी रेंज, कोई बहुत बड़ी रेंज नहीं है। जैसा परसों हुआ था मोमेंटम, दैट काइंड ऑफ मोमेंटम अगर मिल जाए तो फिर काफ़ी अच्छा मूव आ जाएगा। गैस भी देखो इम्पोर्टेंट है, अगर ये निकल क्लोज कर दे ना 305 के ऊपर क्लोज कर दे कैंडल, एक सिंगल कैंडल 15 मिनट की, तो इसमें बाइंग का ट्रेड बना देंगे। बट अगर क्लोज नहीं होती है तो फिर थोड़ा सा अभी रिस्की है वहाँ पर लेना विदाउट significant support. बाकी क्रूड ऑयल और कहाँ जा सकता है इसके नीचे? लाइक करते रहो गाइस, लाइक नहीं रुकनी चाहिए। इंडियन मार्केट भी देखोगे वहीं का वहीं रुका हुआ है, बैंक निफ्टी फ्यूचर मोमेंटम ही नहीं है।
consumers and what could happen in the midterms, which again are only 18 months away and seeming to cause some consternation even among members of the Republican Party.
Charlie, thank you so much. Of course, a terrific update from our Charlie Wells. Now let's continue the conversation on the divisions emerging within the Trump administration. We're joined by Brett Bruen, President and Chief Executive of Public Affairs Agency Global Situation Room, former Director of Global Engagement in the Obama administration, and an ex-U.S. diplomat, and our very own Stephanie Baker, Bloomberg senior writer and author of Punishing Putin. So thank you both for joining us. First of all, Stephanie, and we were all, frankly, led to believe that Donald Trump was a businessman, that he wanted a deal, that he would put America business first, and that also he cared about the stock market. I mean, is this a timeline problem, that he cares about America but in 4 or 5 years, or is it that his North Star is something else?
Well, you see him governing on a far more radical agenda than he campaigned on. And I think that has shocked many of his supporters. You've seen, with some of his, donors like Ken Griffin, Bill Ackman, come out and criticize the tariff policies, which have gone much further than what he said he was going to do. I view the Musk attack on Peter Navarro as an attempt to get him fired. And I would say, actually, if I was to put my money on it, I'd back Musk, because Musk is far more important to Trump than Navarro is. All these his money, Musk's money, is the thing that Trump needs to control the Republican Party. A lot of Republicans are up for re-election next year, and the threat of being primaried with a Musk-backed candidate, if they don't fall in line, is the thing keeping them supporting Trump. And that if that's not there, there is a possibility that Republicans will look at the situation, will look at the economic fallout, the loss of jobs, companies going bankrupt if this continues, and decide to band together and form a veto-proof majority in Congress to block the tariffs from going ahead. When that will happen is unclear, but Trump has been talking about tariffs for decades, but no one, even his supporters, thought he would go this far, this fast, and that, no one denies that there's a trade imbalance with China, but even his supporters say that this shock and awe approach is not the way to do it.
Yeah, and Brett, I guess the question is, I've read so much on different theories about, Donald Trump wants all the countries to come and kiss the ring to try and get forgiveness or renegotiate. I've heard actually he really believes that this will be better off for U.S. companies longer term. Do we still need to think about why he's doing this to find a way forward?
I think the question of what is the end game looms large over Washington right now, because we don't have a timeline. Quite frankly, we don't even have a real strategy. We don't know, is this, as Peter Navarro would like, a restructuring of the U.S. and indeed the global economic order, or is it, as we're hearing from Trump, this is all about negotiation. This is all about leverage. And, what's interesting in this battle between Navarro and Musk is that Musk has not just money, but he has influence over large swaths of the party as it's currently constructed. Navarro does not. And so I do think as this, public spat plays out, Caroline Leavitt, the White House press spokesperson, said, well, this is just boys being boys. What's unusual is you don't usually see that play out in the West Wing. Right. That's something, that plays out on the streets of Washington, not inside the White House.
Yeah, but Stephanie, I remember interviewing Peter Navarro the first time around, right, when Trump was in charge. And at the time, even his thoughts on China were seen as outlandish. And then they became mainstream policy because a lot of his thoughts on China at the time were also then taken on board by the Biden administration. So it feels like he's not that easily replaceable.
I think he is, and I follow the journalist motto, follow the money. I think too many people have lost too much money with this, that it cannot continue. Unpredictable as to when, this might be reversed. But look at Elon Musk. He's lost more than $140 billion. That is an enormous amount of money. And I think others as well, will put huge amount of pressure on Congress to stop this. The overall strategy, a lot of people do agree with, that there needs to be a rebalancing of trade. But the tactics that are being employed, as Brett has alluded to, there's no clear communication strategy. There's no clear goal set out as to what countries can do to get relief from the Trump tariffs. And it's not clear, is it a negotiating strategy? Is it a revenue-raising strategy? Is this about restructuring the American economy? If that's true, I don't think this is going to work. The input costs as a result of these tariffs are going to impact a lot of companies manufacturing inside the United States. I liken this to when the G7 put unprecedented sanctions on Russia as a result of Putin's invasion of Ukraine in 2022. Trump has essentially self-sanctioned the U.S. economy in an unprecedented way that will isolate it globally.
But what I still find surprising is that not a lot of people are coming out and talking against Donald Trump, right, despite the market rout.
Well, I think you saw the beginnings of that. Earlier this week, it was Senator Ted Cruz suggesting that Congress needs to take back some of the power of the tariff. Now you've got Tom Tillis, the Republican senator from North Carolina, as well as a whole host of Trump supporters, the billionaires who backed him in his campaign. And I think that will continue to increase in calling on Trump to rethink this, to take a deal, any deal. And what's interesting here is what we're seeing play out on the crisis front with Ukraine, Gaza, and now Iran is similar in some ways to what Trump's strategy is on these tariffs, which is, come to me with a deal, let me get a deal, any deal. And I bet, and I'm putting my money on this, that the White House is going to parade out this morning, look, we've got the beginnings, the concepts of a plan of deals with these countries to assuage concerns in the markets and to try to tamp down some of that Republican unrest.
So what, he just needs an off-ramp in an elegant way.
And the thing about Trump is it doesn't even need to be a fully fledged plan. What he will do is have a call with Keir Starmer here in the UK. He'll say, look, Keir is willing to give me the following concessions, even if he's only alluded to those. And then the White House parades that as the world is coming to Washington and offering Trump these concessions. That, I think, will be the turning point. We'll wait and see what we get from the White House this morning. But my bet is that they're going to try to push out some positive news to indicate the world is willing to concede.
Yeah, because, Stephanie, not much is actually going the president's way so far, right? He was expecting a quick resolution in Ukraine. That's not happening. I was also surprised that the tariffs touched allies. Like, if you look at Israel, if you look at India, no one got a better or softer deal because they were close to the U.S.
Exactly. I mean, I think a lot of people thought there would definitely be tariffs against China, but going against allies and so many other countries all at once was not anything in anyone's playbook. I think the big problem is that while there might be certain countries like Japan and South Korea that could do a deal, China does not seem interested in doing a deal. And the tariffs are so high that it's unclear what they could do to get any kind of tariff relief. And that slice of the pie is so enormous. Even setting that aside, let's say there's some deals with South Korea and Japan and a few other countries. I think the uncertainty that has been unleashed by this is going to be so damaging for so long. That will be really hard to undo.
Yeah, could there? I mean, again, we're spending quite a lot of time looking at treasuries and why what's happening in treasuries. Is there a risk that China says, even if we can't retaliate on tariffs, let's just stop buying treasuries and let's do stuff with the reserves? Is there a longer-term play that the U.S. really won't have that U.S. exceptionalism anymore?
Well, that is their leverage, right? They could just pull out of U.S. Treasuries. The degree to which they're able to do that remains unclear, and maybe that is some of the reason behind the market moves. But that is definitely the weakness.
But could I also just lay out a smart play here, and that is if Trump is able to cut deals with Europe, with Japan, South Korea, some of those other big economies, and then tell them, on top of that, we want you to impose additional tariffs on Beijing. Now, all of a sudden, he's able to leverage. This is some three-dimensional chess, which, again, we'll see whether or not this White House is capable of doing that. But Trump has said everything's on the table. And the mistake he made in putting in place these high tariffs on everyone is that you're not able to apply the same pressure on China.
The problem is one of trust, right? As Stephanie knows very well, is that if you're an ally of the U.S., you suddenly go back into bed with them and say, yeah, everything's fine, let's go after China. Which brings us to your risk report. So you have a risk report out next week. I know you're looking at AI, ties with Elon Musk. Market meltdown is probably in there as well.
It is, and what's really interesting, over 100 preeminent public affairs leaders contributed to the report, which is now coming out quarterly, and the top risk is AI adoption. And what I think we're seeing is that companies are rushing too quickly to put in place some of these new AI applications without assessing the concern that that's raising amongst consumers and other stakeholders. That really is something that executives have got to be more careful in terms of how they proceed, because, yes, there are efficiencies to be gained, but there are also customers to be lost.
Thank you both for joining us. Brett Bruen, Global Situation Room President and Chief Executive, and Stephanie Baker, Bloomberg Senior Writer and author of Punishing Putin. I think we have the book cover. If we don't, you should read it. It's a great read. Coming up, we'll be discussing China's next move in the trade war with the U.S. with Kei Jin from the LSE. Stay tuned for that conversation. It's up next, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
In case you missed it, on The Pulse.
You know, it's not the headline-grabbing $15 billion bankruptcy. It's not Lehman Brothers. It's not that. But what is happening underneath the surface is just frantic activity. There's a moment in time when real estate gets really interesting.
Now or soon?
Now. It's here.
Don't miss The Pulse, live every weekday. Welcome back, everyone, and let's get the European reaction to President Trump's new tariffs with a 20% levy now in force against the EU. Well, Bloomberg's Oliver Crook joins us from Brussels. So, Ollie, how is the EU reacting to this?
Yeah, Francine, we should probably take a second to mark the moment here, because we're talking about more than 500 billion euros worth of exports from the EU that go into the United States, the biggest exporter to the United States, now having a 20% tariff on all of those goods. That comes out to about 100 billion euros worth of different costs. And who is going to bear those costs? That is what we're going to begin to find out over the next few hours. Is it going to be the producers here in Europe? Is it going to be the consumers there over in the United States? It will probably be a bit of both. The next step for the Europeans here, the policymakers here, is they're going to vote a little bit later this afternoon on retaliatory tariffs to be imposed on the United States on certain goods. This, Francine, is in retaliation not to the 20% we got today, but the steel and aluminum tariffs that we got a couple of weeks ago. This is going to be a pretty muted response. It's only going to be about $20 billion worth of $20 billion worth of goods that will come into effect next week, and they may not even begin collecting those tariffs until May, because what they want to do is to create as much roadway to have negotiations with the Trump administration, an administration that so far has had no interest in speaking to the Europeans. Could that change next week when Giorgia Meloni heads over to the White House? She'll be there and talking to Donald Trump to try to get some concessions, try to advance talks on negotiations with tariffs. But we should also say, Francine, there's another geopolitical development we should be paying attention to, and that is that the Spanish Prime Minister, Pedro Sanchez, is heading to Beijing on Friday. He has for a very long time advocating a closer relationship with China. Could this shift in geopolitics, diplomacy, and trade put the Europeans going a little bit closer to China? We should say that all the trade ministers that I spoke to earlier this week are not yet ready to talk about a wholesale sort of rethink of the Chinese relationship. But in a world when the unthinkable seems to be happening every other week, it's a conversation we need to be paying attention to.
Well, we certainly do. Ollie, thanks so much. Oliver Crook there in Brussels. Now, China has held off from an immediate reaction to higher import duties imposed by the U.S. Chinese goods heading to the U.S. now face tariffs of 104%. Now, instead, Chinese state media have reported on the importance of building relationships with neighboring countries. Well, joining us now is Keiyu Jin, an associate professor of economics at the London School of Economics. Keiyu, as always, thank you so much for joining us. Is China holding back? Are they looking at options, or do they want to try and find a solution?
Of course, China would like to find a solution, but there needs to be an appropriate off-ramp. I think China's waiting and seeing. But really, it really needs to be in a position of strength when they talk to President Trump. They are coming out with equivalent pressures, countermeasures, and really shifting from passive defense strategy to targeted retaliation. Just from the phase one experience, by pressuring U.S. soybean farmers, they have eventually come to an agreement.
I mean, is there anything that, for example, PBOC can do to actually try and shield from tariffs, or at least have some sort of, tariff defense without aggravating the Trump administration too much?
Well, of course, the obvious obvious thing to do is just massive amount of domestic stimulus. They've talked about targeting the specific industries that will be hurt most from the exports, and there'll be a lot more pivoting to new markets. Of course, that's more in the longer term, but in the short term, they are really eager to have a renegotiation with Trump. But again, China's really not the other small economies and be able to concede because they believe that one concession leads to other more demands.
How are Chinese companies actually reacting to this, KU?
Well, first of all, it's been a long march since Trump 1.0. It has really set off a globalization frenzy of diversification of suppliers, factories, investors, new markets. It's been an ongoing process. If you look at the surveys now, 70 to 80% of Chinese companies have an ongoing overseas plan. So they are better protected than the first time around. Of course, in the short term, this is a massive profit squeeze for Chinese companies, but for U.S. companies as well. And part of the plan to raise tariffs on the U.S. goods is to actually shift some of the cost from the importers in China to the U.S. importers as well to share the burden.
I mean, how much, given all of the changes in supply chains the first time around President Trump was in charge, how much more can China actually build some supply chains that are de-Americanized or even, get away from dollar as a reserve currency and treasuries?
But that's, again, an ongoing process, and this time around, it's just simply accelerating that, and you feel that undercurrent in play everywhere around the world, where you see everyone is trying to sign up new trade partners, including RCEP, closer with the partners, even talking about zero tariffs in 54 different sectors. We heard also from the previous panel, but I totally agree, it feels a little bit warmer towards China, where we stand in Europe. And of course, there will be much more regionalization. China's talking to Japan, to South Korea. Again, U.S. is forcing these countries together. And these fixed alliances based on geopolitical and ideological interests, that is out, right? It's now a very fluid, realistic, circumstantial situation.
We know the Spanish Prime Minister, KU, is of course visiting China, and he wants the EU to pivot more towards China to counter some of these tariffs from the Trump administration. Could China actually longer term be a beacon of stability, and could China be the real winner in all of this?
Where Washington, D.C. is erecting greater walls, China is actually voluntarily lowering tariffs, even speaking about zero tariffs to the least developing countries. And it aims to build stronger alliances with Europe, Africa, Latin America, and ASEAN, and everywhere around the world. You see a lot more interest, even Latin America, towards China. Of course, Europe and China have a lot to cooperate on, especially the EV and battery supply chain. And here, I really think that China is going to reevaluate its position in the globalization. In fact, taking measures to invest more in Europe, build joint ventures with European countries. As long as it's an open possibility, China will embrace this opportunity, including in finance, global finance.
In the shorter term, Key, what's the biggest risk for China? I guess that if you look at the yuan, that it could crash, or there's some very big shock of financial instability.
Certainly, if the U.S. stock market experiences greater volatility, it will transmit to domestic stock markets and pull down confidence even more. China has already been very, very fragile, very vulnerable to confidence shocks, and this is certainly very bad news in the short term. Lots of companies are going to be squeezed of greater profits, but still, this Trump shock will be the most kind of convincing force for government to stimulate aggressively, to subsidize even more strategically, to pivot to new markets. And China is now readily in survival mode.
May 2nd is also a big day because for now a package that's shipped directly to the U.S. consumer that has a retail value of no higher than $800 basically doesn't get tariffs because it's too small to matter. But that changes for packages coming in from mainland China and Hong Kong. Will that be a big hit to the Chinese economy, KU?
Well, actually, right now, China is really trying to accelerate some of the service trade, the digital e-commerce, to offset some of this of tariffs. So we're going to see more of that. In fact, we have to be reminded that the U.S. has a trade surplus in services with China in finance and all these and this could be another target for China in terms of countervailing measures. The negotiation could look like opening the financial services more to American companies, which I think is a great thing. But what this is all doing is to really restructure a global supply chain. I mean, costs are going from 15% to 45%, and so we're embracing new technologies.
Yeah, Kay, as always, thank you so much for joining us. Kay Jinder, Associate Professor of Economics at the London School of Economics. Don't miss our Markets Daily newsletter for what's happening in stocks, bonds, and currencies. This is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the fourth grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
The names that move markets are on Bloomberg.
U.S. consumers are flexible. We have options. We can produce stuff at home. We have a variety of countries we can import stuff. We can substitute into home production. Whereas countries that sell to the United States are inflexible. They've only got the United States to sell to. There's no alternative. So they're the ones who will bear the burden of these tariffs, which means that there's going to be very limited pass-through into downside economic risk or into higher prices. So I think that a lot of folks have got that wrong.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Trump's tariffs take effect. Levies hit a 100-year high. Import taxes arrive for dozens of U.S. trading partners, and an 104% tariff on China. Market dysfunction. Global bond markets convulse, sending U.S. 30-year yields soaring to touch as high as 5%. And China holds fire on immediate retaliation, but allows the yuan to sink to a record low. Beijing reportedly plans its next moves. This is when the orderly market sell-off starts to look disorderly. Since Friday's close to now, the 30-year yield is up some 40 basis points. At one point, we were touching 5%. At one point, the biggest sell-off for this bond market since 1982. This is the kind of move caused by a forced liquidation of leverage trades being unwound of a fire sale of the most liquid asset. But here's what happens when a foundational part of the financial system starts to break down. The knock-on effects across the globe happen. 40-year yields for Japan rising at one point, the highest since they debuted in 2007. That's about 18 basis points now. Your UK 30-year yield also climbing to the highest since 1998. This stock market also flipping back and forth between gains and losses. At the moment, we're posting gains. We're up 0.1% for your U.S. futures session. NASDAQ is 0.5%, while Russell 2000 falls 0.4%. We are still 12% lower since the reciprocal tariff tariff announcement. Meanwhile, crude oil falls 3.2%, so there is still recessionary bets going on in this market. It is an important hour. You do not want to miss the conversations we're going to be having. We're going to be speaking with Sharon Bell of Goldman Sachs and Priya Misra of JP Morgan Asset Management. But back to our top story, global bond yields continuing to push higher this morning with reciprocal tariffs here and now. With a look at the market action is Bloomberg's Valerie Teitel. Val, is this some disorderly moves or what?
Look, this is really starting to beg the question, are we about to see some major market dysfunction when it comes to the Treasury market? The three-day move in the long end, Danny, is something we've not seen since March 2020 when there was a failed 30-year auction and the Fed had to ride to safety. That is a very concerning move, a lot of concerning price action in the Asia session overnight. I want to flip on and just talk about one thing that could possibly be to blame, which is this narrowing of swap spreads, Danny. That is basically telling us that there is not enough dealer capacity. There's not enough balance sheet capacity to absorb this forced liquidation of the Treasury market. And also to that, guys, Danny, we do have some further auction events, let's call it that, like major market catalysts for the Treasury market. We have a 10-year auction today and a 30-year auction tomorrow. Remember, it was an auction that really spurred the major market dysfunction back in March 2020.
Yeah, and we already saw a not very good 3-year auction yesterday. Valerie, thanks so much for breaking it down for us. Bloomberg's Valerie Teitel. So President Trump's tariffs have now hiked levies to an 100-year high as of midnight, reordering global trade. And on the eve of the implementation, the president spoke at the National Republican Congressional Committee dinner.
And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say.
Our team coverage on tariffs starts right now. Bloomberg's Tyler Kendall joins us in Washington, D.C., and James Mager in Beijing. Tyler, let me start with you. The filter out of the White House yesterday morning was one of negotiation. By the evening, it was one of escalation. Where do we stand now?
Yeah, good morning, Danny. Well, it really depends on which trading partner we're talking about, right? Of course, with China, we saw that escalation when it came to stacking those tariffs on top of each other, coming to 104% going into effect at midnight. But with other allies and trading partners, it does appear that the White House is welcoming the outreach, right? We had President Trump yesterday saying that he had a productive call with South Korea's acting president and that a trade deal for that country was looking good. We have also learned that the U.S. appears to be giving priority to Japan in future trade talks. And President Trump now saying that each deal is going to be tailor-made, not off the rack. Those are his words when it comes to the future of the tariffs here. And we even had Treasury Secretary Scott Bessent yesterday, for example, saying that they're taking an ice cube approach, that an ice cube only gets smaller with time, and that if countries don't retaliate, this is going to be the highest level that those tariffs end up being. But we would be remiss if we didn't mention, Danny, yesterday, President Trump really appearing undaunted, particularly by the market's reaction. We are, of course, focused on these reciprocal tariffs, but important to note, President Trump vowing that some more sector-specific tariffs are coming. He said that the pharmaceutical sector tariffs would be next and coming soon.
Tyler, can we get into that? What exactly would tariffs look like on specific sectors? It's something Trump had talked about before and again talking about it increasingly now.
Yes, definitely. Well, this administration has floated, particularly for pharmaceuticals, it could reach up to 25%. And we know that they are looking at invoking what's known as Section 232. As you well know, the administration has already invoked this to put into place those steel and aluminum tariffs, as well as tariffs against automakers. And it essentially would first, we get some sort of a heads up that this was coming because it first kicks off an investigation and then later the implementation of the tariffs on grounds of national security. Now, President Trump has also floated some other sector-specific tariffs that could be coming down the pipeline, including on lumber and also copper imports, all saying that this is necessary, not just for economic reasons, but for those national security concerns so that the U.S. can bulk up its own supply. Of course, as you well know, this would have wide-reaching impacts because these tariffs would likely be stacked on top of the existing tariffs that we're already seeing.
And speaking of stacking tariffs on top of tariffs, James, that brings us to China. 104% tariff on China now coming into play. The immediate reaction from the Chinese, we haven't seen it, but reportedly a meeting is planned. What might we get out of that, James?
I mean, I think one thing before we get to that is important to remember is there's actually not 104% tariffs because
Donald Trump put tariffs on many Chinese goods in the first administration. Joe Biden added to those during his administration. And so compared to where we were in, say, 2017, are you looking at, some goods from China have, multiples of 100% tariffs on them now. But, the reaction, as you said, we haven't seen retaliation being announced by the Chinese government yet. Based on past, how they've acted in February and March, we were expecting something to happen at midday, Beijing time, as soon as the U.S. tariffs went into place. That didn't happen. But we may see something later today. There was reportedly a meeting today, of the senior leadership, Xi Jinping and the rest of the Politburo to discuss what to do about the Chinese tariffs. To discuss what to do about the U.S. tariffs. I think, and if we do see something, it will be similar to what we saw last week, which was higher tariffs on U.S. goods. It was investigations into American companies in China. It was restrictions on exports of critical minerals and rare earths. It was also, they added a bunch of U.S. defense contractors, drone makers, and other companies to the Chinese equivalent of the entity list. And so we're likely to see more of those things today. And you're also seeing in the FX market, the Chinese central bank is clearly allowing the yuan to weaken, which will make Chinese exports more competitive and will blunt some of the effect of those tariffs. Whether they can weaken the yuan enough to allow, to blunt a large portion of the effect of those tariffs without causing Chinese investors and savers to try and get their money out of the yuan and sparking capital flight or not is still to be seen. But you see the central bank in the market today telling state banks how to sell and how to buy dollars to sort of control the speed at which the currency is depreciating.
James, to that point, do we risk a trade war turning into a financial war right now, given what the Chinese are saying, with the PBOC is reportedly asking banks to hold back on those U.S. dollar purchases and the allowed devaluation of the currency?
It's very possible that these moves could lead to unexpected consequences in the financial market. In 2016, when the PBOC tried to devalue the currency, they sparked a massive capital outflow from China because people suddenly wanted to get their money out, and so these kind of actions, even though people think they're in control, can have these unintended consequences. You're seeing in the treasury market today that yields are spiking as well. So it's quite possible that an action on the trade front, whether it's higher tariffs, whether it's export controls, can lead to unexpected consequences in other markets, in financial markets, in the stock market, wherever. It's impossible to say, that it's definitely going to happen or it's not going to happen. But the risks of those kinds of things is definitely rising.
James, Tyler, thank you both so much for your time this morning. So much to go over. By the way, George Seravalis of Deutsche Bank warning that we are headed for a financial war. It might shift from a trade war to a financial war. Also writing that they're warned about confidence crisis in the dollar. Events over the past few days are, in our view, validating those fears because we are witnessing a collapse across U.S. assets. Okay, let's get to some other top stories that are trending on your Bloomberg terminal this morning. Ray Dalio is warning that investors aren't paying enough attention to a once-in-a-lifetime breakdown in the geopolitical and monetary order. The billionaire Bridgewater founder blames these underlying conditions for leading to the tariff disruption that has been dominating market action. He says bigger disruptions are still likely to come. The largest seller of eggs in the U.S. reported a 247% surge in profits last quarter after prices rose to a record high. Mississippi-based Cal-Maine Foods also acknowledged it had been contacted by U.S. authorities investigating price fixing. The ongoing avian flu outbreak forced farmers to cull some 30 million birds so far this year. And demand for used gold Rolex watches is on the rise. The price of the precious metal has risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces, climbing the most places up in the index since it was launched in 2022. Coming up, stocks teeter on the edge of a bear market. We're going to discuss with Sharon Bell of Goldman Sachs next. You are watching Bloomberg Brief.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is a bit of a panic moment for the market, and it is reminiscent of March of 2020. And in that type of environment, no asset class is immune from these potential dislocations. So I think technicals is certainly at play. Fundamentally, I think investors might be questioning the long-term investment case for the United States. And I don't want to go too far with this idea, but a lot of countries around the world own U.S. treasuries. And could they use that as a retaliation tool? I hope not.
Yes. Ruptures in global bond markets after U.S. tariffs come into force. Let's get the reaction from Europe with, again, European bond yields moving higher in the U.K., the biggest spike to the highest level in 1998. And now a 20% levy in force against the EU. Bloomberg's Oliver Crook joins us from Brussels on this. Oliver, is there any space for negotiations with reciprocal tariffs now here?
I mean, that is certainly what European policymakers and leaders and citizens, frankly, alike are hoping for. So far, there has not been any really indication that the Trump administration is willing to have those discussions. But, Danny, I think it's worth just taking a second to mark the moment here, because the EU, when you look at the trade data from last year, this is the bloc that was the biggest exporter to the United States. We're talking about more than 500 billion euros worth of goods that come from the EU into the United States. You put 20% on that, that's 100 billion euros of costs annually that need to be distributed somewhere, from the producers here in Europe to the consumers in the United States. And over the last few hours and the coming weeks, that is going to be figured out. Who is actually going to be paying for this? For the policymakers here in Brussels, they're going to be voting on measures a little bit later today in retaliation, not to the tariffs from today, but the tariffs from a few weeks ago on steel and aluminum. They're going to take a very sort of modest approach in imposing those tariffs. It's only going to be about $20 billion worth of goods that they're going to target. It's going to be some of the things that the U.S. exports, like motorcycles, boats, appliances, poultry, some agriculture, but they may not even start collecting those tariffs in May. The reason for that, Danny, is they want to give themselves as much flexibility as possible to get some of these negotiations with the Trump administration. But as we've been reporting over the last few days, they don't seem very inclined to talk. And Danny, maybe that will change next week. We have the Italian Prime Minister, Giorgia Meloni, going to the White House, hoping to get some concessions or to get at least some idea of what the United States wants. While, Danny, at the same time, you have the Spanish Prime Minister, Pedro Sanchez, in Beijing on Friday. He has been talking about, with all of this uncertainty, potentially having a closer relationship with China. So this is really ripping through not just the markets, but also the geopolitics here in Europe.
A really interesting development. Oliver, thank you so much for keeping us on top of it. That is Bloomberg's Oliver Crook. And European equities under pressure this morning, down 2.4% as U.S. futures flip between gains and losses. Sharon Bell of Goldman Sachs writing, quote, "We would argue that we are in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risks." She's a senior European equity strategist and pleased to say that she joins us now. Sharon, thanks for joining us on quite the morning. So how close are we to tipping in to something that looks like more of a fundamental bear market driven by a recession?
Yeah, we're getting closer by the day, by the minute, aren't we, at the moment? And I think if this does tip into a recession, and that looks extremely close now, then a typical cyclical bear market, you see falls from peak to trough of about 30%, and we're not there yet, I'm afraid.
I feel like we have to continue to ask this morning and most mornings as we see this selling action happen. Sharon, as an equity investor, what do you look to act as a circuit breaker of the current dynamic that we're in right now?
The circuit breaker that's typically the case, and this was true in the pandemic, for example, but it's been true in various other instances too, is policymakers shifting. So this could either be a shift in tariff policy, for example. That doesn't look likely at the moment, but any easing on that front clearly would be powerful for the markets and a huge relief. And then the other thing would be monetary easing as well. But at the moment, given that tariffs are, certainly for the US, likely to be inflationary, there's less room for Powell to really shift on rates. So yes, it would have to be a policy pivot, I guess, of one sort or other that will help to provide markets with relief.
It was previously, to start this year, Sharon, with the expectation of tariffs coming in, was that it was bad for the U.S. at a time that Europe was starting to spend. And that meant that you could see European equities rally. The opposite is happening, at least for today, at least since we got the implementation or the announcement. Sharon, is there any sign that that rotation might come back? Or is it a case where the U.S. suffers, but the rest of the world suffers more?
I don't know that the rest of the world suffers more, but the rest of the world certainly suffers. Europe is essentially a large open economy, very dependent upon global trade. So if we're talking about a global trade war and that continuing to heat up, Europe is not going to be a beneficiary of this. Europe is going to suffer too. And as for whether it suffers more than the US, one thing I would say is that there are some cushions for Europe. Europe has already opened the sort of fiscal piggy bank, as it were, for Germany. You're starting to see a bit more spending there. I think Europe could do a little bit more in terms of that. You can also, because I think this should be less inflationary for Europe, there's more room potentially for policymakers to ease monetary policy as well in Europe. So there are some things that help, but honestly, Europe being a large open economy is going to be hit by these global trade concerns. The other thing, of course, is European currencies have been stronger recently, and that hits European earnings too, and there are a lot of dollar earnings for European companies.
Well, to that point, if you're a market participant, you can react day to day to the headlines. You can react to whether it seems like the White House is negotiating or whether they're escalating. But if you're a company, Sharon, you need to make CapEx decisions that span over years. So what are the scars of the uncertainty of this moment and companies' willingness to commit to CapEx and to hold on to employees?
Yeah, absolutely. I mean, this is what causes, in some ways, your recession, a lack of investment. The uncertainty, I would say, is more powerful than the tariffs themselves, because you'll get lower employment. You'll also get lower investment too. But I think there's also an additional rinky-dink, as it were, to this for Europe. Europe has spent the last 10, 15 years pivoting towards the US and investing in the US, and both sort of investors have done that, buying the Mag 7, buying the US stock market, etc. But also corporates have done that, moving more of their assets to the US. But is that more questionable now, particularly if the dollar is weaker, particularly if there's lots of uncertainty about who you wish to trade with, etc. So I think that uncertainty is very high, and where Europe should wish to pivot to is also uncertain as well.
Yeah, that weaker dollar dynamic, really fascinating, brings to question as whether we're in peak U.S. asset ownership. Sharon, thank you so much for joining us. I know you have lots going on today, so we'll let you get back to it. Sharon Bell of Goldman Sachs. You're watching Bloomberg Brief.
in case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and forget it.
You need to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s.
Don't miss Open Interest live weekdays.
The reciprocal tariffs have arrived, and I gotta say, just looking at markets themselves in the U.S., you would almost think it's calm. U.S. futures are higher. The 10-year yield is now just up 4 basis points, but at one point we had a 30-year yield hit 5% in flips between gains and losses for the S&P 500. George Servais of Deutsche Bank calling it a loss of U.S. dollar confidence as the dollar weakens. Let's take a look at what's happening under the surface with some stocks to watch. Here's Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So keep an eye on the pharmaceutical stocks today after big losses in the European peers as Trump threatens potentially huge tariffs on the sector. And while it's unclear how this would affect the US names, we are seeing the likes of Pfizer lower on the pre-market. Then I'm also watching the Mag 7 with Apple leading gains after an upgrade at Jefferies that says while iPhone shipments are set to decline, a 30% slump for their stock year to date is well and truly overdone. And finally, Peabody Energy soaring in the pre-market as Trump signs an executive order expanding the use of coal in the United States. And also just a usual shout out for our Before the Bell opening wrap, running you through these and more on the terminal now.
An especially important day to take a look at that. Joe, thank you so much. Bloomberg's Joe Easton. Now let's get you some front page news, a look at what's making headlines around the world. It is all tariffs across the front pages. The New York Times leading with the U.S. implementing punishing tariffs on trade partners. The administration signaling that the White House was ready to negotiate deals, though, saying 70 governments have reached out so far. Wall Street Journal, they are reporting that Trump's tariffs put the Fed chair in a no-win situation. Levies pushing the economy towards a possible recession while simultaneously pushing up the price of goods. Jerome Powell and the FOMC caught between opposing arguments to either cut or hike rates in the near future. And a quick look at the FT leading with companies rushing to promise new factories in the U.S. being threatened by Trump's tariff chaos. Coming up, we get back to the conversation about bond markets. JP Morgan's Priya Misra joins us next.
estate. Which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco. And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. Our lives are migrating online, and I think these data centers are a critical part of that infrastructure. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Trump's tariffs take effect. Levies hit an 100-year high. Import taxes arrive for dozens of U.S. trading partners and an 104% tariff on China. Market dysfunction. Global bond markets convulse, sending 30-year yields in the U.S. soaring, at one point touching as high as 5%. And China holds fire on immediate retaliation that allows yuan to sink to a record low. Beijing plans its next moves. So reciprocal tariffs have arrived, and this is when the orderly market sell-off starts to look disorderly. Look at the 30-year yield at one point touching 5%, at one point logging the biggest sell-off since 1982. It's the kind of moves caused by forced liquidation of leveraged trades being unwound, but it's a foundational part of this market, and it has global repercussions. Japan's 40-year yield at one point rising to the highest since it debuted in 2007. In the UK, you're looking at 30-year yields at one point rising 16 basis points to the highest since 1998. Your 10-year yield up 6 basis points. With all of that, you think it would look really ugly in risk assets. Look at what U.S. futures are doing. They are gaining. The NASDAQ 100 is up 0.5%, but make no mistake, they've been flipping between gains and losses with other risk assets from Europe to oil falling. Oil down 3% this morning. So about 60 nations have been hit with levies. Starting today, U.S. tariffs are now the highest since 1909. President Trump spoke at the National Republican Congressional Committee dinner on the eve of tariff implementation.
And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say.
Back with us is Bloomberg's Tyler Kendall in Washington, D.C. So, Tyler, what sort of tariffs is the world waking up to this morning?
Yeah, hey, Danny. Well, the highest tariffs in more than a century when it comes to what the U.S. has imposed. And, of course, the big question remaining is what is it going to take to bring those tariff barriers now back down as countries come and start calling President Trump. Delegations are arriving in Washington trying to strike a deal. One thing that has become increasingly clear, it's going to take more than just eliminating trade barriers, eliminating tariff barriers, pledging to eliminate those trade surpluses these countries run, because that's exactly what we've heard heard from some already, like Vietnam and Israel, who don't appear to be on the verge of any sort of deal. In fact, that's why we're really going to be watching what sort of non-tariff barriers start to make their way into the conversation in a more serious way. Danny, yesterday, the USTR Jamison Greer was testifying on Capitol Hill, quite a time for this pre-scheduled hearing to happen. And he's told lawmakers that the U.S.'s message to countries that have other ways to achieve reciprocity is that the government wants to hear from them, indicating to us that some of these deals could get a little creative, as President Trump says that they're all going to be tailor-made, not off the rack in his words. But importantly, Bloomberg News reporting, per sources familiar, as of now, it doesn't appear that there is a formal established system for companies and countries alike to formally register their complaints with the USTR, Commerce, the Commerce Department, the NEC, and that's only further complicating matters as these countries try to get their phone calls taken by the White House.
And it's not just country-level tariffs. We also heard from Trump talking about measures on coal, talking about measures on pharmaceuticals. What industry type of tariffs might we be getting soon, Tyler?
Yeah, well, yesterday, President Trump pledged that those pharmaceutical tariffs would be coming very soon. This is something that he has long talked about, including on the campaign trail, that pharmaceuticals was something that he is going to look at. And we know that that's going to definitely sound some alarms for our European Union allies. Other than that, President Trump has, of course, also pledged copper is going to be a key one here. And our Bloomberg News reporting that those tariffs could come sooner than expected. And then, of course, chips. Chips is going to be a big one moving forward, as well as this administration really tries to prioritize creating a more domestic supply chain when it comes to chips. It's been really interesting to watch how this White House really has taken more of a stick versus carrot approach when it comes to chip makers, with President Trump saying he prefers his tariff plan over the Chips and Science Act.
Tyler, thank you so much for your excellent reporting this morning. That is Tyler Kendall in Washington, D.C. Now, I mentioned that global bond markets have been under pressure. We've seen that in the U.K. with the 30-year yield rising to the highest since 1998. The BOE's Financial Committee meeting on April 4th and April 8th, we were getting some readouts from that saying that the risk of further sharp corrections remains high, that they are ready to raise or lower capital buffers if needed, and that the trade shift could harm stability by depressing growth. There's certainly concern of dysfunction this morning. I'm pleased to say that Priya Misra joins us now, portfolio manager at JP Morgan Asset Management. Priya, what a day for us to take you away from your desk. First of all, thank you so much for joining. Are we at those levels of dysfunction of policymakers needing to step into this bond market?
So we're certainly seeing this classic war shock. I mean, we've been seeing it in equities. Now we're seeing it in the bond market. So there is certainly market dysfunction. I would say with the bond market in the last couple of days, I think there's a couple of things going on. You know, people have to de-risk. And so if I've had trades on that have made money, sometimes you sell what you can, not what you want to. So I think that's happening. There's de-risking. There's a need for liquidity as margin calls are being hit. And then there's concern that the rest of the world owns a lot of treasuries. I mean, our estimate, about $8.5 trillion of treasuries are held by the rest of the world. If trade deficits, if the objective of tariffs, and it's not clear what the objective of tariffs is it to lower trade barriers? Is it to take the trade deficit to zero? But in that scenario, if trade deficits are zero, the rest of the world doesn't need to hold treasuries, doesn't need to hold dollar assets. And so is that $8.5 trillion being liquidated? I mean, I think it's too early to say whether that's happening, but I think the concern of that is what's letting rates rise. But I think there's an opportunity here. You know, this is a nightmare for corporates. This is a nightmare for consumers because inflation's going up. It's a nightmare for corporates. Your profit margins are being impacted. You know, costs are going up. Demand's going to get hurt. Funding costs are going up. And so I think a recession, I mean, we've been worried about uncertainty. Now you've got tariffs. You've got the DOGE-related government cuts. And so if we're heading into a recession, you talked about, I think, is there a policy response? Is there an off-ramp? Yeah. I don't know if it's here, but you're likely to see the economic hard data, which has been very resilient so far. That's going to start to weaken. I think that's when the Fed steps in. Now, they can probably cut rates. I'm not sure that helps. There's lags. If you do see the credit market seizing up, I think then you can see something else. That's what the Fed has focused on in the past. Credit markets have been remarkably resilient. Yeah. I mean, they are widening. Credit spreads should be wider as the probability of outcomes, you know, or the distribution of outcomes starts to widen. But we're still seeing the lower quality credit underperform the higher quality credit. That starts to shift and you start to see big outflows. I think then you're talking about the Fed coming in potentially with a policy put, in terms of facility, etc. But we're not there yet. I think we're still trying. This has all happened so fast that I think first markets adjust and then the policymakers have to do something.
I mean, we're kind of in the land of economic textbooks, right? About these theories of what's going to happen and watching it play out. If we are in this world where there is less demand for U.S. dollar assets, where trade deficits are shrinking, where you don't have as much U.S. dollars abroad, how big of a paradigm shift is that? Because you can make the argument that that's what has supported valuations to the point where they are, that you have more U.S. dollars abroad buying U.S. assets. Are we talking about a complete reordering of financial markets too?
So the U.S. exceptionalism, I think there's structural components of the U.S. exceptionalism, which I think that might be a step too far. The, U.S. innovation, technology, large, deep capital markets. I think that is here, but there's a cyclical component, and I think that is what is being shaken out right now. It's a highly owned position, U.S. assets. U.S. assets had outperformed the rest of the world. The correlation between equities and the dollar, that's broken down. Now you're seeing the correlation between bonds and stocks breaking down. So I do think it's a big, to your point, I mean, if that's being unwound, I think that's bad for U.S. assets. But then you look at U.S. investors, and that's when you take a step back. U.S. investors have owned a lot of equities, and I think have under-owned fixed income. So at some point, we'll have to start focusing on how do people think about their total asset allocation. And if you're in, I would say intermediate, maybe you stay away from the very long end, because that's a lot of duration risk. But the 0 to 5 year sector of the fixed income market is driven by the Fed. And I think what I struggle with is in all these moves, the end point of Fed rate cuts that the market's pricing in is about 3%. That's neutral. I think if we're talking about a slowdown, recession, the Fed's cutting a lot more. So that front end to me still seems safe. I know we have auctions and there's concern around, this sort of deleveraging can continue. But I think to the extent you can start legging into some short-dated corporates which are levered to this, is the Fed going to cut? I think at some point the Fed's going to look at inflation and then look at growth and say this inflation is supply driven, the demand side is not there, and they're going to have to cut, and they're going to have to cut a lot more than that 3% that's priced.
Do we just end up in QE to affinity? Is that where all this ends, Priya?
I think if the Fed takes rates to zero in a recession, if they go all the way down to zero, I think QE is the next step. I do think what they can do is they can start cutting rates, and if they need to do some, we're sort of reliving a little bit of COVID here. And what we saw during that COVID policy response was they did the monetary policy side, then they did other facilities. I think that might happen, along with the rate cuts. But for QE, I think the Fed funds rate has to be zero. We're very far from, we're at 4.5. So we first have to price in Fed funds getting to zero, and then QE might be the next step, especially if the rest of the world is not buying treasuries.
I got to say, the Fed is not sounding like that at all. I mean, you have Austin Goolsbee in the middle of a market meltdown saying we're worried about inflation expectations becoming unanchored. Is this a Fed that's become extremely reactionary and is only going to be cutting when it sees the labor market crack, when it sees the white of the eyes of the recession?
I think it's going to be hard for them to be preemptive. Absolutely. They've got a dual mandate. Inflation's already above their target. And everything we're hearing from the policy side is likely to make inflation higher. So they have to wait for the data. The data has been very resilient. But that almost tells me that the later they start, the more they'll have to go. Because, then they know that policy works with a lag. So the later they start, if the unemployment rate's already at 4.5 and they're starting to cut, we know the Powell Fed is not shy. They started a little late in terms of the hiking cycle. They went in 75 increments, basis point increments. So I think the easing cycle, when it starts, will be aggressive, because at that point they've seen the cracks in the labor market, and they're having to push back against the inflation, which is still above their target. So I think they will probably start late, but then go aggressive.
I just want to end where we started and just get the final word from you on what we're seeing in this bond market. I mean, the U.S. bond market, it is a foundational part of this financial system. Seeing some of these trades be unwound, the fire sale, at what point do you get worried about cracks in that foundation and the ramifications of it?
So I think some of this is classic flight to quality. We're seeing the difference in, between the off the run and the on the run bonds. It's still not, it's showing you signs of stress. I don't think it's at the point where we need the Fed to jump in. If credit spreads widen to the point where companies can't issue, they can't refinance their debt, I think that's when the Fed is going to say that the credit transmission mechanism is broken. I mean, right now, I think if you can be in short-dated sort of treasuries, I think that's sort of much safer. The long end of the curve is sort of a different animal. I think that's where risks are very high, particularly because the rest of the world owns a lot of treasuries.
Yeah, we're seeing that happen in real time. 30-year yields now up only 5 basis points at one point at 5%. Priya, thank you so much for joining this morning. We really appreciate it, especially on a morning like this. That is Priya Misra of JP Morgan Asset Management. Coming up, pharma next in the firing line. President Trump says that major tariffs are coming soon to the sector. We're going to have more on that next.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never. Ready? Go.
The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg.
We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals.
President Trump last night speaking at the NRCC dinner talking about pharmaceuticals next in line for major tariffs. Joining us now is Sam Fazeli, who leads pharmaceutical coverage for Bloomberg Intelligence. Sam, do we have any idea of what kind of pharmaceutical sectoral tariffs we might be seeing?
Yes, hi, Danny. So we don't know, but it's probably going to be along the same sort of lines that we've seen with other tariffs that the administration has put in place. And of course, you have two types of things. You've got products that are finished or almost finished in terms of the put in a vial or whatever in another country and then shipped to the US. And you've also got the active ingredients, which are the ones that are more likely to come from countries like China, where they are used for manufacturing within the US. And that would probably be much more of an impact on the cheaper generic drugs than it is on the more expensive and modern branded drugs.
The goal of this, as we heard from the president there, bring pharmaceuticals to the U.S. Sam, what would a process like that look like? And would companies even be willing to do something like that when it is just such an uncertain environment right now?
Yeah, so Danny, I think some of the manufacturing can be moved relatively, I don't want to say easily, because nothing is easy in this world of complicated inter-country products and supply chains, but relatively easily, and some would be much more complicated. And at the end of the day, not everything that you use in a pharmaceutical is going to be able to be manufactured within the US. And probably 1, 2, 3 years' time. A lot of pharma companies have already announced expansion of manufacturing within the US, Eli Lilly being an example, Novo Nordisk being another one, partly because they want to have their product near where the demand is. But the problem I have with this, Danny, if I may, is that we're also, the administration is also talking about penalizing companies on price. They've been talking about things like favored nation pricing. You can't entice them to come saying we're the biggest market in the world and then shrink that market to a point that doesn't make any sense. So there's a bit of a incongruence there.
Makes complete sense, Sam, and it's a lot for these companies to grapple with and a lot of decisions that need to be made. We're going to start to hear from some of them in earnings at the end of this month and early May. What in the world are they going to say?
Yeah, so given what we heard from the president last night, we were expecting, I'm assuming, some numbers on the in terms of tariffs today, tomorrow, or that sort of timescale, I suppose. The thing that they need to tell us is what happens to their complicated supply chain work, particularly their work by taking intellectual property into a country where the tax base is low, take Ireland as an example, manufacturing there, transferring it with transfer pricing at much higher level to the US. So you end up paying your tax on that profit in a lower tax country, and therefore you make much lower tax in the US as you bring the product in at a higher price. So that's where I think the companies need to start, at the very least, giving indications as to where their tax is likely to go once they know how that transfer of manufacturing to the US is going to work.
Sam, really great to get your expert voice and opinion this morning. Bloomberg Intelligence's Sam Fazeli. Now, I mentioned earnings for the pharma sector, but we have earnings coming this morning. It is from Delta, one of the first major ones and major airlines to report since we've had tariffs put in place, since we've seen the market turmoil. Pleased to say that joining us in studio here in New York is Bloomberg's Sid Phillips. I mean, Sid, March we got a profit warning, even before we had tariffs. What are they going to say today?
That's the billion-dollar question. Everyone's looking to see what the airline industry is talking about, especially as sort of fares moderate, because remember, the demand that had sort of creeped up since the pandemic, the sort of boom in demand, a lot of that was led by leisure passengers. And if people aren't feeling sort of confident about spending, they might push back, and especially on premium sectors where they were paying for business class and premium economy, they might sort of start cutting back on that spend. So we're looking to see what the airline really talks about and how they sort of go and how they navigate from here. I mean, will they start pushing sort of lower fares in order to fill up planes, because there is likely overcapacity given the fact that the airlines were expecting a bumper summer and sort of run up into summer. And so we're looking for any sort of commentary on what the airlines really are, what Delta is going to talk about in terms of what their outlook looks like, what their fare outlook looks like, especially with costs potentially rising and because of inflation.
I mean, the whiplash is really incredible, right? That you get airlines saying we're going to do well, maybe we won't, maybe demand's lower, and now tariffs. There've been kind of this story bubbling, Sid, and is there any credence to it, this idea that international travelers want to come to the U.S. less?
I mean, we are seeing it on some sectors. I mean, Canada most famously is sort of, we've seen a demand drop on flights from the U.S. to Canada. So we are looking to see what that impact will be, because, I mean, there's also been the crackdown on the border with several countries talking about how it's not a good idea to, or they sort of putting travel advisories on the U.S. And so that might actually also have some impact on people wanting to come and spend money and time and holiday in the U.S.
There's also this fear of supply chains. Over the weekend, Reuters reporting that Howmet, which gives supplies, gives crucial parts to various to Boeing, to the likes of Airbus, that they're declaring force majeure because of tariffs. Are we going to head towards another supply shock when it comes to airlines, when it comes to this industry in aerospace? Is that an inevitability if these tariffs stay on as they are?
It is. I mean, for the aviation industry, I mean, supplies come from all around the world. I mean, the parts that sort of go into a plane that's made by Boeing or Airbus come from suppliers all around the world. And for 45 years, the airline industry has virtually had sort of zero tariffs on aircraft and aircraft parts. And now we're sort of going into a regime where there are tariffs, and then there are different tariffs for different places. And so we're looking to see what that impact will be on the supply chain, whether suppliers will be able to supply parts, will they have to look for alternative suppliers. You can't just find an alternative supplier overnight. It takes years and years, and you need certification of those parts. And so it's going to be a very, very complicated orchestra for the airline and the aircraft industry to try and navigate.
Again, this gets back kind of to the question we were talking about pharmaceuticals with Sam Frizzelli. How do these companies commit to plans? How do they commit to plane orders when there is so much uncertainty? Is this a moment of almost a freezing of the industry when it comes to big decisions?
I mean, the aviation industry has seen big shocks. I mean, the pandemic being the sort of most recent example, and when demand came rushing back. And so, I mean, everyone's waiting to see what the actual impact is before they can sort of take decisions on whether or not they can actually get those parts, whether or not there's any demand on aircraft purchases, whether there's any sort of drop in flying. So, I mean, everyone's looking to see what that scenario looks like and take it from there, essentially.
It's going to be interesting to hear what they report again, Delta earnings before the bell this morning. Sid, thank you so much for joining us, Bloomberg's Sid Phillips. All right, let's get to some other top stories that are trending on the terminal this morning. Ray Dalio is warning that investors aren't paying enough attention to a once-in-a-lifetime breakdown in the geopolitical and monetary order. The billionaire Bridgewater founder blames these underlying conditions for leading to the tariff disruption that has been dominating market action. He says bigger disruptions are still likely to come. The largest seller of eggs in the U.S. reported a 247% surge in profits in the last quarter, prices rising to a record high in that time period. Mississippi-based Cal-Maine Foods also acknowledged it had been contacted by U.S. authorities investigating price fixing. The ongoing avian flu outbreak forced farmers to cull some 30 million birds so far this year. And demand for used Rolex watches is on the rise. The price of the precious metal has risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces climbing the most places up since the index was launched in 2022. Well, what a day it has already been, and it is only 5:55 a.m. this morning, so let's get you set up for the rest of your day. As we're talking about with Sid, we are going to be getting Delta earnings before the bell. Plus, Richmond Fed President Tom Barkin will be speaking at 12:30 p.m. Eastern. What will he say? Is the Fed willing to step in to stem some of the pain in this bond and funding market? Then we're also going to get Fed minutes. Those come from the March meeting out at 2 p.m. Let's quickly get through some stocks this morning that are moving. Starbucks rising, Jefferies upgrading it to a hold, saying that there's limited near-time downside potential. It did drop 29% since its Feb high. Constellation Energy also up 2.7% in the pre-market. Citi raising the stock to a buy. Peabody Energy also extending double-digit gains as President Trump signed an executive order to expand the use of mining and coal in the U.S. All right, some breaking news coming from Germany this morning. Merz has sealed the deal to form a government, a German government. It will be formed with the Social Democrats, coming at a crucial time for Germany from Europe, with tariffs being put on. What kind of spending will Germany be able to do, especially with bond markets looking as they do this morning? Is the fiscal headspace starting to run out for European governments? A question we have to ask as the move in bonds starting in the U.S. seeps into the rest of the market. German 30-year yields not doing a lot this morning. It is really on the front end of the German curve. We have moves. Meanwhile, you are looking at Japanese bond yields. At one point, the 40-year yield rising the most since that measure was implemented, that instrument was implemented, 18 basis points. Your 30-year yield up 7 basis points at one point this morning, touching 5%. Well, that is it for your Bloomberg Brief. Surveillance will track the market moves from here. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Most market participants are not expecting tariffs to last longer than a couple of months.
There are some longer-term positives if we can potentially negotiate some with these tariffs.
The one clear conclusion from Paris is that they are U.S. growth negative.
All these things really aren't sustainable in the long term.
If the full expected tariffs come through, that would likely trigger a recession.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience of worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, entering a whole new world.
The tariffs are on, and the money is pouring in at a level that we've never seen before. And
It's going to be great for us. It's going to be great for other countries. We've been ripped off and abused by countries for many years.
Major tariffs begin across Europe and Asia. The president pushing forward with monster levies on China, sending equities to the biggest four-day slide in more than 5 years, and the bond market offering no place to hide. As the White House keeps the pressure on, the Federal Reserve is not stepping in. One Fed official suggesting policy is in a good place. Is corporate America in a good place? This hour, earnings season begins. Numbers from Delta Airlines are just around the corner. Those numbers about 30 minutes from now.
So how does a company give some sort of forward look at a time of incredible uncertainty across the board, whether it's consumers or corporations? What we heard from Levi's yesterday was a dissonant-seeming level of certainty with the reaffirmation of their guidance, saying that tariffs would be surgical, but saying that they had a task force looking forward to what the consumer demand picture would look like. Will Delta have the same approach, or have they gotten already some different guidance from at least consumer purchases?
They need more than a task force right now, that's for sure. This market, the pendulum keeps swinging between deal hopes and tariff threats. The underlying trend, though, is clear. The tariffs keep going up.
The tariffs keep going up, and the tariffs are in place as of today on some 60 trading partners with the United States. Most importantly, the tariff on China, cumulatives, what we have seen in Trump 2.0, is now at 104%. But Jonathan, you nailed it on the head. The pendulum is swinging. Yesterday morning, some hope, glimmers of hope to the market coming out. Talks of phone calls with South Korea, talks of the president welcoming these calls to negotiate. And then by the end of the evening, what did we hear from the president of Washington, D.C.? The tariffs are coming into place, and there will be more. This time, he's looking at pharmaceuticals.
So in the markets, these are the scores. Since April 2nd, the S&P 500 down around 12%. What's the bond market done? The bond market, the 10-year yield is higher by 20 basis points plus over that period. That's where the pain is right now.
This is a bond market that's losing faith in the influence and power of Scott Bessent, the Treasury Secretary, who is supposed to be the reasonable voice in the room and who is prioritizing the 10-year yield as a metric of success. I would argue that the two most important events this morning and the rest of this day, aside from whatever we might hear in Washington, D.C., number one, Delta earnings. Number two, a $39 billion auction of 10-year notes at 1 p.m. today. Yesterday, a 3-year auction, normally very boring, was not boring. It was not good. It did not come in a well-ordered fashion where primary dealers had to take down a disproportionate amount. What happens with longer duration at a time when you see surging yields on the long end?
Bond yields up across the curve this morning, at the front end up by 6, on 10s up by 8. Your 10-year just short of 440. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley following another wild day in financial markets. Matt Gherkin of BCA Research on the highest U.S. tariffs in more than a century. And Alexander Jekoff of BNP Paribas as we wait for China's response. We begin this hour with stocks looking to snap a 4-day losing streak as major tariffs begin. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we've started every single show for the past week by saying, are these the rules of the game or can you negotiate? And the message coming from the White House seems to be it's both.
Yeah, good morning, John. Well, exactly right. The White House appears to be walking the line between negotiation and escalation. These are the highest tariffs in more than a century that the U.S. has imposed, but of course they're higher for others compared to some of our trading partners that have reached out to President Trump. Take China, for example, of course, as you've been talking about, 104% levy that went into place at midnight. But importantly, President Trump yesterday said that he was waiting for Beijing's call. It appears that the White House is really welcoming the outreach from other trading partners as they all try to figure out exactly what they need to do to strike a deal. One thing that is becoming increasingly clear, as we've been talking about, it's going to take more than just eliminating tariff barriers. That's why we're going to be watching closely how those non-tariff barriers, this White House talks about so much, make their way into the conversation in perhaps a more meaningful way. For example, USTR Jamison Greer on Capitol Hill yesterday telling lawmakers that the U.S.'s message to other countries is if they have a different way to achieve reciprocity, then they want to hear from them. That tracks with what President Trump has been saying, which is that he's looking to make tailor-made deals, not off the rack, in his words. And John, of course, we are laser focused on these so-called reciprocal tariffs, but we'd be remiss if we didn't mention that this White House really does appear undaunted, particularly by the market's reaction. President Trump yesterday pledging that sector-specific tariffs are still coming. He says next up are pharmaceuticals.
Tyler Kendall with the latest down in Washington, D.C. More from Tyler later on this morning. Tyler mentioning Jamison Greer on on Capitol Hill. The U.S. Trade Representative taking some heat yesterday.
Took some heat, not just from the Democrats, which is what was so interesting. You had the likes of Senator Ron Johnson coming out and saying, I don't normally agree with the other side of the aisle with you sitting here, Mr. Greer, but I do today because I am worried that potentially this is going to hit small businesses and you can have bankruptcies, and other Republicans talking about the fact that they're worried about inflation and the consumer, and said, I hope you're right.
So what should investors do? Andrew Sheets of Morgan Stanley seeing downside risk to growth, upside risk to inflation, and writing the following: we see no Fed cuts this year in our base case. The probability of recession in the US and Europe has moved higher. Andrew joins us now for more. Andrew, welcome to the program. We'll focus on corporate credit with you. That's what you focus on. Can we just start with, though, these moves in the bond market? Andrew, what is driving Treasury yields higher and not lower?
Yeah, thanks. Good morning. It's great to be here with you. So I think at this point, it's uncertainty. And I think there are a lot of competing theories, and that's everything from a lack of foreign demand to these large budget resolutions that you see coming out of the U.S. House and Senate, and to just the fact that there's a lot of volatility. And I think investors everywhere are trying to get exposures down. But I think as you open the program, I think that's exactly the right focus and what investors have on their mind. There's a lot of uncertainty. There are a lot of competing narratives for what the administration is trying to accomplish. A number of those goals seem to be kind of at odds with each other. And I think investors are also very uncertain around the timeline. Again, I think there's two very different competing narratives of what the goal is here. One is a negotiation tactic, which by implication is temporary, but there's also this idea that, well, if it's temporary, you're not going to get the type of reshoring, the type of big structural change that the administration's also talking about. And so, you know, these goals being in tension and no sign of resolution, I think, is causing investors to step back. And, you know, long-dated treasuries are very volatile assets, and that's a place that maybe is one reason why you're seeing more underperformance there.
Long-term treasuries are a very volatile asset. Let's just sit on that for a second. This is not the way it has been traditionally. This has been a haven, a place of reprieve during times of turmoil. There are many huge sweeping narratives that people are coming out in terms of seismic shifts in the global order. I want to be more specific. How much of what you're seeing in bond markets in the United States, and I'm talking about treasuries as well as investment-grade corporate credit, is being driven by foreign selling versus basis trades being unwound in a sell what you can, not what you want kind of dynamic?
Yeah, I think at the moment it's, again, I think kind of hard to say or too soon to say. I think there's certainly a reduction of foreign demand. And I think that would not necessarily even, you know, you have to classify that as selling. I think that's, you know, a broader function of there's greater uncertainty around the U.S. You know, you have banks, including our own, ourselves at Morgan Stanley, don't think the Fed is going to cut rates as much as the market expects. That's a challenge to bond markets, or that can be a challenge to bond markets. But also more broadly, right, if we are talking about reducing the trade deficit that the U.S. has with other countries, axiomatically, that means less demand from those countries for U.S. financial assets. That's just kind of the economic math. And so, you know, again, I think there are a couple of different channels and a couple of different explanations that can be going on here. I think it's difficult, or I don't think it's helpful to kind of try to fix. I think what we can see it as a broader pattern. And unfortunately, I think a pattern you see during bear markets where investors are selling what they can. They're selling what is still up, and kind of treasury bond prices are still up. Bond prices are still up. And they're trying to get overall exposures down. And I think that, you know, kind of factors across a number of different markets, including credit markets, of what we're seeing.
If the Fed were to cut rates, would that help the issue or would that hurt the issue?
So I think that's a great question, because I don't think Fed cuts are necessarily the help that you know, the investors might be hoping for. So one is, you know, in what conditions would the Fed cut? Well, if we have a fantastic CPI number this week, and if we have you know, very good inflation readings in the Fed cuts, I think the market would like that. But if we saw very bad data and the Fed is cutting, I mean, I think if you go back through history and you have a scenario where the Fed is cutting and cutting a reasonable amount with bad data, those are usually markets where you want to be selling into those markets, not buying. That's usually a sign that the economy is weakening, and Fed cuts are somewhat lagging that weakness. There's also, I think, a real question of, you know, can Fed cuts really address this issue? I think the market is looking for the Fed to intervene here. But if the issue is trade uncertainty, does a 25 basis point cut offset, 104% tariffs on China for a business? That's unclear. And also the fact that these tariffs can change very quickly is a further challenge to the Fed. And I think a reason why we think, again, they'll be more measured and they have a dual mandate. They're currently doing much better on the jobs part of their mandate than the inflation part of their mandate. And so we think at Morgan Stanley, that's a reason why they are going to stay on hold under our base case and ultimately, ease somewhat less than the market's expecting.
Andrew, if we're having great difficulty pricing the risk-free asset, what does it mean for everything else? How difficult is it right now to price credit?
So I do think it's, it is a challenge, but I do think it's interesting that credit is a real follower here. And I do think the credit market gets a reputation, maybe well-earned, of being this leading indicator, of being this canary in the coal mine. But I think what's really notable about this sell-off has been that credit was relatively slow to react to it. And I think for good reasons. I think the micro dynamics in the credit market were not really the problem in this cycle. You didn't have excessive loan growth. Balance sheets were in pretty good shape. You didn't have excessive levels of M&A activity. So, credit has not been at the leading edge. I think the credit market is very much following what's happening at other markets. But I do think you have this broader issue that if we think about an environment where growth is weakening, where the Fed might not react as quickly as the market hopes, where there's trade uncertainty, I could say that has a number of echoes to the fourth quarter of 2018, where Trump was president, where Jay Powell was chair of the Federal Reserve. And valuations in credit are still well short of the wides that we hit during the fourth quarter of 2018. And that was ultimately an environment where there was no recession. And that was an environment where a lot of the inflation readings were lower than today. So again, I think we're looking for various kind of waypoints or anchoring points that we can use in valuations in this uncertain period. We do think the fourth quarter of 18 is an interesting one, a useful one, but unfortunately we're not there yet.
Andrew, appreciate your time. Thank you, sir. Andrew Sheets there of Morgan Stanley. We all remember that December. High yield spreads gapped out really wide, just like that bank. And what we saw from the issuers is they were all pushed to the sideline, and that unnerved the Federal Reserve. You mentioned the 10-year issue coming from the Treasury a little bit later. Never mind corporate issuers. It's sovereign issuers that is the focus this time around.
Especially because primary dealers had to take down the greatest amount of 3-year debt sold yesterday, going back more than a year. Again, a real plain vanilla, non-controversial issuance. Look, there is a real question of volatility in the benchmark bond, what that does going forward, why that is happening. Nonetheless, there is a real question about what the Fed can do to really stave that off, given that there are inflation concerns that we're not in the boat when we talked about what happened in 2018.
Rate cuts can't produce Chinese exports.
Rate cuts can't control the long end right now at a time where 2-year inflation expectations are rising.
Bond yields are up right now by 8 or 9 basis points across the curve. The 10-year at the moment just short of 440. Equities are settling down. On the S&P 500, we are negative by about 0.4%. But the kind of price action you've seen over the past few days, consistent with the kind of price action you see in bear markets. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump's reciprocal tariffs are in effect, including 20% levies against the EU and a historic 104% tariff on China. That follows a 10% baseline tariffs for most U.S. trading partners that took effect on Sunday. So far, Asian countries, including Cambodia and Vietnam, bearing the brunt of the measures. China's top leaders reportedly plan to meet as soon as today to discuss measures to boost the economy and stabilize capital markets. China did not immediately respond to the new U.S. tariffs, unlike the last 2 episodes, when Beijing retaliated within minutes. Elon Musk attacking White House Trade Counsel Peter Navarro as President Trump's tariffs roll out. Musk calling Navarro, quote, truly a moron and dumber than a sack of bricks in a series of ex-posts as a spat between the two continues. Navarro going on to say Elon is a car assembler. He's a car person. That's what he does. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later this hour. Up next on the program, upending global trade.
I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. They've ripped us off left and right. But now it's our turn to do the ripping.
The market moves have been legendary. Matt Gerken of BCA Research joins us next, live from New York City this morning. Good morning.
the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
A close below 5K on the S&P 500 for the first time since April 2024. Equity futures this morning continue to decline. We're down by 0.5% on the S&P. Later this hour, earnings season begins with Delta Airlines. Delta, since April 2nd, down 17%, and so far this year, lower by 41%. This morning, we're down by 1.5%. Those numbers drop in the next 20 minutes or so. Under surveillance this morning, upending global trade.
I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say. We're making a fortune with tariffs. $2 billion a day. Do you believe it? They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
So here's the latest this morning. President Trump's so-called reciprocal tariffs taking effect. The move raising tariffs to their highest level in more than a century. Levies pushed to 104% on China and 20% on the EU. Bloomberg's Ollie Crook joins us now from Brussels for more. Ollie, we're waiting for China's response. What's Europe's?
Yeah, we're going to get a response from the Europeans a little bit later today. But mind you, John, this is not a response to the tariffs that were imposed today, the 20% on European goods. This is in response to the aluminum and steel tariffs that we got a couple of weeks ago. And what we are expecting is a fairly narrow response from the EU. Remember, they want to keep as much runway open to have these negotiations with Donald Trump. It's going to focus on a number of different goods from the United States, some agriculture, some poultry, boats, motorcycles, those sorts of things, but only about $20 billion worth of goods. We should say this is a $1 trillion trading relationship. And when we think about the trade that happened last year, the EU was the biggest exporter to the United States to the tune of about 500 billion euros. You take 20% of that, that's 100 billion euros that today is trying to find out who is going to pay for it. It's going to be some of the producers here in Europe. It's going to be some of the consumers over in the United States. And as far as the Europeans are concerned, next week is when they will begin to get the architecture of how they could potentially respond to these 20% tariffs. This is where we get into the conversation about possible taxes to the tech firms of the United States, possible taxes on services, maybe regulations. But again, at the end of the day, the Europeans do not want to impose any tariffs. They want to negotiate a solution. And potentially Giorgia Meloni, who heads to the White House next week, will begin to try to get some information from Donald Trump for what the United States wants. We should also say, though, John, at the same time, we have Pedro Sanchez, the Prime Minister of Spain, who's on his way to Beijing. He will arrive on Friday, and he is talking about getting the relationship closer from the EU to the Chinese in response to the instability and the sort of unstable partnership to the United States. So the politics also very active here, John.
Ollie Crook, thank you, sir. Bloomberg's Ollie Crook there. Breaking down the negotiations versus the prospect of retaliation in Europe. We're breaking down the commodity market as well. Brent crude at the moment down by close to 5%. It's a break of 60 for the first time since 2021. Brent crude at the moment 59.87. The supply side response is in focus too. OPEC Plus bringing more crude online. But it's the demand side story here, Anne-Marie, that catches the eye.
Absolutely. If trade is breaking down, then those particles, oil used for trade, also going to break down, on top of the fact that you did have Saudi Arabia and OPEC Plus come out, not just say we're going to put more barrels on the market, but adding even more than they were subject to. I will have to say, though, this is probably a headline, Jonathan, that Donald Trump is going to tout and say, look, as I told you, oil prices are down, which means gasoline prices will come down.
I'm not sure crude's down for good reasons, but yes, they might talk about this headline. We're down 5% on WTI, 56.59. Joining us now to talk about negotiations and the prospect of retaliation, Matt Gerken of BCA Research. Matt, welcome to the programme, sir. We're waiting for the response from China. What do you anticipate happens next?
Hi, well, thank you. It's great to be with you. You know, I think the main thing that's going on here is that the United States is recognizing, and the Trump administration will be forced to recognize by the financial markets and the risk of inducing a recession, that the U.S. cannot wage a trade war against the rest of the world all at the same time. It's bad strategy. It will induce a recession, and so it'll destroy the Republican Party in the midterm elections. That means the administration will have to backpedal on particularly finding small countries and then major allies that are willing to negotiate quickly, and then they can give them exemptions and exceptions to the tariff implementation. But meanwhile, they will maintain a pretty tough line with China, and we're seeing that. And China has been willing and ready to embrace this trade fight because China is also looking to divorce its economy from the American. And that's probably primarily because of strategic reasons.
Matt, this 104% tariff on Chinese goods, does this basically end, especially for small goods, trade between the U.S. and China?
Well, in a way it does, but the thing is that, of course, it can still be negotiated. Now, obviously, the odds of a phase 2 trade deal are low and falling, but we do have 3.5 years or more, well, really more, of the Trump administration still continuing this trade fight. And the correct strategy from the U.S. is to isolate China. This is where there's more popular support for taking trade actions, and to reduce the trade war elsewhere. And in that case, then we would have to see China actually come to the table in order to try to see the last pillar of its economic growth, which continues to be manufacturing, not destroyed by the Trump administration.
What do you think China's response will be? I know that there's some very influential individuals putting out on social media things like maybe banning Hollywood or not accepting U.S. poultry. What do you expect Beijing to do?
Yeah, well, those two retaliation points are perfectly valid and likely to happen. The truth is that the iPhone was already getting squeezed out of market share in China. Teslas were already getting squeezed out of market share in China. China's been very competitive building electric vehicles. Basically, American companies weren't getting access to China, and that's one of the reasons we have a trade war. China's overproducing goods. Now, of course, the Americans are overconsuming goods, but the point is that if there isn't a lot of market access for the U.S., then there's not as many great options for China to retaliate. If they try to sell treasuries, then the issue there is that it worsens the global economy, and then will retaliate. It will reflect or redound negatively on the Chinese economy. And also the Federal Reserve can buy those treasuries in an emergency. And so there's not a lot of great retaliation, but it definitely does mean squeezing out American goods and services, pressuring companies, using non-tariff barriers, and pivoting to the rest of the world and trying to build better relationships elsewhere.
They could lean on the FX channel. What are your thoughts on that? Could a trade war become a currency war?
Well, it certainly can, and that's been something in history we've seen, and of course we've seen a depreciation in the renminbi since the election, and now we have signs that it's happening again. Now that is, of course, poking the bear in the eye. If China's response here immediately is to depreciate the renminbi sharply, and it could, they could lower it, 5% or more, then this is basically another example where the Trump administration is going to have to come out and say they made the wrong choice. And they're going to have to threaten more retaliation. Now, ultimately, given that we're already at, well, you say 104%, really it's higher if you include the level of tariffs beforehand. Maybe the Trump administration doesn't have to do that much more on the tariff level, but they can simply threaten to keep those tariffs in place for longer. But definitely that puts deflationary pressure on other, or devaluative pressure on other currencies around Asia, and so it reduces the buying power of the world and it reduces global growth.
Hey, Matt, appreciate your thoughts. Matt Gerken there of BCA Research on the potential of China to retaliate or to negotiate, for that matter. Got to be across so many things this morning. In the commodity market, just briefly, a break below 60 on Brent for the first time since February 2021. In just a moment, earnings season starts with Delta Airlines. How can you provide guidance in a moment like this one? We'll get a view on the economy with Rob Sockin of Citi in just a second. From New York City, this is Bloomberg.
right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and
you
forget
need to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s. And
don't miss Open Interest live weekdays.
It's another busy morning. Good morning to you all. In just a moment, we should get numbers from Delta Airlines, so stay tuned for that. Equity futures on the S&P negative by 0.75% on the S&P 500 following a close below 5K for the first time since April 2024. The wild swings we've seen over the past few days are consistent with a bear market. Futures on Monday, the lows negative 5%, the highs +3. On Tuesday, negative 0.5 versus +4 by mid-afternoon. Just amazing swings in the market. Elsewhere in the bond market, just to get to bonds, and then we'll turn to Delta. 2-year, 10-year, 30-year yields are still climbing. Up 10 on 10s, up 10 on 30s. Your 30-year yield approaching 5%, 4.86. Earnings season begins. How can you provide guidance in a moment like this one with Delta Airlines? Here's Danny Berger. Hey, Danny.
Hey, John. We have the new playbook for reporting earnings in a tariff regime. Delta is not giving an outlook. It has withdrawn its full-year financial guidance. It says that it will give an updated outlook later in the year when it has more visibility improvements. It still is anticipating a profit in 2025, but it is declining to give an exact figure or back the one that it gave earlier this year. Here's also another sign in just how much companies are willing to spend. Delta planning to trim its capital expenditures for the rest of the year. It now expects no growth in flying capacity for the second half of the year. The CEO saying that growth has largely stalled with the trade uncertainty. Again, not affirming their full year growth given the current uncertainty. For what it's worth, for the first quarter, they did beat 46 cents a share. That is a beat of the average analyst estimate. But remember, that was already a downgraded view given from March when they said that they were concerned about domestic consumers and their likelihood to fly. They did give an outlook for the second quarter. They said that earnings would be as high as $2.30. That is slightly above expectations. But, John, the big headline takeaway, uncertainty means no guidance from Delta.
Danny, stay close. They're not going to be alone, that's for sure. I imagine you'll see many more headlines like the one we just saw from Delta Airlines. Remember, Delta, the first to come out in the first quarter and warn about what was happening with consumer activity, that in the middle of February, things started to stall. It looks like they've continued to stall. Understatement of the year so far. The first quarter unfolded differently than initially expected. Lisa, I imagine you'll hear a lot more in a similar vein in the coming days and weeks.
Yeah, I mean, if Delta sneezes, does the rest of the airline industry catch a cold? This is one thing that Ed Bastian, the CEO of Delta, did say. While the first quarter unfolded differently than initially expected, we delivered solid profitability that was flat to prior year and this is the key point, is expected to lead the industry. So if Delta cannot give some sort of sense of what kind of guidance they have ahead, how can American Airlines, United, let alone Southwest and JetBlue? This is a big question mark. And how do they exactly plan for capacity as well as staffing?
Well, Danny, just to bring you back into the conversation, that capacity issue is really important. Delta's not just going to sit there and do nothing. They are telling us what they're going to do in the coming months.
They are. Look, this is a company that has now decided that they're going to be trimming capital expenditures, and it doesn't expect growth in flying capacity for the second half of the year. In a way, it might be good because we might be experiencing some supply issues for the airlines. You have to remember that airline supplies is a global business. We've already heard from the likes of over the weekend reports from Reuters that Howmet, one of the suppliers for parts for airplanes, declaring a force majeure. So you have both the demand and the supply side under constraint. So maybe it makes sense that they're not going to be expanding capacity with all of those various headwinds coming their way.
Danny, thank you. Delta Airlines pulling guidance. We'll get more guidance later on this week, or lack thereof, from the banks when they report on Friday. JP Morgan kicking off bank earnings on Wall Street. Speaking of capacity, Lisa, Virgin Airlines, Virgin Atlantic, set to reduce winter flights to JFK. We saw that announcement in the last 24 hours as well.
Yeah, and we've seen this type of capacity withdrawal. It's not clear that they have the ability to really cut prices to try to induce people to come to buy if they have higher costs across the board, maybe not gasoline, but certainly with other costs that are coming in. A big question mark is also international demand, because so far they said it is holding up, but there's a real question about how much inbound demand there is to come to the U.S., and especially if the dollar is weakening, how much outbound demand there will be from U.S. Consumers dealing with the wealth effect and maybe dealing with that Italian vacation that isn't quite as cheap.
Just to sit on international, if you watch Sectoral Besson sitting down with Tucker Carlson over the last week or so, I think he did a fantastic job of articulating the kind of things they're concerned about. The last summer, you saw record European travel from Americans. At the same time, you saw record usage of food banks in America. This is something that's on their radar big time down in Washington, D.C.
Look, there is a sort of discussion around the people who are most upset right now are the people who have benefited from some of the order that we have seen over the past 10 years that really culminated in the post-pandemic era. There are many legitimate criticisms in the way things have been arranged. Question is this the way to get about rearranging that, number one? And number two, does it lead to ultimately a more profitable backdrop? Right now, consumers and, frankly, corporate America is not so sure.
For the underlying economy, in the meantime, the low-income consumer has been squeezed now for 5 years. They've been under massive pressure. The high-income consumer is the reason why these numbers have been okay at the headline level. That's what speaks to Delta Airlines and the whole industry right now. You mentioned international, long-haul and premium. Is long-haul and premium starting to break? Because if long-haul and premium is starting to break, then I think there's a read-through to the broader economy from there.
This has been the consumer that's held up the rest of the economy. It has been the wealthiest consumer, the ones that have benefited from the wealth effect, from the fact that stock markets have risen dramatically. All of a sudden, if you lose 20% like that in just a couple of trading sessions, how much does that dampen demand for luxury goods? We've heard some warnings from analysts covering the luxury goods sector. Airlines are going to lead this, given their dependence on that premium product.
Tons of volatility in the equity market. Delta right now is negative by about 0.5% in the pre-market. To turn to the global economy, Robert Socken of Citi writing, for this year, global growth now looks likely to fall in the 2 to 2.5% range and could fall below 2% if downside risks materialise, particularly for the US and China. Rob joins us now for more. Rob, good morning.
Morning.
Is downside risk materialising?
I think what we're seeing this morning with another 50% on tariffs, I would put that heavily in the downside risk category. That is not only going to weigh on growth in China, growth in the U.S., spillovers to other regions. But we have to start thinking with tariffs that large, do we start to get even non-linear effects where trade drops off very sharply because it's uneconomical at these levels? So I'm worried with the way things are moving that we could get even lower than those numbers. I would say if those tariffs stick, I would be in the high 1% for global growth, but with significant downside risk.
That if. How much heavy lifting is that if doing right now? Why are we still sitting here saying if they stick?
Yeah, it's doing a lot of heavy lifting, and the only reason I'm using if is because these numbers are so large that maybe it does bring the two sides to the table, because the economic damage is not just felt in China, it's felt in the U.S. from these tariffs. And more broadly, actually, when we do our modeling, because we're tariffing all of our trade across countries, the economic damage to the U.S. from these tariffs is generally found to be larger than it is for the rest of the world. China is an exception because the tariffs are so exceptionally high there. But broadly speaking, this is hurting the U.S., I think, most of all, at least in the short run.
There seems to be some dissonance right now between economists on Wall Street who are saying this is a five-alarm fire that could potentially torpedo the global economy, and even companies that are coming out and saying, look, we don't know. And honestly, we do see consumer demand sticking in for the most part. Maybe there are some deteriorations on the margins. How do you square those two gaps? Is it just a time lapse as these things come into effect? Or is it just that generally Wall Street economists are portraying the worst case scenario to say, look, this is what could happen versus what is happening or what is likely to happen?
Yeah, absolutely. And, you know, as economists, we have to think about all sorts of things like how durable these tariffs are, how long they stay in place, what the drag from them is. And consumers and businesses have to think about the same thing. But so far, I think the effects on behavior aren't seen as much because, you know, this has come as a large shock. And I think if they stay in place, you're going to start to see a more substantial pullback. When we look at polling of surveys of businesses and consumers, you're seeing a sharp fall in sentiment across the board, even if activity hasn't fallen yet. That tells me that, all right, activity is holding up okay now, but you could see a sharp pullback going forward if these risks that we've been talking about, these tariffs stay in place, do actually materialize.
Will it lead to some sort of layoff wave if this does continue, if these layoffs, if these tariffs do stick, given the fact that companies are scarred by what happened during the pandemic? They are very aware of demographic issues, and we have less immigration, so that's going to also restrain the pool of workers that they have to hire from.
Yeah, absolutely. Those are great points. And I would first highlight that the labor market and the consumer have been remarkably resilient through the cycle. So we shouldn't underestimate that resilience as we go into this additional shock. That being said, with the way these numbers are moving and with signs that households are showing increasing stress, we're talking about the lower income consumers that have shown stress, those stress are going to worsen if inflation picks up. And upper income households potentially, which we haven't worried about throughout the cycle, have that worry about that negative wealth effect from the fall in equities. So I think consumers are likely to pull back. And on top of that, companies are going to have to find ways to be profit maximizing in this environment where their costs have gone up so much. That could mean layoffs. So the combination of slowing consumer spending and the need to preserve costs, I think we have to worry about the stability of the labor market.
If the tariffs stay long term, is the rate so high that it actually would make economic sense for businesses to come back and manufacture in America?
And you know, if you're going to take the administration at face value for the economics, that's what they're trying to do. They said this will be short-term pain, but it'll be long-term gain. And what I worry there is twofold. One, there's a time disconnect that even if companies say, all right, we're going to come back and produce America, it's a long time span between when that gets announced and when it happens. And in the meantime, the tariffs in place. The second worry I have is there are many industries where we don't produce much of those products in America. And when we talk to companies, it's not quite clear we have the infrastructure to produce them here. Apparel is a very good example where we produce very little in the U.S. So there's a question of, can industries that have moved overseas, some of these examples, could they be viable in a U.S. model? And there's a big question mark there as well.
Yesterday, the president in the morning was talking about getting on the phone with some world leaders like South Korea. It felt like there was opening to negotiations. By the evening, he was talking about really doubling down, saying, I'm going to even add pharmaceutical tariffs on top of this. Do you have a base case on any of this by the end of the year where rates could be?
Yeah, well, it's we hope, the way we've been framing is kind of the peak tariff rate, because we do hope that we end up in negotiations, these start to come down. We were at a peak tariff rate of kind of 25 to 30% range before this 50% announcement. This takes you close to 30%, especially if we get some of those sectoral tariffs, which we do expect on things like pharmaceuticals. I do hope after that we move into a period of negotiations. And as we're saying, with China, it's pretty tense, and maybe that could take a lot longer. Who knows where that could go? But hopefully with some of the other countries, we start to get negotiations. However, the administration is talking tough. They're saying they're looking for great deals. Yeah. And that says to me that it could be months until these come off rather than days.
Rob, we're going to hear that word repeatedly through the next week. And to your point, this could go on for months. That word hope right now is the problem. Not to be too dark. Hope is the problem, and I'll tell you why. For as long as we sit here and say, are these the rules of the game? Or can we negotiate? Companies will do nothing. In fact, they'll do less. They won't be building the factory because if they don't believe the tariffs are actually going to hold, why would they start making plans to build the factory and boost capacity in the United States? Lisa, that's the issue you've got in the near to medium term at the moment, and that speaks to Delta Airlines again this morning. What is Delta doing? They're reducing capacity. Now, I know that's a very unique story for the airline business, but are you going to see other businesses do the same? The opposite of what the administration would like to see, because we're stuck in the hope game. We're sitting here every single morning saying, are these the rules of the game? Or can you negotiate? If you don't believe they're the rules of the game, if you keep sitting here and saying, I hope they will come off, if they stay on, you're not going to come out with big plans for CapEx anytime soon.
Factories are being idled. People actually on the margins have been laid off from factories that are on pause until people have greater sense of certainty. What we've seen, to your point, is exactly the opposite. And inaction is action. And what we're seeing is companies not deciding to do CapEx pretty much across the board. They are not deciding to purchase other companies. So at what point does this become a self-fulfilling prophecy?
Robert Sock in a city. Robert, it's good to see you, sir.
Pleasure.
Thank you very much. This came from the central bank governor of Spain just moments ago in the Financial Times. Some of the worst-case scenarios that we had identified are materializing. That's the situation we're in right now. Equity futures on the S&P 500 down by about 0.7%. Wild swings over the past few days. Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just to recap those Delta earnings with shares in the pre-market up nearly 3%. It withdrew its full-year financial guidance, citing uncertainty surrounding global trade. Delta also said it will update the outlook later in the year as visibility improves. CEO Ed Bastian told Bloomberg that confidence is dimming, growth is stalling, and revenue has flatlined. President Trump signaled measures to promote the use of coal in the U.S., aiming to revive the fossil fuel industry and power data centers. The initiatives include legal strikes against state regulations and efforts to accelerate coal exports and develop coal technologies. Elsewhere in Germany, conservatives and social democrats have reached an agreement to form a ruling coalition that paves the way for Friedrich Merz to become chancellor. A deal is set to be announced later today, but it still must be approved by members of the Social Democrats. Merz will likely succeed Olaf Scholz as chancellor in the first week of May. And that's your brief. John.
Hey, Danny, thank you. Great work as always. More from Danny a little bit later in the next hour. Up next on the program, dollar assets in question.
Because we have these great worries over U.S. policy, they have brought into question the role of the U.S., and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that, in turn, putting pressure on the dollar.
Up next on the program, we'll catch up with Alexander Jekov of BNP Paribas, live from New York City this morning. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way, faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline, or trying to send one out. You could transfer millions and millions and millions of dollars worth of Bitcoin overseas you know, while having a glass of wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Close on the S&P 500 south of 5K just yesterday for the first time going back to April of last year. This morning, futures are touched softer, down 0.25%. Is this the playbook for earnings season? Pull your guidance. That's exactly what Delta Airlines did about 20 minutes ago. That stock, Lisa, higher by 3% in the pre-market.
They actually performed better than expected on the margins in the first quarter, and this actually does speak to their ability to be the front runner from all airlines. The fact that they're going to be cutting capacity highlights maybe their ability to keep prices high and even increase them further at a time when all of the industry is going to be feeling the same pressure.
More earnings coming through the week. You'll get the big banks on Friday, starting with JP Morgan and a whole lot more. Under surveillance this morning, dollar assets in question.
Because we have these great worries over U.S. policy, they have brought into question the role of the U.S., and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that, in turn, putting pressure on the dollar. This is also not the first time that the market has falsely gotten excited about this narrative, and it wasn't sustainable. Even if it is the start of a massive rotation, that's something that will take a decade or more to play out.
So here's the latest this morning. The US dollar pulling back as President Trump's so-called reciprocal tariffs take effect. China holding fire on immediate retaliation. Alexander Jekov of BNP Paribas writing, the market is trading rotation out of US assets, making universal tariffs potentially bearish for the US dollar. Alexander joins us now for more. Alex, good morning. It's good to see you.
Good morning.
Let's start on that call. Things have changed. We started the year and a lot of people thought tariffs up, dollar stronger. Tariffs up, dollar weaker. What has changed?
Exactly as you say, a lot has changed. The market's gone from trading tariffs as dollar bullish because FX was the offsetting factor for tariffs to now treating them as dollar bearish because the market's focused on a rotation out of US assets. I think what's changed is previously the market was looking at unilateral tariffs. Now the market is facing universal tariffs, and universal tariffs are more growth negative for the US. What's key for FX is that foreign investors are particularly overweight U.S. equities because of the valuation adjustment that we've had in the last 10 years or so. And that makes FX more sensitive to this rotation.
That dollar long has accumulated over the best part of a decade plus. Do you see a real structural shift emerging here?
Yes, we do. So part of that, of course, is the tariff narrative, but part of that is also about Eurozone fiscal reform. We think Eurodollar can get to 120 by the end of next year, on the basis that Eurozone fiscal reform is a game changer. It means structurally higher bond yields. It means structurally higher growth. And for FX, it also means that the higher supply can crowd in European investors. In other words, less of an outflow. So it's not just about the equity rotation that we just spoke about. It's also about a crowding into domestic fixed income markets.
Is the rumor a bit more inflated than maybe the reality, though? I mean, if we're talking about increasing defense spending in Europe, how much is that actually going to boost growth in a way beyond what we've already seen?
Yeah, so before these tariffs were enacted, we were looking for about a 0.4% change or so to growth this year. So not immaterial, and a lot of that comes from the confidence channel. Later, as Germany sort of potentially builds out its defense industry, there are other channels. We do think it's game-changing over the medium term, but it's a sort of sequence. In the near term, if tariffs are here to stay, then that offsets some of the fiscal impact. But in the coming years, and I think that's ultimately what the FX market's going to be looking at, it's a bullish factor for the euro.
What has changed since late last year, when everyone said that tariffs unabashedly would be worse for the rest of the world than the United States, that suddenly that entire narrative has gotten completely flipped on its head?
I think it's the universal tariffs. Universal tariffs are more growth negative for the US. I think the paradigm that we're in for euro-dollar specifically is not too dissimilar to the one we're in 2017. When euro-dollar rallied from 105 to 125, in spite of front-end rates moving 100 basis points against the pair. This time we could see something similar if the Fed, for example, keep rates on hold, as we expect them to in the near term, given the focus on inflation, where FX then, rather than focusing on rates, starts to focus on global asset reallocation.
What's the safe haven now? I see the Swiss franc money pouring into that currency this morning, but they're being hit with a 31% tariff, even higher than the European Union. Yeah. And Trump last night is talking about hitting pharmaceuticals, which is a main industry that they export.
I think you can make a bearish case for the Swiss franc still. You can say, for example, the SNB are a dovish central bank, and as you rightly point out, tariffs on Switzerland are not immaterial either. But the way in which we think about it is when you have a big risk off, it's very hard to fight the inflow into Swiss. So it is still a safe haven. It might not be the best safe haven. So, for example, yen, we ultimately expect to perform better than Swiss over the medium term. But I think in a big risk off, those factors like what are the tariffs on Switzerland or what is the SNB doing sort of move to the background for the market.
You're focused on the European story. Can we just throw some China in there just briefly to finish the conversation? Do you see a potential for this to morph into a currency war from a trade war? Or are these tariffs just so large, so big, that any kind of devaluation on the side is just kind of doing things around the edges?
I think that it'll be very difficult for the FX to offset the extent to which these tariffs have been enacted or the extent to which or how large these tariffs are. Ultimately, we have a more bearish view on Asia FX because that's where the real surprise came last week. Right? People were, or I would say investors were likely already expecting tariffs on Europe, but definitely not to the extent that we've seen them on Asia FX. And so we think the euro can do well not just versus the dollar, but also versus the Asian FX complex, and CNH is part of that. So euro CNH, although it is already at very high levels, we think risks are still to the top side.
Surprising to see such large numbers on places like Vietnam. And I'm sure a lot of US-based companies were very upset to see that just last week.
Yeah, which raises the question, at what point do they push back, and are we going to hear that in guidance? I would take that a step further. If universal tariffs hurt the U.S. more than the rest of the world, at what point do potential deals offset that? Or is the sort of cat out of the bag, and we can't really put it back in, genie out of the bottle, whatever kind of analogy you want to put.
Toothpaste out the tube.
Thank you, that's perfect. And it's hard to really reset this clock.
Can I mention another French bank? Forgive me, SocGen came out with this morning. Very competitive, the two. Slapping 104% tariffs essentially means China's exports to the US will largely be wiped out. The scale of tariffs is simply too large for any exporters or consumers to swallow. The FX channel is not going to change that story with 104% tariffs on.
This is ultimately going to be a story of either negotiation or a cessation of trade, or potentially consumers paying a lot more, and that's basically where we're at.
Alex, good to see you, sir. Thanks for dropping by. Appreciate it. Alexander Jekov there of BNP Paribas. Up next on the programme, Chris Harvey of Wells Fargo, Bloomberg's Tyler Kendall, Sheila Kaolu of Jefferies, and Tony Rodriguez of Nuveen. From New York City this morning, good morning to you all. The second hour of Bloomberg Surveillance. Up next.
Names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
You are in wait-and-see mode. Those are the three most dangerous words.
We thought that last week would be the week of peak uncertainty. It was not.
We could be in for a long period of pain here.
The critical thing is to what extent investors really start to fully price a recession.
What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. On the S&P 500, futures are lower. We're down across the board. Wild swings over the past few days, and they continue. Gapping lower by 1.2% on the S&P 500. On the Nasdaq, we're down by 0.9. The focus now shifts to corporate America. Delta Airlines out just 30 minutes ago. In a few days' time, we'll hear from the big banks. Delta's up by more than 3%, and Delta doing what I imagine many others will do, pulling guidance, Lisa, this morning.
They're pulling guidance at a time where they basically say, how can we have any certainty whatsoever? They say they're watching closely their premium content, as you were mentioning before, John, because that has been fueling a lot of their gains. But they do plan on trimming capital expenditures. This is important. They also are expecting no growth in flying capacity for the second half of this year. So it's not just no action. They are battening down the hatches, and they are preparing for potentially a bout of volatility.
We're expecting more still to come on this front from other companies in corporate America, but just crossing the Bloomberg terminal, Walmart's a very different beast. Walmart this morning, Lisa, reaffirming their guidance for the months ahead.
And they're going to have a much different story to tell when it comes to how they're negotiating the pass-throughs and how much they can pass along to the consumer. Nonetheless, they said that full year 2026 guidance remains unchanged, with first quarter sales up 3% to 4%. So not necessarily the same kind of flavor as as we're hearing from Delta. Interesting to see that Levi said the same thing. So at what point will the guidance that we're getting from corporate America be a lot more positive than some of the gloom and the doom of the projections of economists on Wall Street? This is the contradiction, the past and the present versus the potential projection of the future.
This pendulum keeps swinging between deal hopes and tariff threats, and that continues this morning, depending on who you speak to. Your day ahead looks like this. A couple of things to watch for. Busy morning coming up. You'll hear from Secretary Bessent a little bit later on this morning, 8:30 Eastern Time. After that, he'll be very focused on this number, $39 billion of 10-year notes coming to market at a time when 10-year bond yields are higher, not lower. We're up 8 basis points at the moment to 437. Someone else speaks a little bit later as well, Anne-Marie. Jamieson Greer on Capitol Hill, day 2 for the U.S. Trade Representative.
This is going to be very important. He spoke yesterday at the Senate, and that's when you saw Republicans come out, notably Senator Tom Tillis. Whose throat do I choke if this proves to be wrong? Republicans are starting to get nervous. What you heard from Ambassador Greer is that the middle class has been decimated when it comes to the so-called China shock, and they are excited about this being one of the biggest trade actions we have seen since China joined the WTO. But you have to imagine, given the market reaction this morning, and that 104% went on China, and remind you, it's even more for goods that are hit with 301 from Trump 1.0, north of 120%. He is going to get a lot of questions.
I mentioned equities were gapping lower. We're down by 1.7% on the S&P 500. There is a why. So let's get to that why. This headline just crossing the Bloomberg terminal that China is raising tariffs on U.S. goods to 84%. So overnight, we moved to triple digits on the U.S. side. We sit here this morning waiting for retaliation, a response from China. And Lisa, we get it. It's 84%.
So this raises the pressure that much more. Initially, there were reports that maybe the reaction was much more muted from China. They were taking a wait-and-see approach after having more than 104% tariffs put on all their goods coming into the U.S. as of today. A real question here, how does President Trump respond? How much does this affect the current products that are sitting on the ocean waiting to get to the United States? And frankly, what does this relationship look like at a time where you already have seen a huge drop in the amount of trade between these two countries?
I think if you're in the market right now, you're wondering where to hide. And I can tell you at the moment, you can't hide in the bond market. It's not working. Yields are up now by double digits across the long end of the curve. On a 10-year, up by 10 basis points. On a 30-year, higher by almost 12. Lisa, that auction later, let's sit on that. 10-year auction, supply coming later at 1 p.m. Eastern Time. You always make a big deal of it.
I do.
How much of a big deal is it today?
It's potentially massive, because yesterday was not a good auction and it was an easy one. Today we have $39 billion of 10-year notes being sold at 1 p.m. Eastern at a time where consumers are not clearly going into these instruments as havens. Are banks going to have the capacity to take on the risk? Can they absorb demand if there aren't other investors that come onto the field? One thing I want to say, tomorrow it gets even hairier when we've got $20 billion of 30-year notes being auctioned. That is the note that has been most affected by potentially the basis trade unwind, but potentially also a whole host of other selling.
Still trying to figure that out.
Yeah.
That's for sure. Many of you are at home, I'm sure. If you're just joining us, welcome to the program. So your main headline this morning, as expected, the reciprocal tariffs go on. Just moments ago, getting confirmation from the Chinese side of things that China's raising tariffs on U.S. goods to 84%. Equities gapping lower stateside, even more lower. Much, much lower across Europe. The DAX, across France, across Italy. We're seeing losses across the continent. Coming up this hour, we'll catch up with Chris Harvey of Wells Fargo following another volatile trading day. Sheila Kahyaoglu of Jefferies reacting to Delta earnings. And Tony Rodriguez of Nuveen as the bond market offers very little comfort. We begin this hour with stocks looking to snap a 4-day losing streak and struggling as another round of Trump tariffs kick in. Chris Harvey of Wells Fargo writing, there's growing crisis of confidence brewing. Stock market vigilantes will not be that patient or ignored. It probably needs to get worse before it gets better. Chris joins us now for more. Chris, good morning. Good to see you.
Good to see you too.
This is a really difficult one. So let's take a beat. Typically, we sit here and think about the kind of threshold that it would take for a policymaker to step in and act as the circuit breaker. This time, the policymaker is the source of the risk, maybe not the solution. How different is this as a moment for you and the team?
It's very different. And the issue is, and we go back to Greenspan before the 04 tightening cycle. He said, we can raise rates, right? But what we need to do is we need to communicate that to you. We need to tell you how we're going to raise rates, over what time period, so you can plan. If you're going to buy a house, you can speed up that house purchase. If you're going to buy a car, you can speed that up. This administration is talking a lot, but they're not communicating a lot. This weekend, we had one person saying tariffs are negotiable. We had somebody else saying they're non-negotiable. What are they? What's your goal? What you're trying to do? What are we handicapping over what time period? You need to communicate better. The other thing is the market is sending a big signal. It's not a good idea to ignore that.
China's sending a big signal right now as well, so I'd love your thoughts on that too. Big tariffs coming from the US side overnight. China responding with 84%. I think at the moment for a lot of investors, they look at that headline and say, you know what, given how little we sell to China, that's not much of a big deal. But I think the bigger read across, the bigger read through at the moment, that makes it much, much harder to get to the negotiating table with this president who's pushed back against China threatening to do exactly this.
Yeah, so what people have realized is the weak spot for the U.S. is the capital markets and the economy. If they push back, right, we're going to lose, and we are losing some negotiating leverage. What are we talking about? We're talking about recession. We're talking about job losses. We're talking about the negative wealth effect. We're talking, in a recession, the deficit goes wider, not tighter, and people know that. So they're saying, okay, fine. If we're going to do this, we're just going to pull everyone down into the muck. And what you're seeing is just not great.
Well, I'm looking right now. China also added 6 more firms from the U.S. to the unreliable list at the same time that we've seen incredible losses in the likes of Apple, which seems to be very much in the crosshairs of this. How much does this discourage you from going to the multinational companies, actually at a time when they potentially could be the most exposed?
Yeah, Lisa, what we need to do is we need to figure out exactly what we're dealing with. And because it's a moving target, that's why it's so hard to... That's why the markets are so fluid at this point in time. And you're right. Where are the safe havens? The safe havens are at the front end of the curve. Safe havens are in low vol. They're in defensives. But even those are still, that's a place where we've liked, but it's still showing some stress, right? So it's very difficult to find a safe haven. It's very difficult to really preserve your money or your assets at this point in time.
Yeah, the reason why is because 10-year yields are up through 4.40. You're looking at 30-year yields now almost 4.9%.
Yeah.
They've absolutely been surging. What's going on? I mean, what are you doing with this?
So there's lots of talk. One conversation is that out of Asia that they're selling duration, right? So they're selling longer bonds and buying shorter bonds for liquidity issues to send a message. There's other talk about basis trades. There's, if you look at what's happening, nominals, last time I looked, nominals are going higher, but it's being forced by reals. It's not being forced by, at least in the last couple of days, by inflation expectation. That seems more like a liquidity issue, people moving around positions, not so much fundamental driven, right? The other thing is, obviously, we've got issuance coming, and there's more and more fear, even though right now, inflation expectations or break-evens aren't moving. There's fear that that will continue in the future.
Seeing some big moves right now, that's for sure. If you are just joining us, welcome to the program. 84% tariffs from China. China raising tariffs on U.S. goods to 84%, and the spillover immediate. Equity futures down by 1.6% on the S&P 500. The Russell down by 2.5. The DAX is down by 4 full percentage points. And in the commodity market, you're seeing crude roll over as well. On WTI and on Brent, we're down by 6%. Brent crude 58.98, WTI 55.85. There will be some individuals in America making a lot of noise today off the back of this headline. I'm thinking of the farmers in a few red states.
Absolutely, because remember, Trump 1.0, the farmers were the ones that got hit the worst because they didn't have the export market of China to go to, and then the United States had to bail them out. But Jonathan, you started this conversation this morning where you're looking to policy makers for the answers, for the solutions. When I asked the president directly the pain threshold he was willing to take on for the market, he said sometimes you have to take medicine to fix something. They think the tariffs are the medicine. Well, what's going to be the solution and the medicine to what is happening right now, the fallout from these tariffs?
Some big moves elsewhere as well. Apple's had a difficult run of things. That name is down by 2% in the pre-market at the moment. Apple is down before today by more than 20% in just 4 sessions. The worst run for that name going back to 2000. The year 2000, the worst 4-day run in 25 years for one of the biggest companies on the planet. Chris Harvey, not to talk about single names exclusively, but we can talk about Mag 7.
Right.
Are they in a difficult moment now, in a much, much bigger way than maybe we've ever seen for those names?
So, some, yes, and obviously Apple is more of a focus because of the tariffs and what they manufacture in China, right? The rest of the Mag 7, more of the communication names, they're in a little bit better space, but it's not as if anyone's in great space. It's not as if you can say, wow, this is a perfect spot, this is fantastic for these guys, couldn't be any better. It's just relative who's worse, who's better, and who's going to get hurt a little bit more. Where's the defensiveness? Right now, what we're doing is everything is across a risk spectrum, and which one has less risk. That's all you're doing.
What's on your dashboard at the moment to establish where a tradable bottom might be? Is that impossible right now for you and the team?
No. So John, this is what we're looking at, because we see a setup. We don't see the bottom, but we see a setup, right? We want to see 1Q numbers reset. We want to see them cut. We want to see an inversion in the front end of the curve between 2 years and Fed funds of 100 basis points or more. That tells us that the market's indicating we need to move faster, you need to hurry up, and potential monetary policies coming. In addition to that, we want to hear the conversation become more productive. We want it either to shift from tariffs to taxes, or the acknowledgement that, oh yes, it's good. Everyone knows there's going to be pain, but the issue is they just don't know. The cure seems to be worse than the disease right now, or that's what the market's saying. You have to acknowledge that, hey, yes, there's going to be pain, but there's light at the end of the tunnel. Here's what we're doing. Here's our goals. When we get there, this is what's going to happen.
In the meantime, Delta withdrew its guidance for the full year. Walmart reaffirmed its guidance. What do you do with this?
So we actually had this conversation yesterday, and I've been having this conversation a lot. We expect numbers to come down. It's going to range. Some people, we were talking to our auto analyst, and he would not be surprised if there would be suspension of guidance there. We were talking to others saying, maybe it's going to be 5%, maybe 10%. What we're going to hear is the C-suite's going to say, out of an abundance of caution, here's what we're doing. We're lowering the top end of guidance. We're cutting 5%. We're cutting 10%. Because of the uncertainty, we have to remove guidance. So it's going to be right across the board. And you're right. The example of Walmart and Delta is a good one, because you have the two ends of the spectrum.
Chris Harvey, going to stick with us, I'm pleased to say. What a morning already. Chris Harvey of Wells Fargo there. If you are just joining us, some big moves out of China, not just the United States. For an update on that and more, let's get your Bloomberg brief with Danny Berger. Hey, Danny.
John, let's get straight to the breaking news. China is raising tariffs on goods imported from the U.S. to 84%. It's a retaliation against a new 104% levy that President Trump imposed on the country. That, of course, according to a government statement. Now, the shares of large U.S. and European drug makers are sliding after President Donald Trump said the U.S. was planning to announce a major tariff on pharmaceuticals soon. Speaking to an event at the National Republican Congressional Committee, Trump said the tariffs will incentivize drug companies to move their operations to the U.S. Elsewhere, San Francisco Fed President Mary Daly says that the central bank can take its time before adjusting interest rates. Daly saying, quote, with good growth and policy in a good place,
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Don't blink. You cannot look away from the Bloomberg terminal right now. Another headline. Overnight, big tariffs on China. The response, China raises tariffs on U.S. goods to 84%. The reaction, equities down across the board, negative 1% again on the S&P. In the bond market, no comfort there. Bond yields up by 8 basis points on 10s. In the commodity market, speaking to a deceleration in economic growth. Crude down across the board by more than 5%. It's a break of 60. On Brent crude, 59.33. Under surveillance this morning, nerves building on Capitol Hill.
In this scenario, the decision maker who decided the alla prima approach, who has obviously had to have spent time anticipating what we saw in the markets and some of the pushback, I'm assuming this all got gamed out because it's a novel approach. It needed to be thought out. Whose throat do I get to choke if this proves to be wrong?
Here's the latest this morning. President Trump's tariff rollout raising concerns for Republican lawmakers on Capitol Hill. Senator Ted Cruz also warning there could be a bloodbath in the midterms if tariffs push the economy into a recession. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Is the pressure starting to build?
Yeah. Hey, John. It certainly does appear that some Republicans are starting to sound the alarm that these tariffs are a little bit more than they bargained for, although we are still seeing them kind of walk the line between criticizing the tariff policy itself versus the tariff rollout plan. And we should just note, for quick context, as you well know, many of these congressional Republicans won the majorities in Congress by campaigning on that economic messaging. And some Republicans in some tight re-election races in 2026, like Senator Tillis, might feel like they don't have the benefit of an extra couple of years to see some of the potential policy benefits from these tariff plans. And as you mentioned earlier this hour, it's not necessarily new concerns from Republicans, particularly when it comes to potential impacts to farmers. And I went back and I checked my notes this morning because I had caught up with Senator Todd Young, a Republican from Indiana, after he questioned Treasury Secretary Scott Bessent during his confirmation hearing about how this White House would protect farmers. And at the time, he told me that he had assurances from this administration that tariffs would be targeted, except in some cases where they would be used as a negotiating tool. It is so clear, John, that we have blown past those expectations, not just of the market, but of these lawmakers who came out and had supported the tariff plans to begin with.
Tyler, today the big focus is going to be on China, I imagine, when Jamieson Greer sits down on the House side at 10 a.m. Yesterday, Trump claimed that China wants to make a deal, and he's waiting for Beijing's call. Any inference you're getting from the White House that she plans to call Donald Trump?
Well, at this point, Anne-Marie, we also have to note that there hasn't been a call between these leaders since President Trump was inaugurated. And we went from President Trump a couple of weeks ago saying that there could potentially be an in-person meeting between the two leaders. We saw Senator Steve Daines, another Republican who was questioning the USTR yesterday, travel to Beijing in a bid to try to make that potential meeting happen. And now we're, of course, at this broader escalation. And, of course, this goes back to our conversation about how farmers could potentially be targeted here. Of course, as you'll recall, the U.S. ag industry lost about $26 billion between 2018 and 2019 during the first trade war with China. But then I'd also point our attention to some of these other targeted actions that Beijing is taking, including when it comes to targeting increasing export controls on critical minerals. That's going to be another pressure point for this White House, as well as the future of the TikTok deal. There's a lot of different facets to this conversation.
Hey, Tyler, great work as always. Tyler Kendall there. Out of the nation's capital, with us around the table, Chris Harvey of Wells Fargo still. Chris, this is where we really started the conversation. Where does the circuit breaker come from? Could it come from Capitol Hill?
It has to come from Capitol Hill. You have to hear the administration acknowledge what's going on, and you have to have them acknowledge and communicate that they see it, they understand it, and you have to have them start to slow things down. This conversation about a 30-day pause, a 60-day pause, a 90-day pause, something has to happen. You cannot continually walk in and have more tariffs and more stress in the system, because the more you do that, the faster we go to a recession, the faster job losses come, and the faster this gets out of control.
But right now it's just rhetoric. Do you actually see Congress pulling back the reins and trying to take control, giving less authority to the executive branch when it comes to trade policy?
Yeah, Anne-Marie, I think if it continues, you go down that route, but that's a much slower route. Right? And the market's going to move much quicker. And this is a question of confidence. Do the markets, do business folks have confidence in the plan, and what's the spill out from the plan? And right now, the markets are saying we're losing confidence, and we're losing confidence quickly.
So when it comes to circuit breaker, you think it's actually Republicans in Congress that could be the ones to put a stop to this? You don't see maybe it Xi Jinping or Donald Trump himself blinking?
I don't see in the conversation. So a couple things there, because that's a big question, right? The situation between China and U.S. appears to think that China is the existential threat. We can have that continue, and likely that does continue. But if we get positive news from the EU, from Japan, from other places where there is actually progress, then things can improve. China is toward the end of my concern at this point in time. Can we get our allies to come on board? Can we strike deals? Can we move forward? Can we make progress? If we're showing progress, the markets will react positively. If we do not show progress, the markets are not going to react positively.
There's a story in the Financial Times about how U.S. ports are getting really crowded, that a lot of companies are delaying their car shipments, right, and they're just holding them at the ports, hoping that maybe in a couple days these tariffs will be removed. Maybe it'll take 4 days, maybe it'll take 5 days, and they're about to reach capacity at these ports. What will it take for both companies and for the markets to realize this is real?
Listen, it's real, right? So the complexity of this, you cannot turn around in a couple days, in a couple weeks, because you've basically tariffed or taxed almost every single country out there. In order to unwind that, it's no small feat. The other thing is, governments do not move quickly, right? And because of what we've done, people want to protect themselves. So they're going to have to talk to their lawyers, to their leaders, to their parliaments or whoever before they take some action. We can have the conversation, but the actual action and execution is going to take, I think, a long period of time.
What are we seeing in markets? Is this just the fear that this is going to have a suppression to growth, or are we getting actually a sense of what markets are repricing as the new normal?
Yeah, the markets don't really know the end goal, right? Is it negotiation? Is it revenue generation? Or is it something much bigger, right? Do we want to change the way we do trade throughout the world and for the rest of time? That's a big question. So the markets are just trying to figure out what's going on, and the markets are trying to send a message. We need better communication. We need to understand the goal. When we get to the goal, what are you going to do, and how are we going to do it?
To start that process, to engineer that supply-side response, you've got to believe that these are the rules of the game. And we're still sat here saying, is this a negotiation, or are these the rules of the game?
I love how Chris puts it. The market is crying to the White House. We want better communication. Can we have a therapist come in here and try to clarify what the end goal is? Are we meant to be together? Are we meant to be apart?
Is this therapy again?
Well, it sounds like a lot of people are trying to get into the psychology of the moment.
What do people say? Cry harder. That's what we're doing right now.
I think that's what we're doing on every single market.
Got to find some light humour in a moment like this one. We're down again by 1.4% on the S&P. A special thanks to Chris Harvey of Wells Fargo. If you're just tuning in, welcome to the programme. Moments ago, about 25 minutes ago, we got China's response to the overnight tariffs from the US side. 84% on US goods. That's driving equities lower, not just stateside, but in Europe too. And in the bond market, bond yields are higher, not lower. Again this morning. I know that got the attention of many of you yesterday. It's where we're focused again this morning. Why aren't we seeing that haven bid into treasuries? Yields higher by 8 basis points, the 10-year 437.42. Earlier on this morning, Delta Airlines coming out and pulling guidance. Up next, we'll catch up with Sheila Kahiyolu of Jefferies from New York City. This is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to
your retirement account. I cannot say that enough. Set it and
you need to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s.
Don't miss Open Interest live weekdays.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Live from New York City, welcome back. Equity futures sliding here by 1.2% on the S&P 500. On the Nasdaq, lower as well by 0.9% on the Russell. We're down by 1.8%. 30 minutes ago, we learned China's response to America's tariffs. China raising the tariffs on U.S. goods to 84%. With 2 hours until the cash open, let's get to your morning movers. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. Look, it's been a volatile morning for the benchmark, but one thing has been consistent, and that is the pain in pharmaceutical stocks this morning. Pfizer down nearly 4%. If it closes at the level it's currently at, it would be its weakest price since 2016. The sector under pressure after President Donald Trump last night saying that there would soon be an announcement on pharma tariffs. BMO writing that for the industry, they'll be unable to move their supply chains because they are so complicated. This shatters the illusion of safety that they would be spared. Some earnings to work through. Delta, we've been talking about this all morning. Here's one of the playbooks. You can just give no guidance. They withdrawing their guidance for the full year, citing the uncertainty, saying that they would provide more clarity once they get it. Also cutting their capex and their capacity, saying that we are controlling the one thing that is in our control, and that is margins. You can see Delta shares, though, barely holding on to the gains at this moment, up 1/3 to 4/10 of 1%. Here's another playbook for earnings, and it comes from Walmart. They have their earnings, full earnings, on May 15th, but ahead of that saying that we are keeping our first quarter outlook unchanged. That's a gain of 3 to 4% in sales. Our fiscal year 2026, that's also staying the same. Of course, the irony, though, is even though they've kept their guidance the same, shares are falling 1.6%. But, John, unfortunately for them, they pre-announced that just at the same time as those China tariff headlines crossed.
Hey, Danny, appreciate it. They might have some work to do on that outlook, that's for sure. Danny, appreciate it. Equity futures on the S&P then sliding. On our radar this morning, President Trump's historic tariffs on China taking effect. The latest round of levies pushing as high as 104%. Trump also slapping 20% tariffs on the EU. China's responding with levies of 84% on US goods. The countermeasures going into effect tomorrow. China also adding 6 firms to its unreliable list and 12 entities to its export control list.
So this is now the full tit for tat. You see this escalation and this rift. What I would say is, what is the off-ramp? Who blinks first? Trump claimed yesterday China also wants to make a deal. He said they want to make a deal badly, but yet Xi Jinping has not called. Caroline Levitt then was asked about this, and she said, we will be gracious if China's leadership reaches out. Well, guess what? They're reaching out with an 84% tariff.
How do companies respond to this? Let's say these do stick. Do they just expect that they'll eventually be taken off? Do they make investments to try to shift the supply chain? And then to where? Is it back to the United States? I think Walmart's guidance was interesting because they did say that they have a wider range of outcomes for its first quarter operating income growth. And get this, for some sort of nice euphemism, they may have to, quote, invest in price, which will, quote, widen the range of outcomes for its first quarter operating income growth. In other words, they might have to eat it. And that might eat into their profit margins, and that might be what you see from them.
Thanks for attempting to translate the McKinsey, because I think we're going to see a lot of that in the coming weeks, aren't we?
I mean, how do you say something that is uncertain and that potentially is highly unsavory? Markets are able to also translate McKinsey, which is maybe why the shares are a bit lower.
This is going to be highly industry-specific, and we've all said around this table repeatedly, you need to be very open-minded about the kind of consequences that we could see. Clearly, for the airline business, you cut capacity because you think things are going to be not as busy as you thought they might be for the year ahead. For other companies that might have to increase capacity to meet domestic demand, they're not going to do that until they're 100% sure that these are the rules of the game. And the administration has spent the past few days saying you can negotiate. So in the meantime, what are those companies, what are those industries going to do?
Especially if you're worried about pricing power and you're worried about a consumer that is exhausted and not able to take on that much more. Well, that means that they can't really expand their profit margins to offset any potential increase in the costs that they are seeing. So what do they want to do? They want to sit tight. They want to have less inventory. They want to necessarily have less overhang and potential exposure.
We've mentioned Delta a few times this morning. If you are just joining us, these were the numbers. So basically what they've done is withdrawn their full-year guidance, citing uncertainty around global trade. The CEO, Ed Bastian, saying, quote, "It's very difficult to predict what policies may look like over the course of the year, that's for sure." The stock is up by 1.7% as Bastian adds that revenue has flatlined. Joining us now to discuss is Sheila Kahyaoglu of Jefferies. Sheila, welcome to the programme. If Mr. Bastian can't offer any guidance, can you?
I don't think we can either. We cut our estimates earlier last week across the entire airline landscape, assuming flat domestic pricing for the year. What we're getting from Delta is suspended guidance, clearly, and that's probably the best strategic move from here. But it assumes something worse than that for Q2 in terms of flat domestic pricing, and then a second half capacity is flat. So not great news out of the U.S.'s largest carrier in terms of what they're saying.
Sheila, you've talked about this repeatedly. The high-income bracket here in the United States holding up business for many of these airlines, premium, long haul. Sheila, are you seeing building evidence that maybe we're seeing something we haven't seen over the last 5 years, that they're starting to take the hit here?
I think premium and Atlantic or international are actually still holding up. We just got off the phone with Dan Jenke, Delta CFO. It seems like the bookings visibility there is decent. What you're seeing the contraction is in the main cabin, which is where we would see it. But also notably corporate. Corporate really saw a move down in February and March. Industries that were particularly hit were industrials, aerospace, of course, and some other sectors, while financials and tech held in there, it seems. So corporate is also taking a leg down, so corporates are clamping up a little bit, whether it's the tightness in just, cost cutting, or if it's the macro volatility that's causing that is to be determined. So that's where we're seeing the premium hit is really within the corporate customer trending down.
We are seeing some commentary from Ed Bastian, the CEO of Delta. This in the Wall Street Journal. He said he understands there's a role to play with tariffs and trade policy. It's just hard when you're trying to do them all at the same time. He also said, "I don't think we're in a recession. I think we're in danger of talking ourselves into a recession." When you talk to executives, particularly from airlines, is there a level of frustration that the consumer does seem strong, willing to accept even price increases, still looking for experiences, at the same time that there's a lot of gloom and doom on Wall Street and a potential regime shift that could just torpedo that?
It's interesting because Delta's telling us they saw it within the consumer trend down really quickly, whether it was in February and March in the first 5 to 7 days of April. I'm actually in Atlanta right now. I'm at a trade show, an aerospace aftermarket trade show. And the 10 executives we met with yesterday were so confident regarding tariffs. They don't think it'll have as much demand destruction as people assume. And that pricing will actually be positive because they could pass it through to the end user, which is, of course, the airline, which is, of course, the consumer in the U.S. So I think we're seeing that short cycle hit with Delta this morning, a massive change with what they previously guided. They had guided capacity up 4, now it's flat, and pricing also taking a swing down 2.5%. to down 6.5% in their forward outlook for Q2. So we're seeing that major revenue cut, not only from a capacity perspective, but from a price perspective. And the airline's doing its best to stay profitable, show that it's, it's positioned well for this with its relatively low leverage, but they're only growing their net fleet less than 1%. So taking into account Boeing Airbus deliveries and their retirements, that's less than 1%. So they're clamping down on their costs as well.
This is a really fascinating dichotomy right now, Sheila, because on one hand, you have the airlines saying, ostensibly, they believe they have pricing power. They believe that they can raise prices and that you could shrink potentially just your flight schedule and keep prices where they are, go higher and offset any kind of change. You're seeing something so different from the likes of Walmart that want to invest in price, i.e. absorb some of the increase in prices. Is there some sort of structural change that gives airlines a strategic advantage to being able to have pricing power?
So the airlines are clearly saying pricing is stalling. Pricing and capacity are stalling. The aerospace show I'm at is more the manufacturers and the maintenance providers to the airlines. They're still seeing that they have the ability to pass price through. One is a shorter cycle buy. With an airline, a consumer booking is maybe 30 to 90 days, and that's where we're seeing the hit with Delta. The aerospace show I'm at is probably 30 to 1 year buy cycle. So the shorter cycle is definitely seeing the market volatility impact its demand and its pricing.
Sheila, Delta is a Virgin Atlantic partner on its North Atlantic routes. We saw Virgin Atlantic pull back some of those routes, especially when it comes to New York City, this major hub, JFK. Are you expecting more airlines to pull back some routes?
I think international is the region we're going to watch the most. So to put it in perspective, in terms of domestic is very important. Delta had previously $7.35 of EPS. Every 1 point of domestic pricing is about 85 cents to EPS. Internationally, every 1 point of pricing is maybe 20 cents. Internationally is still holding up, but what we're seeing there in the second half and into in Q2 and the second half is actually a decent amount of capacity, whether it's Delta, whether it's United, whether it's American. Capacity is up mid-single digits, up 4%. So if you have a lot of capacity, not a lot of demand, what happens? Your price gets cut. So Atlantic is still holding up strong in Q2. They're fairly well booked into April. I think 90% booked in April, 60% booked in May, and 40% in June. And that's system-wide, so internationally would be better than that. So right now, international is still holding up. But again, that's a longer sales cycle, probably 90 days instead of 30 days for the domestic side.
Sheila, appreciate your time. Thanks for jumping on. Busy morning for you, I'm sure. Sheila Kohli there of Jefferies. The latest on Delta as they pull their guidance. That stock is positive for now in the pre-market by around about 1%. The big headline this hour, though, escalation. It comes from China. China turning around and putting 84% tariffs on U.S. goods in response to major tariffs from the United States overnight. Equity futures this morning, near session lows, down by 2% on the S&P, negative 1.8% on the NASDAQ. In the bond market, this move continues. Bond yields higher across the curve, up by 12 basis points on 10s. On 30s, up by 12 to 4.88. The headline that we're getting from the Treasury Secretary in the last few moments, speaking to the American media a little bit earlier this hour, saying this on the tariffs. This escalation is a loser for them. Turning around, the Treasury Secretary saying it's unfortunate. The first response from the administration following those tariffs this morning.
Where's the off-ramp? Are we seeing it in these comments? Not necessarily. From President Trump, is he really going to back down when he's talked about going in harder? This really is becoming a tit-for-tat of retaliation, and the ripple effects not only for some of the exports from China to the United States, but also U.S. companies that rely on Chinese sales. How significant will that be?
What Scott Bessent told to me, the Treasury Secretary, after Liberation Day was that this is a cap. Do not retaliate, and potentially we could bring your tariff rate lower. We heard that again from Jamieson Greer yesterday, speaking into the Senate. So I'm not surprised that Treasury Secretary Scott Bessent is coming out today and saying this is unfortunate, because what they wanted to see was cool heads to prevail, so they would have these windows of opportunities to strike deals.
We said to the Commerce Secretary only a few weeks ago, just last week, he came on the programme and we turned around to him and asked, are you underestimating or misestimating the amount of leverage that you have over China? Because they're not coming to the table. They're not coming to the table. In fact, they're retaliating. Now, I think overnight we saw some comments and people thought that maybe they were ready for talks. But based on that headline, that's not what this president's been asking for at all.
No, they're retaliating. And they're not just retaliating with tariffs. They're also putting more American companies on the entity list. They're going after export controls. You know what else they're doing? They are having outreach with European leaders. Ursula von der Leyen yesterday, the Spanish Prime Minister today. Xi Jinping will be making a trip to Cambodia and Vietnam later this week. They are trying to shore up regional allies and the Europeans to say, look, if the walls go up and you can no longer do deals with the United States, we will be your safe haven. We will be a place that you can still do business with and trade.
Speaking of safe havens, can we pull up the bond board again? 2-year, 10-year, 30-year. Bonds are not acting as a haven right now. Lisa has talked about this repeatedly so far this morning. Speaking of the Treasury Secretary, later on this afternoon, he is going to be very focused, Lisa, on what you're focused on every single week. The supply coming from the Treasury, $39 billion of 10-year notes.
This has the potential to be quite messy. A lot of people have been talking about that. A lot of banks are trying to pull back on risk. So if they are forced to bid on these auctions, they are going to be shorting treasuries elsewhere to offset that potential exposure. There isn't the absorption capacity that a lot of people were expecting. So yes, it could be basis trades unwinding. Yes, it could be foreign selling. Yes, it could be just simply a lack of buying. But you add $39 billion of supply to this, it becomes a real potential note of concern.
We add another 12 basis points to a 10-year Treasury yield. We're through 440 this morning at 441 on 30s, getting closer and closer to 490 at 488. A lot to get through. A lot to get through this morning. Let's get to it. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Ankara is withdrawing its director nominations for U.S. Steel's 2025 annual meeting. The firm citing reports that Nippon could be gaining support from the Trump administration for its takeover bid of U.S. Steel for $55 per share. Monday, Ankara unveiled a plan to jumpstart U.S. Steel and nearly double the stock price to $75 per share. A former Meta executive plans to testify before Congress that the company briefed the Chinese Communist Party on emerging technologies, including AI. The corporate whistleblower alleges that Meta aimed to help China outcompete American companies. Meta, for its part, denies the claims. Elsewhere, demand for used gold Rolex watches is on the rise. Gold prices have, in turn, risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces climbing the most places up since the index was launched in 2022. And that's your brief. John.
Hey, Danny, thank you. More from Danny later on in the hour. Up next on the program, betting on the Fed put.
If it's foreign selling, we could go towards 450. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning.
Up next on the program, we'll catch up with Tony Rodriguez of Nuveen from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
In case you missed it on Balance of Power.
The statute governing the FTC
says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Waking up with a cup of escalation this morning from China, raising tariffs on U.S. goods to 84%. The bond market offering no comfort at all. Yields are higher across the curve, up by 8 at the front end. On a 10-year, up by almost 13. On 30s, up by 11, 488. Under surveillance this morning, betting on the Fed put.
Heading into Liberation Day, we thought that last week would be the week of peak uncertainty. It was not. I'm not a believer that the price or yield that you see is a reflection of market expectations. It's a reflection of that marginal buyer or seller. If it's foreign selling, we could go towards 450 if it is. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning. It is one of their roles. So for that reason, we believe in US 10s at 420 to 450 is a buying level.
Here's the latest this morning. The Fed isn't racing to step in, and the bond market is offering very little comfort. Tony Rodriguez of Nuveen writing, we forecast the 10-year yield at 4% for year-end, though we expect volatility to remain elevated and for the trading band to remain wide in the near term. Tony joins us now for more. Tony, good morning.
Good morning. Good to be with you.
Let's get straight to that bond board. It's good to see you. Yields are up across the curve. Why are they up across the curve by double-digit basis points on 10s, on 30s?
Well, there's a lot of reasons that people are providing. In our view, there's a couple of main ones. Inflation, number one. Inflation is going to be significantly higher than we had expected prior to these latest rounds of tariff increases. And obviously, that's very negative. Number two, the inflation hit is up front. The growth drag is a little more delayed. So we don't expect to see any kind of rally in rates until we start actually seeing the hard data begin to reflect the slowdown. You also have, in our minds, foreigners that are backing away from the market, less confidence in the dollar, less confidence in U.S. policy, so you get that. And the third thing is the leverage unwind. With these kinds of moves and this kind of volatility, everyone is lowering their leverage. A lot of basis trades people talk about, et cetera. You're seeing that. So I think there's a bunch of factors, but they're all pointing in the same direction. And there's no offset, like you would say, well, maybe the Fed will step in. There's nothing for the Fed to step in for yet.
We'll get to the Fed in a second. Earlier this year, there was the Besant put. Everybody said don't bet against the Treasury Secretary, who was saying that he was targeting 10-year yields and wanted to see them lower. Is the Besant put dead?
Yeah, I don't know if the best input ever really existed because I don't know what policies they had set up in order to drive those yields lower. This best input is related to an economic collapse from tariffs that are, 50%, 100%, et cetera. So you might get what you want, but you get it for the wrong reason. So we don't think the best input is there. Right now, the tariff policy is really the main driver because that's what's impacting inflation and that's what's impacting the medium-term growth hit, which is why you're seeing all the selling in equity markets, for example.
Not to get too existential, but what is your confidence level that in the case of a real growth slowdown or even a contraction, that treasuries would be the haven bet, that you would get a massive bid in, that yields would go substantially lower? Because if the U.S. wanted to give some fiscal support to this economy to get it out of some sort of recession, its hands are a bit more tied than it has been in the past.
Absolutely. So the ability to respond to that slowdown is very challenging, which is why we think growth, while we're not yet forecasting recession, we're forecasting 0.5% growth if we stay with tariffs that are around this level or even move back to tariffs that are, let's call it, around half of current levels. If we stay at these levels for the balance of the year, then we tip into a recession call as well. And in that environment, because it's driven by U.S. policy, kind of that self-inflicted wound, then it is possible that treasuries won't provide that haven. You won't see as much of a rally. You'll still see, we think, yields decline, but they won't decline to levels that would be typical in a more market-driven, economic shock rather than a policy-driven, self-inflicted wound.
Tony, let's just recap these headlines from Secretary Bessent again. He's speaking a little bit earlier this morning, and this is what he said. What he sees in the bond market, normal deleveraging in the bond market, nothing systemic. There's a word that was thrown around going into the weekend. I threw it around too, orderly. What's the difference between orderly and disorderly, and how close are we to the latter and not the former, given the moves we've seen in the past few days?
Yeah, I'd say we're still on the orderly side. And the main difference in our minds between the two is when you have a financial accident. You have a leveraged fund that basically goes under. You have, for example, if you look at cross-currency swap spreads, they blow out. You look at short-term funding markets, they implode and, for example, seize up. We're not seeing that yet. We're seeing all of the initial steps in that direction. So certainly the markets are challenged. They're not quite crossing over the line into disorderly yet. But with every day that we see continued volatility, continued escalation in tariffs, I think we get a lot closer to going across that line. That's when the Fed might begin to be able to step in.
Not to put words in anyone's mouth then, isn't the Treasury Secretary basically telling the Federal Reserve there's nothing to see here?
Yes.
There's nothing disorderly to step in and fix. That's the message from the Treasury Secretary this morning based on these comments. Nothing systemic, normal deleveraging in the bond market. So if he's saying there's not a problem, why would the Fed step in? For market functioning reasons.
And what exactly could they do? If they cut rates on the short end, would that actually help or hurt the long end? Deutsche Bank's George Saravellos came out this morning and said if recent disruption in the U.S. Treasury market continues, we see no other option but for the Fed to step in with emergency purchases of U.S. Treasuries. Talk about kind of what the Bank of England did back with Liz Truss back in 2022.
Certainly got echoes of that. Tony, just a final thought. What do you do from here? What's your approach to this market?
Yeah, so tremendous uncertainty, so you need to be more conservatively positioned than you were. You need to have more cash, right? So liquidity is paramount in this kind of environment to be able to take advantage eventually of a dislocation. And you need to be following the metrics that will indicate whether there's any kind of backing off. We don't see that right now from any foreigner. Like China's not going to step up to the table in our minds. They're watching what's occurring, and really that's applying very little pressure. The more they wait, maybe the uglier things get, and all of a sudden the leverage shifts a bit. So we think we're going to be in this period for quite some time.
Tony, it's good to see you. Thanks for breaking things down for us. Tony Rodriguez there of Nuveen. Breaking down this bond market. This bond market's breaking down. Yields are higher by 14 basis points. The 10-year 4.43. Twos are up by 7. At the front end of the curve, 3.80. And the equity market's rolling over as well. Equity futures on the S&P negative by 1.9%. The third hour of Bloomberg Surveillance is just around the corner. Your lineup looks like this. We'll catch up with Richard Bernstein of Richard Bernstein Advisors. We'll speak to Ryan Peterson of Flexport, Sarah Wolf of Morgan Stanley, and Rusha Sharma of Rockefeller International from New York City. This is Bloomberg.
If I want to go to use an ATM and I have a Bank of America ATM card, but I don't see any Bank of America ATMs, I go to some other bank ATM, I pay a fee. Is that it?
You wouldn't, David, because you're...
What?
You wouldn't, but other people might.
I thought you had to pay a fee, I mean, is that a profit center for banks, those fees? Or?
No. You know, at the end of the day, we get 55% of our revenue, our $100 billion of revenue last year, 55% came from interest, 45% came from fees. The dominant part of those fees are trading revenue and asset management fees and things like that. We have consumer fees, but they've come down dramatically because basically we said to the consumer is, you keep changing your behavior, we keep driving down the cost to serve, and we'll give that back by lower and lower fee structure.
Do you think we will have in our collective lifetime no more currency, everything will be digital, or you think that's not likely?
Not in our lifetime.
What about a digital currency, which doesn't preclude other things, but a digital currency?
It's pretty clear there's going to be a stable coin, which is going to be a fully dollar-backed, type of thing, which is no different than a money market fund with check access, is no different than a bank account, really. And so, if they make that legal, we'll go into that business. So you'll have a Bank of America coin and a Bank of America and a U.S. dollar deposit, and we'll be able to move them back and forth.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Most market participants are not expecting tariffs to last longer than a couple of months.
There are some longer-term positives if we can potentially negotiate some with these tariffs.
The one clear conclusion from tariffs is that they are U.S. growth negative.
All these things really aren't sustainable in the long term.
If the full expected tariffs come through, that would likely trigger a recession.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, 90 minutes away from the opening bell, and we've got some escalation to talk about. Major tariffs go on overnight on the rest of the world from the United States of America. Equity futures gapping lower going into that opening bell as China responds. China retaliates. Here's your escalation. 84% tariffs on U.S. goods. Equities down across the board. On the Nasdaq, we're lower by 1.6. On the Russell, we're down by 2.6. In the bond market, no comfort provided whatsoever. Yields are higher across the curve, up by 8 basis basis points on 2s, up by 16 on 10s, 445 on 30s, approaching 5%, 491 this morning. And later on this afternoon, we've got some bond supply for you, 1 p.m. Eastern time. This is the number for the 10-year auction, almost $40 billion of 10-year debt coming to market. The Treasury Secretary, Scott Bessent, speaking this morning, saying it's normal deleveraging in the bond market, nothing systemic.
Well, there is something systemically that is a bit awry or making people deeply uncomfortable. It's that bond markets are not providing a haven right now. They have not been the market of choice, even as you see German 10-year yields go lower, as well as French 10-year yields, and you pick your domestic market of choice. You're also seeing gold that now is rebounding, but the dollar also weakening. So all of these haven trades are no longer functioning at a time when so many people are wondering, what is the new world order going to look like?
Well, this is what the president would like it to look like. He spoke a little bit early this morning, posted on social media. This is a great time to move your company into the United States. Don't wait. Do it now.
But companies are waiting on the sidelines. It's paralysis. They want certainty. And what have we heard from every single guest today? We're at almost peak uncertainty. We don't know what the next steps are. We are still sitting around the table today and questioning, is this a negotiation? And the Treasury Secretary earlier this morning saying that actually it's exciting because you have places like Vietnam coming today for negotiations. They're excited to start negotiations with Japan. At the same time, we are in a serious escalation when it comes to Beijing.
To engineer that supply-side response that you're talking about, to engineer that supply-side response, you need to believe these are the new rules of the game. And as long as you go around talking about negotiating, companies will just sit there and do nothing. They're not going to build that factory until they know for sure those tariffs aren't going away.
There is a maturity mismatch, as that one viewer yesterday wrote into you, in terms of the near-term impact of tariffs versus the long-term response of possibly building out factories. Look, right now, as the president tries to negotiate, it seems like the market is giving it less leverage to move, given the fact that the market is saying that companies are going to suffer. You're seeing Walmart coming out and saying they're going to invest in price, i.e. have smaller margins as they try to maneuver through this. And you have Delta saying that they are going to cut capital expenditures as they batten down the hatches to deal with this uncertainty.
It's another morning facing the same question. We've said this on this program repeatedly. Are these the rules of the game, or can you negotiate? And a pendulum keeps swinging between the two. Every single day, hopes for a deal, fears about tariffs, a headline about equities up or down. Anne-Marie, the underlying trend, and you've been talking about this for weeks now, if not months, the underlying trend is that tariffs are going up. They're higher than they were a week ago, 2 weeks ago, and they keep climbing higher.
And even if there are deals, most people think that no one's going to get a deal below 10%, that baseline they set for every single country on that list, on that board the president came out. So regardless, there will be higher tariffs. But can you have potentially a deal where there's something towards reciprocity? I still think there's potential for that for most countries besides one, and of course that's China.
So seen, equity futures down by 1.8% on the S&P, bond yields higher by 16 basis points. The 10-year, 445. Coming up this hour, we'll catch up with Richard Bernstein of Richard Bernstein Advisors as trade tensions shake up markets worldwide. Ryan Peterson of Flexport as shippers brace for the impact of Trump's tariffs. And we'll speak to Rashesh Sharma of Rockefeller International on why the Fed shouldn't try to save the world. We begin this hour with stocks lower. After 4 days of losses on the S&P 500, Richard Bernstein of Bernstein Advisors writing, the Fed is caught between a rock and a hard place. GDP forecasts are being revised downward, but inflation expectations seem poised to accelerate. Richard joins us now for more. Richard, welcome to the program. You put it in your note. Everyone's got a plan until they get punched in the face. That famous strategist on Wall Street, Mike Tyson. How strong is that punch this morning?
I think the punch is a real. It's not a jab. It's a real roundhouse punch, and I think. John, look, you've been talking a lot about all the different uncertainties and all the different things that are going on. That's fine, but I think one also has to realize that we entered the year with investors historically confident. So this has a magnified effect on investors' confidence that they're being shaken. So that was my point about that everybody has a plan until they get punched in the mouth, because everybody had a plan. They thought it was easy. They thought this was like, oh, let's just buy an index fund or let's buy the Mag 7. And all of a sudden they're realizing that was the unusual period, and now we're going back to something that's much more uncertain, and they're getting punched in the mouth.
Richard, Scott Bessent, Treasury Secretary, speaking with Anne-Marie, our own here, and saying that this then is not necessarily a MAGA problem, it's a MAG 7 problem. Do you agree? Is that basically what you're seeing right now, is the unwind of an overvaluation of a crowded trade at the end of the last year, beginning of this one?
Well, Lisa, I understand where he's going with that question, but my response would be, why is the Russell 2000 underperforming so dramatically here? If it were just a MAG 7 point, why are the most domestically focused companies in America, smaller companies, are underperforming, right? So how is this just a large cap MAGA effect? It's clearly not, or MAG 7 effect, sorry. It's clearly not. I think this is a comment. The markets are making a comment on the broad economy in the United States. And I think also the notion that this is an orderly process, that's fine. I would agree with that. But the process is not a positive one. The markets are not giving a positive verdict on that. And that's kind of what I think people are still sort of missing here.
Richard, how do you navigate a situation like this, where the rules of the road may be called into question over a longer period of time, and asset allocation potentially could look very different if the trends that we're seeing in markets today would hold? So how are you thinking about not just short-term investing, but the 1 year, 2 year, 5 years ahead?
Right. So Lisa, I think in the short term, you're using the word uncertainty. Everybody's using the word uncertainty. I shouldn't personalize it like that. Everybody's using the word uncertainty. So what that means is the scarcity in the marketplace is certainty. That's what will command a premium through time, is certainty. What does that mean? That means quality. That means more certain cash flows. It means dividends. It means really kind of focusing on near-term fundamentals as opposed to long-term growth stories. The second thing is, what do you do for 3 years, 5 years, 10 years, 2 years, whatever? And I think, look, the goal of what's going on, of returning industrial processing back to the United States and manufacturing back to the United States, I think that's a great goal. In fact, we've been talking about it at my firm at Richard Bernstein Advisors for 10 years. I wrote an op-ed in 2011 in the Financial Times about this topic and how important it was. The goal is real. However, the method that they're choosing to try and get to that goal, well, personal opinion here for a second, is incredibly ham-handed. There are many better ways to do it that do not place a tax on the U.S. consumer.
Richard, we heard from one ECB official earlier on this morning that said there's no reason for a rate cut right now. I think he referred to 50 basis point cuts as ridiculous. Mary Daly, the San Francisco Fed president, putting out a post on LinkedIn saying we have the time and space to deliberate our next moves. Lisa, that's what's different about this moment. These officials at these central banks aren't rushing to race in, rushing to step in and provide support like maybe they would have done a number of years ago.
And for the correct reasons, which is this is a very different type of crisis that is not of the credit markets making. This is about policy uncertainty and the potential stagflationary shock that comes along with inflation. If you take a look at 2-year break-even rates, they've actually hit the highest level going back to 2002 earlier this morning. It's shifting around, incredibly volatile markets, but the signal is not so clear in terms of how they should act, let alone if.
Richard, are you thinking about where pockets of leverage might be? This has been a really unusual cycle here in the United States and worldwide because of the support that was offered through the pandemic and through the recovery as well. When you think about where pockets of leverage might be this time around, how do you answer that question?
So, John, it's related to what you and Lisa were just talking about. The Fed was spoiled for many, many years, three decades, by globalization. Globalization was a massive disinflationary force on the U.S. economy. Why? Because we were just increasing competition. And we all know when you increase competition, you put downward pressure on prices. So the Fed could play the hero and ride in on the white horse and save the day. Now what we're seeing is deglobalization. That whole disinflationary process is now being reversed, so it's now an inflationary process. That ties the Fed's hands, and the Fed can't play the hero anymore. And I think that's one of the things that's happening. So where is the pocket of leverage? I don't really know. One could argue that it's in the private market somewhere. because I think that a lot of their returns have been boosted by leverage and the ability to borrow cheaply to make acquisitions. Maybe that's where it is. It's certainly, not going to be, I would argue it's unlikely to be in the big banks. The big banks, for all their whining about over-regulation, big bank balance sheets are pretty strong. It looks like the regulation has worked. But where is that leverage? It's in things like private debt and all of that. So the risk hasn't gone away. It's just moved, I think, from the public markets to the private markets. It's an interesting a monetary and fiscal question is that if there is some kind of problem in the private markets, they're supposed to be private. Will they come to the rescue? I would think they'd be very hesitant to do that.
The Treasury Secretary this morning is saying really nothing to see here. I feel like I'm going to sound like Lisa, but how do you think this bond auction is going to go today for the 10-year?
Well, a little outside my area of expertise. I just don't think – I think what we are seeing is a complete repricing of U.S. assets with a higher risk premium. Right? If you think about it, we've taken about 5, maybe 6 multiple points off the S&P despite good earnings. We're seeing in a very short period of time the 10-year sell-off. But certainly bond volatility has gone up, whether you agree with my statement about the risk premium or not. Certainly bond volatility has gone up. And I think what's happening is U.S. assets are being repriced. You mentioned before about, are we a safe haven anymore? Maybe not. And that's kind of what we're seeing.
I spy the Tottenham emblem right behind you as well, Richard. Super depressing stuff for you, eh? Appreciate the time, as always.
Rough season.
Thank you, sir. Richard Bernstein of Richard Bernstein Advisors. Thank you very much. Equities near session lows on the S&P 500. Difficult moment for this equity market. Just to breathe some life into that conversation on the central bank PERT. Who remembers that news conference in 2020? Christine Lagarde of the ECB. We are not here to close spreads. What does she do later on? Close spreads. Everyone's got a threshold. The difference this time around is that because of the nature of the shock and the potential economic consequences, that threshold might be a whole lot lower than we thought it was for this ECB and likewise for this Federal Reserve.
The other wrinkle in this is that they have to be responding to immediate circumstances. During the pandemic, the entire world just shut down and travel shut down. And suddenly there was this question about supply-demand dynamics that were totally skewed. Right now, companies are not raising the sort of huge 5-alarm siren that you would expect. That is not what we're hearing from Delta. That is not what we're hearing from Walmart. How does the central bank respond to that with data that's still holding in?
I remember when people thought the president would back away at 5,500 on the S&P. And here we are sat at 5K at a close as of yesterday.
He didn't want to answer the question if there was a Trump put, if a threshold still existed. He actually said it was a stupid question, but then went on to say, sometimes you have to give medicine to fix something. This is self-imposed. This is policy medicine from what the president thinks should be fixed when it comes to global realignment. What's the cure to Trump's medicine is the question we're all asking this morning.
Super difficult question to answer. Equity futures at the moment on the S&P negative by 1.8% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just to round up what we have in tariffs at this moment, President Trump's so-called reciprocal tariffs are in effect. That includes a 20% levy against the EU and a historic 104% tariff on China. That follows a 10% baseline tariff for most U.S. trading partners that took effect on Sunday. Now, in retaliation to those moves, China is raising tariffs on imported U.S. goods to 84%. A government statement released over an hour ago said that the countermeasures will come into effect on April 10th. China also said it would sue the U.S. at the WTO and added 6 firms to its unreliable entity list. Elsewhere, Delta Airlines has withdrawn its full-year financial guidance, citing uncertainty surrounding global trade. Shares up about 1/3%. The company said that it will update the outlook later in the year as visibility improves. It also trimmed CapEx and cut its plan for capacity growth to flat for the second half of the year. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Another update from Danny coming up in about 15 minutes' time. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Ryan Peterson of Flexport as shippers brace for the impact of Trump's tariffs and China's retaliation. From New York, this is Bloomberg.
the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Live from New York City, your equity market looks like this. 1 hour and 13 minutes away from the opening bell. Equity futures down across the board. A wild few sessions to start the trading week, that's for sure. We're down by 1.8% on the S&P. On the Nasdaq, we're down by 1.5%. Retaliation from China, 84% tariffs on U.S. goods. After the U.S. slapped major tariffs on the rest of the world overnight, equities are down across the board. That's the price action. Let's get to your morning calls. First up, Jefferies upgrading Apple to hold, expecting a potential tariff exemption for the company, but noting downside risk. That stock is down by 2%. Everyone still thinks, who covers that company, that we'll get that exemption. Let's see if we will. Next up, Benchmark adding Tesla to its best ideas list, saying concerns over declining sales are overblown. That stock is down by 0.7%. And your third and final call comes from Bernstein, downgrading Ford to underperform, seeing significant downside for the stock due to tariffs. That stock is down by another 2.4%. Let's stick with those tariffs. Global shipping taking a major hit. Ryan Peterson of Flexport saying 28% of the customers in a company call last week said they're pausing all ocean freight bookings from Asia until there's more clarity on where tariffs will end up. For a clinic on shipping and a whole lot more, Ryan joins us now for more. Ryan, welcome to the programme, sir. I want to start with a really important question because I think there's tons of confusion out there about this. Help me understand, if a ship is already at sea and has declined, say, a port, has left a port in, say, Asia, and they arrive in a week's time, do they pay the tariff or not?
No, they would not pay these new reciprocal tariffs. The way that it works, I mean, typically throughout history, it's based on when the goods arrive. That's what the duty rate that you pay is. However, with these reciprocal tariffs, they made it so that as long as your ship departed by midnight last night, then you only pay 10%, a 10% additional tariff. It was midnight, April 5th was the deadline to pay no additional tariff. So if the goods have been out there on the water since then there's no tariff. So there was a mad scramble the last few days to get every container into the ports and loaded, and hopefully those ships departed. Hopefully your ship departed by midnight last night.
Yeah, Ryan, could you help us describe that?
That is midnight Eastern time, not local time in Asia.
Interesting. Can you just describe then how that mad rush came about and what that looked like over the last few days?
Yeah, I mean, a lot of containers actually switched to air freight to make sure that they got out on time. There was just this rush. Ocean freight, the goods have to arrive at the port several days before the ship departs. Air freight, you can tend to get to the airport in a matter of hours before the plane leaves. So there was a switch over to air. I read somewhere that Apple chartered 5 747s for iPhones. So, yeah, like a big scramble to get things. Flexport team, we're one of the largest logistics companies and customs brokers in the world, and we had team working all weekend, paying overtime and taking care of people to get to put in extra effort this week for our customers.
So China's getting hit with 104%. Beijing comes back with more than 80% this morning on American imports. You're talking about this mad rush to get product out of China and out of Asian ports. Well, then what happens in a few weeks? Is it a mad halt?
Yeah, I mean, you saw that in the survey result that you posted there from Flexport's customers. We are seeing expecting quite a slowdown based on what customers are telling us. And it's not necessarily that there's 3 possible reasons for this, in my view. Number one is that people knew this date was coming for a long time, and they're well stocked. They imported a lot of inventory ahead of time at the lower duty rates. So that part, they're going to sell through those stocks. 2, as I mentioned in the tweet, there's a lot of uncertainty. I think people believe that tariffs may come down. The White House, the administration has been signaling in all kinds of different ways that they're making deals. Japan, Korea, like a whole bunch of countries have come in and said they would drop U.S. tariffs in exchange for a deal. So if you think duty rates are going to drop from these high levels, then that would make sense. And then the third possibility, and the one that's the most worrisome, is the business model isn't working as well. I mean, people are going to have to raise prices because these tariffs are so high. There's no other choice. And, you know, the one thing we know from economics is if you raise prices, you sell less stuff.
So, Ryan, when do you think that can actually happen? Prices going up?
We've already seen that start to happen. So it's looking like you look at our customers and you check all their e-commerce websites, we're seeing about a 5% increase in price that's already taken place. So even though the tariffs haven't started to get paid, they know it's coming, starting to factor that in. I assume prices will go up even further from there as they, the tariffs actually start getting paid, washed through the system, fed into more of the analytics of these companies.
Ryan, there are a couple of different pieces to this. On one hand, it's the tit-for-tat headline tariff rate. There also is this matter of fees on Chinese-built vessels, which potentially could also add to some of the costs. We're just getting news now from the Wall Street Journal that right now there is a revision to that where the new plan is to base the fees largely on vessel capacity, which could make it a lower fee. But from a broader standpoint, given China's dominance in the vessel creation, building of some of the shipping fleet, how significant would that aspect of some of these new levies be?
Yeah, so that's expected on April 17th is what we're expecting when a new ruling will come out about these fees that have been proposed on Chinese ships. It could potentially catastrophic. I mean, I can kind of overuse that word these days with how brutal the tariffs have been on customers. But the danger here is that they are, and we'll see how the new ruling comes out. I haven't read that Wall Street Journal article yet, but the way that they've been proposed is that it would be a per port call fee. And that would mean that it would create this real incentive for the carriers to skip the smaller ports because then they would pay less fees if they just make one port call at a major port instead of going to the small ports. Today, the ships will tend to, on the West Coast, they'll stop in Seattle, Oakland, LA. They'll make 3 port calls. So if you skip a few of those, obviously really bad for the jobs, both the port workers and the warehouses and everything around there. Very bad for importers and exporters, importantly, that are now having to truck their stuff all the way to LA instead of using the local nearest port to them. And then what you'll see is congestion at the major ports. And we saw that in COVID. LA just can't keep up with that kind of surge in volume. LA, Long Beach will get congested. New York, Houston, those are kind of the major ports on each coast. So you will see a lot of congestion in those ports. So yeah, hopefully they rework that. Looking forward to that. I've been pretty active, pretty vocal on the internet that this is kind of a crazy rule that's going to really hurt America's exporters and be self-defeating.
Ryan, just a final question. Busy week for you. Incredibly busy. How quiet might the rest of the year be?
I hope, we thrive off of this, man. I mean, I don't, normally you don't invite your customs broker on television. So we're enjoying the fact that we get to be more valuable for our customers. Show up, work hard. That's why we work in this industry. It's always pretty exciting, but rough for our customers. We're trying to do everything we can to help them work through this because a lot of their business models have been turned upside down overnight. And yeah, I mean, there are some things that we can do for them, but a lot of it is trying to be as informed as we can be on top of what's happening, and then working on strategies and solutions for them in real time.
Existential for some of them, I'm sure. Ryan, appreciate it. Thanks for making time for us. Ryan Pedersen there of Flexport on the situation at the moment. I'm not sure how many people are aware that was actually how this worked, that it might be a number of weeks before you see that first ship arrive from China that has to pay the tariffs that went on overnight.
Right, because if already you are sitting on the sea, you have a little bit of a window room and you have some space. What I would also say is de minimis. These packages under $800, Shane, Temu, you see these teenagers buying off Instagram. Not only did the Trump administration close that exemption, if you're buying those packages, that tariff went up to 90%.
Those margins are like that. For so many of these companies, what we've seen overnight is truly existential. In the bond market right now, yields are up by 17 basis points on a 10-year. The 10-year at the moment, 4.47. From New York City, this is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to
your retirement account. I cannot say that enough. Set it and forget it.
You need to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s.
Don't miss Open Interest live weekdays.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Getting some corporate reaction this morning. Delta Airlines pulling their guidance for the year ahead. Jamie Dimon at JP Morgan speaking ahead of the earnings release on Friday, speaking to the press here in the United States a little bit early this morning and saying this: a recession is the likely outcome, echoing the views from his economist Mike Ferroli. That announcement coming out over the weekend. That's the base case for that team now. I expect more credit problems. Not seeing defaults yet, but I expect them. That's on the credit cycle. That comes from Jamie Dimon just moments ago, saying this about hedge funds. Lots of deleveraging from other players out there too, not just hedge funds. So that speaks to the bond market moves that we're seeing as well, Lisa, that a lot of people are curious about. If you are just joining us, equity futures on the S&P 500 down across the board here. The opening about 60 minutes away. Bond yields are higher by 15 basis points at the moment. The 10-year 445. The 30-year north of 490, up by 13 basis points on the session so far. Let's get you some morning movers into that opening bell. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, Don. It's also been a really tough morning for the pharmaceutical stocks, with yesterday, last night, Trump saying the announcement would soon come on tariffs on the pharmaceutical sector. BMO writing that this shatters the illusion of safety that many had believed because sectors weren't included in that initial tariff announcement from the White House on Liberation Day. Maybe they would be spared. It seems not so. Pfizer shares dropping 4.4% to the pre-market. If they hold at this level and close at this level, it would be their lowest price since 2016. Now, you mentioned the earnings. Let's just quickly go through those because we got one playbook from Delta. Those shares up about 1/3%, scrapping their full year guidance, saying that there's too much uncertainty to do so, and we will update you once we do have that certainty. Also going further to say we're controlling the things that are in our control, and that is margin and cash flow. So they're cutting their CapEx. They're reducing their capacity for the year. Ed Bastian, the CEO, may be on the bright side, saying this isn't COVID, this isn't bleak, this is just uncertainty. We also heard from Walmart, too. They, on the other hand, are keeping their guidance, both for this current quarter and the fiscal year of 2026. Now, the one area you do see tariffs come into it, they've widened that potential outcomes for operating income for this quarter to account for tariffs, but those shares down about 0.9%. John, they will report their earnings on May 15th.
Hey, Danny, thank you. The latest on Walmart there. The stock is down by about 1%. Easy to forget, but in the next 24 hours, you'll get CPI. You get CPI and PPI as well. Get some Fed speak, too. Mike McKee can break it down for you. Mike, based on the Fed communication so far, they're not racing in.
No, they're not racing in. The Fed is keeping an eye on what's going on in the markets, but they want to make sure that the trades go through, that there isn't a disruption to market functioning. The fact that we're seeing volatility isn't going to make them happy, but it's not going to make them too concerned at this point. I've been talking to a lot of people in the markets this morning who basically say as U.S. markets open, it doesn't look as bad from a systemic point of view as it might when you're just looking at the price action. Futures trading for treasuries has been relatively calm, and we're not seeing big dislocations from a lot of people. So we have to keep an eye on what the Fed is doing today, but it doesn't look like there is an immediate need to step in. Now, Ian Lingen from BMO pointing out in his note this morning that we have a 10-year auction this afternoon after yesterday's bad 3-year. If we get a bad 10-year, especially signs that foreigners are not buying, then that could set off a significant market reaction. So things to keep an eye on.
Mike McKee, appreciate the update, sir. The breakdown of what to look for, not just the data and the Fed speak, but also that auction coming up a little bit later. I said it last week, that one morning you'd come in with equities down and down hard and bond yields were up. That was going to be the morning that would concern me. And I think it is concerning to see these moves in 10-year Treasury yields. Up 16 basis points.
It's concerning a lot of people, and there's a question of what happens to this bond market if there is a failed auction or some sort of catastrophic outcome, and that's clearly gotten people concerned.
The Treasury Secretary, Scott Bessent, speaking at the moment at the American Bankers Association Summit down in Washington, D.C. When we get some headlines from that, we'll share them with you. But this is the man to watch right now. He's pushing the idea that you can negotiate some of this, but at the moment we're just seeing escalation, particularly between the United States and China. Sarah Wolf of Morgan Stanley writes, we revise our outlook for the U.S. economy in the direction of even slower growth and a sharp firming of inflation. Sarah joins us now for more. Sarah, good morning.
Good morning.
Does that constrain the Federal Reserve?
Puts the Fed in a very tricky position. They're going to be on this wait-and-see hold. We're getting the FOMC minutes later today. Likely going to be a non-event. Chair Powell made it pretty clear on Friday that he's highly attentive to the outlook, but they're not going to move until they get some deterioration in the hard data. The soft data is not enough. So what gets the Fed to move by more? Markets are now pricing in over 4 cuts for this year. It's financial conditions. We're talking about the deleveraging that we saw yesterday. Credit spreads are widening a bit. There's a little bit of concern about what's happening in the private credit market as well. And so I think the Fed's going to be very highly attuned to how the financial plumbing plays out, and that could be what gets the Fed to move.
We've mentioned it a few times, that period back in 2018, in December 2018, when high-yield credit really started to break down, spreads started to widen aggressively, and issuance completely froze. The Fed did step in. Are you seeing parallels to this moment, or are they constrained by the inflation story in a way now that they weren't back then?
They're definitely more constrained today, right? I mean, we were dealing with 1.5% inflation in 2018, so it was much easier for the Fed to be delivering cuts. They already were ready to be a bit more on an easing bias. Right now, the Fed is treading a very fine line where they're worried that long-run inflation expectations are going to be drifting higher with growth slowing down. It's a very tricky position for the Fed. But at the same time, if you have some type of liquidity issue, that's what could really start to cause the economy to tumble very fast. And so you see that the Fed will be very focused on the hard data when they can be, but then be very focused on financial conditions when they need to be. So we could start to see a little bit of a shift in Fed communication if financial conditions continue to deteriorate.
How much is an offset potentially of lower oil prices, given the fact that people are so worried about pricing pressure, and that this is a huge tailwind potentially if oil prices are going the lowest since 2021?
Yeah, I mean, oil prices are a tax on households if they go up, and they provide quite a bit of relief on the way down. And when we think about who's getting hit the hardest by tariffs, it's lower middle income households, and that's where gas prices matter the most. And so we do see that lower gas prices are going to free up some discretionary spending for these low income households. But at the same time, the fear is still there, and the price increases that we're going to see from tariffs across broad goods and maybe even trickling into the services sector in the medium run is really going to win the day over gas prices. So we might be getting a little bit of alleviation right now. But we've done some work on price sensitivity, income sensitivity, and households are going to be pulling back on durable goods.
Even the high-end consumer?
Even high-end. We're seeing it already with consumer financial expectations for high-end consumers has fallen more than lower and middle-income households. Think about the wealth effect. We've seen a $10 trillion loss in wealth over the past couple of weeks. That has a really significant impact on how high-income households feel. And it's not even the loss of wealth. It's the volatility. It's the uncertainty. Where are we going from here? What is going to cause markets to start to calm down? And I do think that even though tariffs are really hurting the good side of the economy, it's the wealth effect that will start to bleed into the services side of the economy. And we see that things like air travel, package tours, hotels, those are the sectors that take a hit.
Payrolls came out on Friday. They were decent. They were fine. A lot of people said it doesn't matter. They're going to get worse. That seemed to be the response that we had on this programme. Perhaps they're right. Maybe they're wrong. I don't know. But when we get CPI and PPI over the next few days, are we going to have a similar response to that data?
I do think there's a little bit of a dismissal of the incoming data because it's not incorporating the impact of these new policies. There was barely a peep on Friday after a strong payroll report. I think what we know, though, is that some of the weakness that we're getting in the GDP numbers for the first quarter are likely overstated because of some of the payback in January and February from strong holiday sales, from weather-related events. And so payrolls are showing that we're starting on stronger footing than people thought, right? So maybe we have a little bit more room to fall before we actually hit a recession. But I think at the same time, markets don't really care. Right? We're waiting on when the federal layoffs really start to bleed into payrolls. We're waiting for tariffs to start to weigh on businesses, CapEx, and hiring plans. That's all yet to come. And so similar to Friday, I think there's going to be a little bit of a dismissal of the inflation data that we get over the next couple of days.
Are markets getting ahead of themselves? Are people pricing in the worst case scenario and not accounting for some of the offsets that a growing number of companies are coming up with, whether it's getting around some of the tariff plans in a lot of different creative ways, whether it's offsetting some of the margin, some of the increase potentially in price with margin reductions, trying to capture market share. I mean, a whole host of things that could potentially offset how much of a shock this is to the broader economy.
Yeah, I do think that there's possible upside scenarios. I mean, financials are a good example of this, where deregulation will eventually start to benefit financials, and capital market activity will start to come back online. So maybe something like financials is being overly punished by some of the medium-term volatility and news that are coming in. But when I think about longer run, what the stock market is really reacting to is just what is the game plan? Are we trying to raise revenues through tariffs to offset tax cuts? That means tariffs are here to stay. Are we trying to open up global trade, and so tariffs are going to go down to zero? That's a huge upside scenario. Or are we trying to stimulate business investment in the U.S., so tariffs are really just for negotiating? And I think, businesses could try to find these loopholes. We saw it during the 2018-2019 trade war. But until we have real clarity about what the end goal is for this tariff policy, it's going to be very difficult to see a meaningful recovery in markets.
Sarah, appreciate your time. It's good to see you. Sarah Wolf there of Morgan Stanley, breaking down the latest and looking ahead to that CPI and PPI data later on this week. Equity futures on the S&P down across the board. We're down 2% on the S&P 500. On the Nasdaq, we're down by 1.8. On the Russell, by 2.7. In the bond market, not a source of comfort. Bond yields at the moment up another 15 basis points on a 10-year, of 14 on 30s. The headline of the morning so far. The tariffs go on overnight, as expected. The retaliation from China, raising tariffs on U.S. goods to 84%. To discuss, I'm pleased to say that joining us now is Risha Sharma of Rockefeller International. Risha, welcome to the program, sir. We are trying to work out what this Federal Reserve should do. Should the policymakers be stepping in and providing support, or should they watch and wait to see how this plays out?
Well, I don't think there's any case for the Fed to cut interest rates given its dual mandate just now, because as I wrote in my FT op-ed this Monday, which is that the Fed has missed its inflation target for 5 years in a row. It will do so again this year and the year after that, and possibly won't get to the target now for the next couple of years, even if it does nothing at this stage. And inflation is a big concern for Americans, and the rise in consumer prices over the last 5 to 6 years has been such that it has offset the entire undershoot of the 2% inflation target that we had last decade. So if you go back to the year 2000, over the last 25 years now, what you will see is that over that time period, consumer prices today are higher by about 16% than they would have been had the Fed been meeting its 2% inflation target over the last 25 years. So that's a serious miss on inflation, and I think it's aware of that. And given the fact that some inflation expectations are already elevated, to add fuel to that fire would be a mistake. So I think that the Fed needs to be true to its mandate, and it needs to sort of, at the very least, watch. And so far, there's been no evidence that its policy has been overly restrictive.
The pushback that I've heard over the past week, and I'd love your response to it, goes a little something like this. They should focus on the downside risk to growth and not the upside risk to inflation, because anxiety around the labour market is so much higher. We don't have sufficient tightness in the labour market that would drive those second-round effects, higher wages, etc. What would you say back to that?
Well, this has been the same easy money crowd which has been, which is always calling for lower interest rates. So I think that that's been the real problem. One of the basic problems of the U.S. economy is that it's been fed on a diet of easy money for far too long, whether it's monetary policy or fiscal policy. And I think that's coming back to bite the U.S. And what's happening today is a demonstration of that, which is that I can't remember seeing a day in my memory where on the U.S. markets, all three major indicators are down: U.S. stocks, U.S. bonds, and the U.S. dollar. So there's a real loss of confidence happening here as far as the U.S. is concerned. This is almost like the kind of scene that I see in emerging markets, where you see cross assets declining together like this. And in emerging markets, I don't think any central bank would think about cutting interest rates in such an environment.
Do you think that we're getting a little ahead of ourselves with trying to give a narrative to the move in markets right now, given that there are basis trades unwinding and hedge funds that are deleveraging?
Well, it's still unprecedented. I agree that there's nothing that sort of extraordinary going on. If you look at the scenes we have seen in 2008, that kind of market panic, we are far from that. But we don't want to get to that point. So I think that the whole issue here is the fact that let's acknowledge that we have seen a very unusual move in asset prices, and that this accident, in a way, was waiting to happen. As you know, that at the end of last year, I had sort of called this the mother of all bubbles, this American exceptionalism trade where everybody was flooding into the American market as if there was no other market in the world to invest in. 80% of all equity market flows around the world this decade went into just America. So it's this big unwind taking place, I think, of that bubble. Now, you can argue that it would have happened regardless of Trump and tariffs, but his moves have obviously precipitated this. But as someone put it, that the air is coming out of that balloon, but that air was put in the balloon before that. And as I've argued in the past, the combination of very easy monetary and fiscal policies is what has got us into this place today.
How much further does it have to go then, if that's the theory that, yes, this is partly because of what's going on right now with policy uncertainty and the actual policies being put in place, but it also has to do with the buildup over so many years that you call a bubble. How much further do we have to go to create a level that you feel more comfortable investing in?
Well, I think that this marks a major regime shift, which is that the U.S. market had outperformed the rest of the world for 15 years, as you know. And in the last couple of years, that reached what we call a parabolic stage, where it just went completely vertical, where U.S. markets totally disconnected from the rest of the world. They, in fact, were sucking capital out from the rest of the world. So I think that this has many years to go, that what we're seeing today is the opening act of this major trend reversal in capital flows. But this is a multi-year trend. That people love to say that don't bet against America. The American stock market eventually always comes back and has been a great performer over very long stretches of time. All true. But if you look at those very long stretches of time, which go back to the year 1900 when we have data, that the U.S. stock market in 6 of the past 11 decades has in fact underperformed the rest of the world. And we've just had a 15-year incredible spell of U.S. market outperformance, with both the dollar doing well and the U.S. stock market doing well. I suspect for at least the rest of the decade, both the dollar and the U.S. stock market to significantly underperform the rest of the world. So I think that this is a regime shift precipitated by what Trump is doing, but something which predates him.
In this regime shift, do you think we need to start worrying about potentially a firm blowing up like Melvin Capital Management did in 2022?
Well, I think, there is a lot of leverage out there which we'll only know about when this happens. Like, what are the marks today for private credit, for example? Have they, started marking their assets down or not? Private equity. So I think that there is a lot of follow-through action that we have to see. What we've seen so far is only in the public markets. My concern is that the longer this lasts, which I think it could, then you have to sort of start marking down private assets, and then we have to see what really happens, because that's where a lot of the buildup in excesses has taken place. So I think that, yes, we are going to find out where all the leverage is. And that's what the Fed should be doing now. It should be out there looking at where will this stress emerge of this big decline in public markets, because so much of the froth and so much of the excesses are lying in the private markets outside of the regular eye.
Second time we've heard that this morning. Risha Sharma of Rockefeller International. Risha, appreciate your time, sir. Thank you very much. The dash for cash. Jefferies this morning. Treasury market volatility is intensifying. It's starting to resemble the spring 2020 dash for cash. It's never a good sign. That's what we're seeing right now off the back of just extreme risk aversion driven by uncertainty around the U.S. economy.
Sell what you can, not what you want. That is not what you want to see. And that was what spurred the Fed to really come in a big way back in 2020. This is a different type of shock, and it's not clear exactly how much ammunition they have.
Bond yields up again this morning by 14 basis points on a 10-year and a 30-year yield. The 30-year this morning, 490 in the equity market on the S&P 500 at the moment. Equities are declining across the board here. On the S&P, we're down by 1.5%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Oil is sinking to a 4-year low. Brent and NYMEX futures both below $60 a barrel for the first time since 2021. President Trump's tariffs are forcing analysts and traders to rethink demand outlooks. Both Goldman Sachs and Morgan Stanley have at least halved their outlook for oil consumption growth this year. The Wall Street Journal reporting moments ago that the Trump administration is revising its plan to impose port fees on Chinese-built vessels. The new plan will base fees on vessel capacity, resulting in lower fees for smaller ships. U.S. Trade Representative Jamieson Greer told the Senate that the revisions are based on public feedback. A former Meta executive plans to testify before Congress that the company briefed the Chinese Communist Party on emerging technologies, including AI. Meta has denied the claims, writing in a statement, Mark Zuckerberg was public about our interest in offering our services in China, and details were widely reported beginning over a decade ago. The fact is, we do not operate in China today. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Great work this morning, as always. Up next on a programme, we'll set you up for the day ahead. From New York, you're watching Bloomberg TV.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Equities at the moment negative across the board, recovering somewhat though as we work our way towards the opening bound. We're down 1% on the S&P. On the Nasdaq we're down by 0.6. On the Russell we're down by 1.7. Your day and week ahead looks like this. Later on this afternoon, 1 p.m. the Treasury auctioning $39 billion of 10-year notes. Look out for that because yields are up at the moment by 16 basis points. Then later, Fed minutes. Then at 2:30, the President signing more executive orders. Tomorrow, CPI, plus another round of jobless claims. On Friday, PPI and new Mitch sentiment. Plus, earnings season continues. The banks, JP Morgan, Wells Fargo, Morgan Stanley, all reporting on Friday morning. Joining us now from the nation's capital is Tyler Kendall. Tyler, welcome back to the program. So, big action overnight. Big retaliation from China. How is the administration responding to that snapback from China?
Yeah, hey, John. Well, Treasury Secretary Scott Bessent, in an interview a little while ago, said that he was confident that the trade dispute with China could be reached at the highest of levels. He said that President Trump has a good working relationship with Xi Jinping, though we should note that there hasn't been a call between the two leaders since President Trump was inaugurated. And just yesterday, President Trump said that he was waiting for a phone call from Beijing. Importantly, though, Bessent went on to say that everything is on the table when it comes to China. When asked if the U.S. would go as far as removing some Chinese companies from U.S. exchanges, he didn't rule it out and went on to talk about the potential need for more export capital controls. Now, I will add that we did potentially see a shift even more towards the optimistic, not necessarily with China, but with some other trade deals. The secretary said to expect a, quote, rapid succession of deals. He named Japan, South Korea, India, and the U.K. as countries that this White House is all engaging with.
Tyler, I appreciate the update. Tyler Kendall down in Washington, D.C. Look out for more coverage from Washington, D.C. with Tyler throughout today. This from the Treasury Secretary just moments ago. There is a little uncertainty about the economy. Still, we are in pretty good shape. The message from the Treasury Secretary this morning.
Well, I would say there's a lot more uncertainty about the economy, and that is stemming from policy in Washington, D.C., and it depends who you ask in the administration. Me, Josh Ringgrove, Saleha Mohsen have a story out today that actually Peter Navarro wanted it to be even more aggressive when it came to these tariffs. Depends on who you talk to that is surrounding the president on potentially where this is going to go. Negotiation or new rules of the road.
A little uncertainty. I think a lot of people might disagree in markets right now. It seems like uncertainty. You cannot overstate that. The commentary from CEOs is getting more pointed. And I think that that is marking a shift after they remained on the sidelines for a long time. Jamie Dimon in comments earlier this morning talking about the probability that a recession is a likely outcome and saying that he has put some headcount controls in place, not yet forcing cuts to the workforce, but reflecting that this will cause credit problems. They have lost a few deals to potentially local businesses. You're just hearing a little bit more detail from some of those executives.
Bracing for another wild day in financial markets. Equities recovering just a touch, still lower by 0.8% on the S&P 500. The bond market is not recovering just yet. Bond yields are higher by 15 basis points on a 10-year maturity. Coming up tomorrow, we'll catch up with Russ Kostrick of BlackRock, Stuart Kaiser of Citi, Wally Adeyemo, the former Deputy Treasury Secretary under President Biden, and Erica Najarian of UBS, looking ahead to those bank earnings on Friday. CPI is just around the corner, more volatility, I'm sure. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
In the world of real estate,
which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco. And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. Our lives are migrating online, and I think these data centers are a critical part of that infrastructure. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant.
In case you missed it, on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way, faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline, or trying to send one out. You can transfer millions and millions and millions of dollars worth of Bitcoin overseas, while having a glass of wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, it is tariff day. 30 minutes until the S&P 500 opens near bear market territory. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, China raises tariffs on U.S. goods to 84%, sending global stocks further in the red.
As China raises the stakes, crude collapses, forcing analysts and traders to reassess their oil demand outlooks.
And from retailers to airlines, corporate America responds as Trump tariffs kick in. All of that and more coming up. Let's take a look at Delta pulling its outlook due to uncertainty for travel demand. Shares actually a little bit higher right now, Matt Miller.
Yeah, interesting move there. Walmart, on the other hand, reaffirmed its first quarter sales guidance, and you can see the shares are a little bit lower right now.
I'm looking at the pharma industry, another tariff set of stocks to watch. Pharmaceutical stocks plunging after Trump said he will soon add tariffs targeting the sector. Pfizer down 3.6% pre-market. And last night, the president commented on the trade war with China, and this is what he said before Beijing implemented those 84% tariffs on the U.S.
They don't want tariffs on themselves. And it's very simple. We're making deals, and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%.
Let's now get the latest on the White House trade negotiations with Bloomberg's Tyler Kendall. Since we saw that China retaliation here, we also saw Scott Bessent come out and react to them a little bit. How do we know about how the U.S. administration will respond to these newest Chinese tariffs?
Yeah, hey, Shonali, it appears this White House is sort of walking that line between a negotiation and escalation. As you mentioned, we heard from the Treasury Secretary Scott Bessent earlier today in an interview who said that he was confident that the dispute with China could be resolved at the leader level. He said that President Trump and Xi Jinping do have a good working relationship together. We should note, though, that there hasn't been a call between the two leaders since President Trump was inaugurated. And just yesterday, President Trump said that he was waiting for Beijing's call. Importantly, the Treasury Secretary also said that everything is on the table when it comes to the dispute with China. Even when asked, the U.S. would go as far as removing Chinese stocks from U.S. exchanges. He spoke about potentially the need for some more export capital controls there. But I will mention another update that he did give us, which was that he said that we should soon expect a rapid succession of deals, not necessarily with China. He named Japan, South Korea, the UK, and India as countries that the U.S. is currently engaging with as they all try to figure out exactly what this White House wants to see in order to clinch a deal.
Well, let's talk about that a little bit more, Tyler. We've heard from the Treasury Secretary just in the past 10 minutes saying that Europe would cut its own throat by aligning with China. He also said that, to your point, he sees deals with allies, and then the hope is that they can approach China as a group. Who counts as an ally in this situation, and how fickle is that allyship?
Right, that's a great question. And it's actually something that President Trump was asked, and he's previously said that sometimes allies are worse than adversaries when it comes to their tariff barriers against the U.S. President Trump was also asked yesterday whether or not he was concerned about a potential realignment when it comes to the markets around China instead of the U.S., and he brushed it aside. Now, it is important to mention, particularly with these allies that are trying to strike these deals, it is becoming increasingly clear that it is going to take a lot more than just eliminating tariff barriers. That's why we're going to be closely watching, of course, the non-tariff barriers that this White House talks so much about. In fact, you had the USTR Jamison Greer on Capitol Hill yesterday, and he said that his message to countries was if they had any other ideas on how to achieve reciprocity, then the U.S. wants to hear from them, signaling to us that some of these deals might end up getting a little creative, as President Trump says that he's not looking for anything off the rack. He wants to see these all specifically tailored to exactly what these countries can bring to the table, whether that could be energy imports, for example, something that President Trump has floated specifically for the European Union, or those other taxes that we talk about often, such as the VAT or digital services taxes.
All right, Bloomberg's Tyler Kendall in Washington reminding us that we may still have allies. Energy among the most volatile sectors today. Take a look at crude. At one point, it was down 7%. Joining us at the desk is the close team, Alex Steele and Romaine Bostic. So, Alex, you've covered energy for years. What do you make of these moves?
Yeah, it's really bad. It's bad in terms of the price level, but it's the speed, right? So if you're an energy producer, you may not care right away about the actual price, but the speed with which we re-rated $15 in 5 days, that's really brutal and really hard to then make CapEx decisions. We're still keeping the lights on, like we're not at that level where that would be more in the 40s, and obviously the big guys can handle this a lot better than the small guys. But in the Permian, for example, you're looking at break even in about 65. Like we are now below that at this point.
How much worse does it get in the event of a recession? Because we came into this year and energy was supposed to be a huge sector. Yeah. Drill, baby, drill. You're seeing energy one of the worst performers already, even heading into the overnight drop.
I can tell you no one is drill, baby, drilling right now. Period. Full stop. When it comes to how much worse it can get, so Energy Aspects, Emery Descent looked at 1 million barrels of oil a day could be cut from demand due to recession. But you take a look at the futures curve, so CCRV on your terminal, and the curve isn't indicating that yet. The front end of the curve is still higher than just a few months from now. So demand is still okay. It's just the anticipation of losing that demand that's the issue. Remember, Saudi Arabia is also allowing OPEC Plus to put a lot more barrels of oil in the market, particularly when it comes to May. That's on purpose. The Saudis don't want Iran and Kazakhstan to keep cheating, right? So that's on purpose, but that's going to weigh on the price. But it does take away a little bit of that market stability lever from the Saudis.
So Alex Steele covering the energy sector, the global energy sector, very closely. Romaine Bostic, let's talk about a few other industries, because we did hear a little bit from corporate America this morning. Their response so far to the tariffs, Delta and Walmart come to mind.
Yeah, and Delta was a big one. I mean, we talk about what a difference 3 months makes. I want to go back to early in January when Ed Bastian, the CEO of Delta, told investors that he was very confident in the company actually exceeding some of Wall Street's targets for full year revenue and full year profitability. Today, basically saying there is no visibility to stand by by that guidance. And, well, why would it? There was an interesting report out just last week by OAG, which tracks flight data. International inbound travel right now is actually putrid. In fact, we look at inbound travel from the U.S. to Canada, forward bookings down 70% on a year-over-year basis for every month going to September. We had Clint Henderson from the Point Sky on yesterday. He said leisure travel is down as well as business travel is down. And you get a big sense here of why Delta would pull its forecast.
All right, we have Walmart sticking to its forecast in the face of inflation due to tariffs.
That's what they do, Matt. And this is exactly what the CFO said, is it's times like these are when Walmart really does shine. Now, the big question is, how do they do that? They seem to suggest that they are willing to take price, meaning that they're going to absorb the costs and not necessarily pass it on to the consumer. They also made it clear they are going to take some mitigating steps to try to reduce the burden on them. It'll be interesting to see how they manage this, but it's really a tale of two companies right now. One that does typically thrive in economic downturns, and another, the travel industry, that typically struggles.
I want to go back to the other thing we were talking about, pharma in particular.
Yeah,
Katie,
drugs.
I know you watch this really closely. This idea that there are plants in Ireland for some of these companies, and you think about generics as well coming out of the other side of the world. Where are you most concerned or seeing the pain right now?
Well, I mean, right now, everything in the pharma space right now is getting hit. We're talking about huge drops in U.S. pharmaceuticals, huge drops in European pharmaceuticals, huge drop in Asian pharmaceuticals. We talk about global supply chains, and there's been so much focus, Shanali, on the auto sector, but people forget the pharmaceutical sector is so intertwined globally in terms of where things get sourced, where things get produced, and ultimately where things get sold. That's not easy to unravel. And remember, just about a week ago, most people thought that the pharmaceutical sector would be spared from this. But you heard those comments from Trump that you guys just played at that event last night. He seems to be saying they're the next in line here for some sort of tariff or trade remedy. So investors, really, there's not a whole lot of places to hide.
You know what helps? Lower oil prices. Just saying. For all of those stocks.
Can I tell
I'm
you,
just saying.
all day long, she just talks my ear off about oil. Yeah, well, yesterday it was coal, so I got a little reprieve from oil.
Person on the equities market show. So I feel
all right, guys, great roundup as always. That is Romaine Bostick and Alex Steele. You can catch them on the close at 3 p.m., but don't go anywhere right now because we have a market open to get through. You take a look at the futures picture. It's not that bad relative, at least to the past few days. The S&P 500 down about 0.4%. We were looking at pre-market losses of 1.9% earlier, so a little bit better there. Now, coming up, we'll go deeper into Delta, pulling its full-year guidance as uncertainty surrounds global trade. We'll speak to Tom Fitzgerald, TD Cowen Airlines analyst, next. This is Open Interest.
The world's second largest economy with a growing influence in global affairs. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg, the China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why. But we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Let's get now to high interest. Look at what's making headlines around the world. Treasury Secretary Scott Bessent is playing down a sell-off in U.S. Treasuries, saying there's nothing systemic at play, and he's attributing the moves to a normal deleveraging process. Longer-dated Treasuries have borne the brunt of declines in the market for U.S. government bonds in recent days. He is also warning China not to try to devalue its exchange rate in retaliation for U.S. tariff hikes. Citadel Securities is proposing a system that would let it process trades for a large swath of banks. The proposal aims to start with U.S. Treasuries, interest rate swaps, and corporate bonds, and could expand to other markets. Citadel says the system would give it more insight and leverage in the market and would help smaller banks compete with the likes of J.P. Morgan and Goldman Sachs. And Delta Airlines withdrew its full-year financial guidance thanks to uncertainty surrounding global trade. It's a stark sign of the turmoil rippling across corporate America from President Trump's tariffs. Several airlines warned last month the volatility was pressuring domestic travel, and Delta CEO Ed Bastian said he's monitoring if the pullback will bleed into key areas like premium and international demand. Shonali?
Something to watch closely, Matt. We should say that they also still anticipate a profit in 2025, which is why you might see some green in the stock. Let's take a deeper look at Delta. Here with more, Tom Fitzgerald, TD Cowen Airlines analyst. He has a buy rating on the stock with a $45 price target. We have seen Delta take a lot of pain this year, so far down 40%. We have analysts saying that this sector, this airline sector, is really a sign of what's to come with the U.S. consumer and business spend. What is the biggest risk to you at this juncture?
Yeah, for an airline like Delta and the other large legacy carriers, it's that the risk starts spreading to international and premium demand. Those parts of their business held in well in Q1, and they expressed optimism on their performance in 2Q. But if the broader economy starts trending downwards and we see weakness in premium and international, that would be very concerning for Delta's margins and United Americans.
Yeah, it'll be fascinating to see if global demand holds up and for how long. But I want to talk about what we can maybe extrapolate out into the other airlines. Delta, the first U.S. carrier to report earnings, pulling their guidance. That's been the expectation across industries. Tom, when you think about the other carriers who have yet to take the stage, would you expect to see similar guidance pulls from them?
I would, and I think there's a more negative read-through here for some of the other domestically focused carriers, as we expect Delta and the other full-service carriers to compete pretty aggressively for basic economy traffic. So that portends poorly for a Southwest, JetBlue, Frontier, Spirit Airlines, all the domestic leisure carriers.
It looks like, Delta is pulling its guidance, and Ed Bastian says he's on recession footing. He told CNBC, I believe, this morning. However, oil prices, fuel prices are coming down dramatically at the same time as the labor market is softening. Aren't those the two most important cost inputs for an airline like this, for any airline?
They are, a lot of the labor force here is unionized. Less so for Delta, but definitely very much so for the broader industry. So there's a lot of long-term contracts that are underway regardless of the undulations of CPI in the broader economy. But fuel coming down definitely helps. And we expect a lot of airlines to work judiciously to lower cost as we move through the year. We might see a slowdown in maintenance spend as more older aircraft are retired rather than, putting more cash in to keep them operating.
Well, Tom, that's where I wanted to go, because just to meditate on those comments from Ed Bastian a little bit more, he said specifically that they're acting as if we're going into a recession. I was wondering what specifically that means. You mentioned, maybe deferring maintenance costs. Would we expect them to be cutting flights and things along those lines as well?
Absolutely, and that takes a while to play out, but you see it in a couple forms. It could be lower utilization, so flying your planes less hours per day, and it could also just be parking older aircraft. So Delta and United, we've written about this. They have a pretty large amount of aircraft that are 24 years or older. So some of those aircraft that are very long in the tooth, like 30 years or more, those are good candidates to get retired, and that gives them a lot of optionality in this environment. So if demand is better than expected, they can keep them operating. If it's worse, they can send them to the desert. And other levers could also include cutting the worst performing markets, maybe leaving markets entirely, things like that.
I want to go back to something you were saying earlier, Tom, about the premium demand. That would be a big issue if stalled. What would it take to get there? If you look around the economy and are looking for signals that would start to dent demand, even from higher income customers, when does it stop?
Well, the stock market being down is a big indicator. I think the wealth effect has been a positive tailwind for premium demand over the last, in this post-COVID cycle. So if we continue going into a bear market in risk assets broadly, I think you could see that start to bleed into demand. Some of the airlines have talked about baby boomers being a really strong source of demand, especially in the premium cabin. And I would imagine the negative wealth effect to be acutely felt in that age cohort.
Yeah, absolutely. After $10 trillion have been erased from this stock market. Tom, thanks so much for joining us. Tom Fitzgerald of TD Cowen. Our airline coverage continues in the next hour. We'll be joined by the CEO of Air France, Ben Smith.
I do want to talk a little bit more, though, about those comments from Ed Bastian. I know they were on a competing network, but I think they're really interesting. The fact that they're behaving as if they're in a recession.
And so are their competitors, he said.
Exactly. That's kind of how this becomes a self-fulfilling prophecy. If you have a bunch of companies behaving as if they're in a recession and taking actions that would reflect that kind of...
Well, Larry Fink told Eric Schatzker a couple days ago that all the CEOs he talks to says they are in a recession right now.
But to harp on a comment that Katie had just made.
Don't harp on it.
You could talk yourself into a recession, right?
Yeah. Well, that's what I'm saying, yeah.
Yeah, the fact that you have businesses stalling activity, behaving that we're in a recession. Also, Larry Summers talking about the potential of a crisis. Some doomsday mentality just puts people on pause.
So that's the C-suite read. It's interesting, of course. We'll have to watch the sentiment surveys closely to figure out how consumers actually feel. But we'll discuss all of that and more because less than 12 minutes until the opening bell, we'll begin this trading day with Gabriela Santos of JP Morgan Asset Management. She joins us next. This is Open Interest.
In case you missed it on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Well, Goldman Sachs, for one, is beginning to see opportunity with the S&P 500 closing below the 5,000 mark. We had Goldman partner John Flood saying that long-duration investors will likely get aggressive buying this dip if the S&P 500 continues to fall, especially around 4,500. Let's ask Gabriela Santos. She's chief market strategist for the Americas at JP Morgan Asset Management. Great to have you with us in studio. So Goldman sees opportunity below 5,000. That was based on conversations that they're having with their longer-term investors. Take us into the conversations that you're having with clients, whether folks are scared right now or whether they're also sensing some opportunity.
So I think it's a mixture of defense and offense, and all coming from a starting point of very unbalanced allocations. And this is true across retail, institutional, U.S., global investors. There was a very heavy focus on what had worked, namely U.S. equities, the growth style, and mega cap tech. And I think that, plus high expectations, plus the change in policy, helps to explain this violent rebalancing that we've been seeing. So for some clients, that's still the journey. Reduce a bit equity exposure, have a more neutral allocation, stocks, bonds, have more diversification beneath the surface, balanced value growth, U.S. international, look for other ways to play defense in portfolios. And then you may have some investors that do have a longer time frame that maybe feel like some stocks or some strategies they had high conviction in anyway are now a buying opportunity. But a lot of it's still concentrated, I think, on defense, rebalancing, and making sure that investors aren't off sides, because it still seems like there's plenty of uncertainty to digest.
A lot of uncertainty, and I guess we all expected President Trump to implement the most damaging parts of his, campaign promises first. He can do that by decree. The good things like tax cuts and deregulation may need a little bit more congressional help. Are tax cuts still going to drive a rebound? Are these still impetus, since it's actually just looking like an extension of the status quo rather than something new?
I think that's a really important discussion that's going on in Capitol Hill right now between Senate and the House. This discussion around additional tax cuts, I think completely baked in after the Republican sweep started to get priced in September last year, that there would be a full extension of the 2017 Tax Cuts and Jobs Act. So no news for anyone, should that really happen, as it looks likely. The conversation, though, seems to have really increased, and will increase further should the economy soften further, as we expect, about additional tax cuts. So will there be no tax on tips or overtime or Social Security or auto insurance payments? Will there be perhaps a targeted cut in the corporate tax rate? Or could it go even further and there be Doge dividends, meaning stimulus checks across the board? I think the more the tariffs bite, the more that looks likely. I just don't know if the bond market will like it, but maybe for stocks it could put a bit of a floor.
You know, how much is the bond market telling you how much more pain there is to come in the equity market at this point? We saw just this morning the 10-year yield is hanging around 4.4%, but it hit as high as 4.5%. Is it telling you that maybe right now we're seeing a relative calm in equities, that there could be much more to come? The VIX is still pretty close to 60.
Yeah, I think what we saw Monday, Tuesday in the stock market, yesterday giving up huge gains. That was the biggest gain that was given up since 1982. I think the open might not tell us much by the time we get to the close. But I think the bond market is telling us a message that it's concerned about the growth shock. Because even if you look at 5-year break-evens, they've actually come down. However, the bond market is also telling us that there's some other building issues. Maybe they're just unwinding of trades, but also some concerns around the fiscal that we mentioned. Those are still very much there, as well as maybe concerns that foreigners, either passively or actively, are not that interested in U.S. assets, including treasuries. So we've been having a lot of conversations about, yeah, sure, just extending some duration for the growth shock. It worked in February, but also adding other defenders during the these moments?
Well, that's the thing. There's a lot of existential questions about 60-40 portfolios right now because your bonds aren't working the way they should. We'll discuss that next because Gabriela Santos is staying with us through the opening bell. You can see that futures off their worst levels of the session, but still down on the day to the tune of about 0.7%. The open is up next. This is Bloomberg.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are still seeing red arrows on futures. S&P futures down 0.6%, NASDAQ futures down 0.2, although we have seen NASDAQ futures creep up into positive territory. We've been down in the S&P as low as 2, so a lot of movement again today in this market. You hear the opening bell on the New York Stock Exchange, a company called Mistress, which actually provides some sort of asset protection solutions, I think like physical asset, not financial assets. And then there's some kind of magician, Steve Cohen, ringing the bell. Maybe that's what we need today. He can make the tariffs disappear for everybody, Katie. In terms of the stock movement, it's really not that significant on the index level. What are you seeing in terms of individual movers?
Yeah, there's something poetic about a magician ringing the opening bell with the S&P 500 set to open near a bear market. I don't know what the symbolism is, but there's something there. I'm taking a look at Delta, actually, because we've seen a big reversal. Remember, this morning, Delta actually pulled its 2025 outlook due to uncertainty for travel demand. They are still expecting a profit for the year, but they're not able to specify at this point what it will be. And shares currently higher by about 4% right now, Shanali.
It's interesting. I've got a bit of a flip side story for you. Walmart reaffirming its first quarter sales guidance and still expects net sales to grow this year. But you are seeing Walmart rise not too much in this market, 1.7% at the market open, Matt.
All right, pharmaceutical stocks are another industry group that we've been paying attention to, plunging after President Trump said he will soon add tariffs targeting that sector as well. He just can't get enough of these tariffs. Still with us, Gabriela Santos, Chief Market Strategist for the Americas at JP Morgan Asset Management. Gabby, do we get through this alive? I mean, 10% plus tariffs, is that good for the U.S. economy long term?
So we do think it's quite disruptive in the short term, to be debated whether it's good for the medium long term. I do think it takes a while to truly understand how long they will stay in place, which countries, which products, are there exemptions, and ultimately how the domestic economy is able to rebalance. But I think what investors are pricing in is that clearly tariffs are being used everything, everywhere, all at once for this bigger overarching goal of rebalancing several different aspects of the economy. We estimate that currently tariffs the U.S. is imposing on imports are at 30%, which you'd have to go back before 1900 to see something that high.
It's a massive tax hike.
It's a massive tax hike. It's not just on the consumer. I think to be seen during this earnings season, how much companies feel like they can pass on. Is it half the increase in tariffs? Is it just a quarter because demand's a little soft? But it gets eaten up along the way, and it has an impact on how much consumers as a result are able to spend, but also how much companies are willing to invest in big projects, including CapEx, hiring. So I think a lot of research analysts and investors are eager to get any kind of information about that from companies as we have the earnings season get underway here.
So to go back to Matt's first question, we are going to live, it sounds like.
We'll make it.
We're going to make it.
We always do.
Right.
We've had the pandemic. We've had the financial crisis. We will. What we see the market do is correct valuations, especially when there's so much uncertainty. It will take some time to truly get the dollars and cents impact on the economy and on earnings. So what happens in advance? The multiple contracts, spreads move higher to overprice that. We saw that in 2018, 2019 at a smaller scale during the first trade war.
Right.
So I think that's what we're doing right now, but the multiple had come from being very expensive. So we've had basically a bear market, but the multiple still at 18 times with no confidence in next 12-month earnings. Normally you have this like full fleshing out when the multiple gets to 14 times, 15 times.
So we've been here before. It's great context. Somewhere we've been before is 2022, when you had stocks fail, you had stocks really fall down 19% on the S&P 500, and you had bonds just completely fail as a hedge. Did not work at all. It seems like we are in a similar environment over the past couple weeks. If that extends through the course of 2025, where do you hide out? What is defensive? What's a haven in this market?
There's no magic bullet, frankly. And we've been having conversations with clients since 2022 to make sure that portfolios learned the lesson from that period, which is that in this kind of economic market environment we're in, bonds can't be the whole solution for diversification. They can be some, but not the whole solution. So examples of what worked in 2022, certain alternatives were up. And here, not just a mark-to-market issue, but more an uncorrelated behavior that's a feature, not a bug, of certain types of alternatives, specifically real assets, infrastructure, real estate, as well as certain types of hedge funds. Otherwise, for certain investors where maybe that's not an option or it takes some money to deploy, takes time to deploy capital, thinking about liquid alternatives, absolute return strategies or hedging strategies to minimize some of that downside.
I just want to be clear that the reason I asked if we would all live through this is that I'm getting those questions from investors. Let's not forget that $10 trillion have been erased in this stock slump. And Donald Trump, like on point right now with his latest tweet. maybe the best tweet that I've ever seen from the United States president. Be cool. Okay. Be cool. In all caps. Everything, Shonali, is going to work out well.
You know,
be cool.
I want to focus on the coolness, I guess, of the S&P 500 right now, because you're looking at it erase so much of last year's gains. Certainly everything we've seen since the election, but we're back to levels we've seen in April and even January of last year. So a lot of pain borne by investors so far. You were talking about hedging strategies. I've seen investors take moments of calm in the market to actually load up on hedges. Would you do that at this point in time? Try to buy puts while they're cheap?
So what we see working really well, and you've reported on this, Katie, are around ETFs that offer systematic ways to hedge some of the downside. They sell some calls, so give up some upside, but they also buy some puts that are able to hedge on a quarterly basis some of the downside. Now, the strategies we feel with particular conviction can work here are not ones that are trying to time the market with selling calls, buying puts. Just systematic, quarter by quarter, giving up some upside to protect some downside. And that's a way to play defense, but also offense, because we will live, the market will price all this in, and it eventually will rebound. So that's a way to have kind of a best of both worlds approach.
I'm going to say the ticker. It's JEPI, of course. It's the JP Morgan Equity Premium Income ETF. It does exactly what Gabby said, and it's been really popular. And it's been popular even in bull markets, too. So it's going to be interesting to see what that translates into if we do sustainably enter a bear market. Gabby, we got to leave it there. It's always great to see you. That is JP Morgan's Gabriela Santos. Meanwhile, let's go back to this equity market and talk specifically about Apple. Among the hardest hit from this standoff between the U.S. and China, let's discuss with Bloomberg Technology co-host Caroline Hyde.
Extraordinary, a day of recovery in somewhat, a slight move to the green for Apple after more than $770 billion has been wiped off Apple in the last 4 trading days alone. It was the worst 4-day sell-off that we've seen since the year 2000. Why? Because 4/5 of all of the smartphones made by Apple are shipped from China to the United States. They're assembled in China. Yes, you might get the odd screen capability, the glass from Kentucky going back to China and then reassembled there. But 4/5 of iPhones still coming from China is why Apple is so much in the eye of the storm. And the fact that the numbers are extraordinary when you think about it more broad brush. $41 billion of imports coming from China to the United States were smartphones. It is the single most important import from China to the United States. And this is what we're hitting.
We also sell a lot of stuff to China, and I imagine that a lot of it goes into goods that they assemble and then send back, right? But almost $200 billion. China is the 3rd biggest national buyer of U.S. goods in the world.
Yeah, and then you slap 80% tariffs on going the other direction.
Exactly.
No wonder that you're seeing this tit for tat escalate. No wonder you're seeing such a dampening pressure on the growth of companies where they're withdrawing their overall earnings outlook. Delta, will that spill into some of the earnings that we start to get from the technology sector as well? But I really think that you're starting to see analysts saying, look, there is no way when Trump puts out a Truth Social post saying it is a great time to move your company into the United States, like Apple. I'm sorry, Dan Ives says that's going to cost you $3,500 to have an Apple iPhone. You've got Laura Martin, another key analyst, saying this is not going to happen. Large part because we don't have the labor, you don't have the capability, you cannot start building that amount of manufacturing here in the US in that sort of time frame. Inventory has helped these companies. We have seen the biggest uptick in PC shipments over from China to the United States and inbound into the United States since 2021, since COVID, because everyone front-run this. Interesting that companies managed to front-run it from an inventory perspective. The market did not.
Caroline, we thank you so very much. That is Bloomberg Technology co-host Caroline Hyde. And coming up, pharma is on the firing line. President Trump says a major tariff is coming to the sector soon. More on that next. This is Bloomberg Open Interest.
in case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute news.
Technology news, geopolitical news,
economic news,
financial news.
Bringing you the latest news in private markets
whenever,
and wherever.
Wherever
it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this
is Bloomberg.
All right, welcome back to Open Interest. To check on these markets right now, we have a rally on our hands for now. The S&P 500 up about 0.9%. Big tech leading the way. The Nasdaq 100 up about 1.5%. The Russell 2000 also getting in on the action. I will say we're coming off of 4 straight days of a trading range of 5% for the S&P 500. So we'll have to see how this one settles out. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Apple actually getting upgraded over at Jefferies after its significant drop, with the analyst cutting his price target, though, thanks to those tariff risks. Next, Bath & Body Works getting upgraded as well to a buy over at Piper Sandler. The analyst says that the business is fairly well insulated from macro pressures relative to its peers. And finally, we have Ford getting downgraded to a sell over at Bernstein on those tariff risks. The analyst says that significant downside for the stock is actually not yet priced in, even though we've seen quite a wipeout. I do want to turn to pharma, though, because President Trump says that levies on pharmaceutical drugs are coming next.
We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals.
We're joined now by Sam Fazeli of Bloomberg Intelligence. And Sam, unpack this for us. Do you feel that tariffs will do anything to shift a very globally integrated supply chain back to the United States?
They might at some point, but just like everything else that we've talked about, I'm just listening to Caroline talk about Apple, not only will push prices up and costs up, but also it would be a while before you can do that, especially for the more complicated drugs that require a big manufacturing suite and then maybe the devices to go with them, like these zip-bound injectors. So it would take time.
One place that I'm particularly concerned about, Sam, is not just big pharma and the new big fancy expensive drugs. I'm wondering what the impact to generics will be when many of them are made abroad.
Yeah, so interesting because you can read some of that questions or answers to your question in the US trade data, which I've just been looking at. So Mexico accounts for 33% of pharmaceutical imports into the US by volume, but for 1% by value. That tells you those are the cheaper active ingredient type products that are coming in. So Mexico is already obviously under tariffs, but pharmaceuticals have not been. And as soon as that happens, you're going to end up with a situation where those cheaper generics
News when you want it with Bloomberg News Now. I'm Lisa Mateo. Stocks battling back on Wall Street after a 4-day plunge led by big tech companies. The tech-heavy Nasdaq up more than 1%. The bounce back in treasuries from session lows came after 30-year yields briefly crossed the 5%.
ओके क्रूड ऑयल को देखोगे रेंज के अंदर ही है न्यूज आई थी उसके बाद से ऑलमोस्ट साइडवेज ही चला गया लेट्स सी कुछ बनता है तो मॉर्निंग से क्रूड ऑयल में तो कुछ भी नहीं बना है गैप डाउन उसके बाद रेंज बाउंड नेचुरल गैस सही था ठीक ठाक मोमेंटम थोड़ी बहुत वॉलेटिलिटी जरूर हुई ऊपर एक रेजिस्टेंस था नीचे एक सपोर्ट होल्ड किया उसके बाद न्यूज आई फॉल किया नीचे सपोर्ट एरिया से वापस आके ये भी एक रेंज के अंदर बना हुआ है बीच वाले स्मॉल लेवल को रिमूव कर सकते हैं दीज आर द लेवल्स लेट्स सी थोड़ा सा और मूव करता है तो वैसे तो ऑलरेडी इन्वेंट्री क्रूड ऑयल की आ चुकी है उसका भी कुछ खास इम्पैक्ट हुआ नहीं क्रूड ऑयल की इन्वेंट्री का स्ट्रीम नॉट वर्किंग नहीं स्ट्रीम तो वर्क कर रही है स्ट्रीम इज वर्किंग गाइस स्ट्रीम इज वर्किंग लेट्स सी 9:30 हो चुका है 2 आवर्स आर लेफ्ट क्रूड ऑयल में कुछ पॉसिबिलिटी बनती है तो अगर नेचुरल गैस में सेल किया था तो उसमें एक अच्छा मूव आया था और अगर नीचे सपोर्ट से किसी ने बाई किया था तो वो भी अच्छे मूव दे चुका है वापस सेल मत करना ठीक है डोंट सेल अगेन इन नेचुरल गैस नीड टू वेट फॉर अ ब्रेकआउट देन नीचे से एक लेवल क्रिएट होगा तो उसमें फिर देखते हैं बाकी देखो क्रूड ऑयल में अगर ये ऊपर एग्जैक्टली आया नहीं है अभी तक 5120 के अराउंड अगर उस एरिया के अराउंड अगर मिलता है तो वहाँ पर एक अच्छी सेलिंग हो सकती है वापस से, because that is a good resistance zone as per the level right now in 15-minute chart. आने की कोशिश करी तो थी but exactly hit नहीं किया इस लेवल को. And if you look at the low of that candle is around 5118 and 5118. So that is a retest zone. Exactly hit किया नहीं है, करता है तो वहाँ पर एक retest के तौर पे सेलिंग होगी. लास्ट मोमेंटम में जब आया था ऐसा लग रहा था कि यहाँ पर आ जाएगा बट हिट नहीं किया एग्जैक्टली. तो लिक्विडिटी अभी भी है पेंडिंग. दिस इज अ retest zone if prices hit this level. बाकी नीचे सपोर्ट हो भी सकते हैं बट वहाँ पर बिकॉज ऑफ वो 15 मिनट का चार्ट उतना पीछे दिखता नहीं है, सो वी कांट से नीचे एग्जैक्टली सपोर्ट कहाँ पर है. कोई नया सपोर्ट बनेगा तो या तो उसी को मेंशन करो, अदरवाइज और कोई लेवल वहाँ पर फिर बना नहीं सकता बिकॉज 4 आवर टाइम फ्रेम का ही चार्ट उतना पीछे दिखता है. उससे कम टाइम फ्रेम का कोई भी चार्ट और पीछे सो ही नहीं होता है. बाकी चाइना ने जो रेसिप्रोकल टैरिफ वापस यूएस पे लगाए हैं, तो देयर इज अ न्यूज़ समथिंग अराउंड दैट मेजर यूएस कंपनी जो इंपोर्ट करती हैं चाइना से, दे cancel their upcoming inventory like from Amazon. Amazon cancel some inventory order from China after this tariff, and also there is a airline called Delta, and the CEO of that US airline Delta's stated that the airline won't pay tariff on any Airbus planes. बाकी अगर ट्रेजरी यील्ड भी देखोगे यूएस की, इफ यू लुक एट द ट्रेजरी यील्ड S&P 500 तो ऑलमोस्ट फ्लैट है, नैस्डैक पॉजिटिव है. So if you look at the last 10 years US Treasury yield, that is flat, neutral, no dip which can expected by the US department. It is still on 4.45. This is 10-year bond yield, okay, from the USA. And if you look at the German market, and England, Britain market, and French market, all are down. On the other hand, gold, euro, pound, dollar, they all are rising significantly, almost around more than 4%. And if you look at the Walmart को देखोगे, the rival of Amazon, so he can also expect that their online sales is going to increase because they have many warehouses around the globe, so they can expect a major revenue from online sales this year. So that's why their share is also jumping around 4 to 5%. Currently trading is around $85.19. नहीं नहीं, नेचुरल गैस में अभी नहीं है. नेचुरल गैस में सेल पहले हो चुका है, वो फेक ब्रेकआउट देके नीचे आ चुका है एक बार. अब नहीं कर सकते, निकलने दो ऊपर. फ्रेश सेल के लिए थोड़ा सा ऊपर निकलेगा, देन वी कैन ट्राई. ये नेचुरल गैस में भी ट्रेड बन सकता है. लेट्स सी थोड़ा सा ये और और ऊपर निकल जाए. अगर क्रूड ऑयल में तो बनने वाला है, ऊपर सेल कर सकते हैं.
Tariffs of 104% on Chinese imports. And as the European Union approved tariffs to hit around $23.2 billion of U.S. goods. That's in response to the 25% duties President Trump imposed last month on the bloc's steel and aluminum exports. Bloomberg's Enda Curran has more from Washington.
There's no hint of an off-ramp just yet. No sign of an immediate round of negotiations. Now, we had a lot of commentary this morning from Treasury Secretary Scott Bessent making the point they are willing to talk. Lots of governments are coming here to talk to the administration, so that's clearly on the table. He also made it clear, though, that China isn't yet coming to the table for talks.
Bloomberg's Enda Curran in Washington. Treasury Secretary Scott Bessent says he envisions reaching trade agreements with U.S. allies that would then lead to a collective approach to dealing with China's trade imbalances. Bessent said negotiations are already underway.
I think what a lot of people are missing here is that the levels that were put out last Wednesday are a ceiling. So if you don't retaliate, that is the ceiling. So we've been overwhelmed with the response to come to D.C. and negotiate.
Bessent was speaking at the American Bankers Association. Well, it looks like the White House has its eyes on market reaction to levies. In a post on Truth Social, President Trump urged Americans to remain calm and continue investing as his sweeping so-called reciprocal tariffs hit. The worsening trade conflict has been condemned by investors, including Bill Ackman, and prompted economists at J.P. Morgan Chase and Goldman Sachs to raise the probability of a recession. J.P. Morgan CEO Jamie Dimon on Fox.
I always remind people markets aren't always right, but sometimes they are right. And I think this time they are right because they're just pricing in uncertainty at the macro level and uncertainty at the micro level, at the actual company level. And then how it affects consumer sentiment, it's hard to tell.
Dimon adds that if there is a recession, it will likely be short. Shares of drug makers like Pfizer, Merck, and Eli Lilly are under pressure, with President Trump promising to announce a major tariff on pharmaceuticals very soon. Bloomberg Intelligence senior pharma analyst Sam Fazeli says even generic drug makers won't walk away unscathed from the trade war.
Mexico accounts for 33% of pharmaceutical imports into the U.S. by volume, but for 1% by value. That tells you those are the cheaper active ingredient type products that are coming in. So Mexico is already obviously under tariffs, but pharmaceuticals have not been. And as soon as that happens, you're going to end up with a situation where those cheaper generics, where a lot of people rely on, and that's how you get drug prices down, are going to be the ones that are impacted first.
Sam Fazeli with Bloomberg Intelligence. Uncertainty surrounding global trade pushed Delta Airlines to withdraw its full-year financial guidance, and sources say it forced Amazon to cancel orders for multiple products made in China and other Asian countries. As tariff spooked shoppers begin pulling back on spending, Walmart is preparing for a worsening economy by using its massive footprint to keep prices low and take market share. Bloomberg's Isabel Lee has more.
Walmart reiterating its sales guidance despite the barrage of tariff attacks and the weakening consumer sentiment. And this could really only assume that the world's largest retailer is in a good position to really navigate this uncertainty. We have Walmart seeing net sales growing 3 to 4% this year. That's not accounting for tariffs, unlike its previous outlook in February.
Walmart shares higher by about 3%. That's news when you want it with Bloomberg News Now. I'm Lisa Mateo, and this is Bloomberg.
And make it easier for the consumer to be able to buy what they need on a weekly basis.
Intelligence. So in terms of direct impact, it's fairly minimal, you say?
Yeah, I think so. For the most part, you don't have companies that are sourcing product and selling it. And so, the direct impact of tariffs is really going to be limited primarily to new development, right? So those companies that are looking to build new properties may have increases to their construction costs, which could change the calculus in that regard. But for the most part, operating the business, tariffs are not a direct impact.
Okay, so then let's talk about the indirect impact on operations. What might that look like?
Yeah, and so that's what we're really, we're seeing hit the stocks the last couple of days, and what we're really trying to sort through what the actual drivers might be, right? Obviously, a slowing economy, whether or not we tip into recession, is still to be determined. But slowing economy means less leasing activity. It means delayed decision making. It means less hiring. These are all, bad for owners of office properties. To what degree and what the timing of that might be is yet to be seen. Also, if people start losing their jobs or have less economic clarity, maybe that's bad for rental residential. The caveat to that is, what happens on the for sale housing side as a result of rates and what that impact of that might be. So it's really the knock-on effects, right? What the overall economic direction is, and then what rates do.
Well, yes, I'm so glad you brought up rates, because you would think that given the sell-off in equities, you would see rates falling, but that's not happening right now. Even as U.S. mortgage rates, which are kind of delayed here, are falling to their lowest levels since October. How are you thinking through that, Jeff?
Yeah, it's the 10-year yield. That's what pricing of real estate properties is based on. That's what lending for commercial real estate is based on. And there was the thought that this activity would drop the 10-year yield, and that would be kind of a positive after effect for commercial real estate owners and borrowers. The last couple of days, obviously the reverse is true, and the 10-year yield has been bouncing back up, and that is impacting the stock prices negatively.
All right, Jeff Langbaum with Bloomberg Intelligence, thank you so much for joining us. And as we take a look at what's happening in the markets, I mentioned how stocks are all over the place. The S&P 500 now up by 0.7%. The Nasdaq gaining 1.5%. From New York, this is Bloomberg.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia. But now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to governments, and so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks. The epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Welcome to Bloomberg Markets. I'm Scarlett Fu. Let's show you what's happening in equities right now because the S&P 500 began today on track for its first gain in 5 days. Right now, that is still the case. You see it up above the 5,000 level at 5,956. Tech is leading the way for now, still clinging on to an advance as well. But the real action is in the bond market, where selling continues, and you can see yields getting pushed up across the curve. The 2-year yield now at 3.77%, up 4 basis points. There's a 10-year auction taking place in about 30 minutes' time. $39 billion worth of bonds for sale. Yesterday's 3-year auction generated some fairly lackluster demand. And the 30-year hit 5%, poked above it during Asian trading, but then came back down. There's a $22 billion auction of that tenor tomorrow at 1 p.m. But for the moment, let's go back to equities and check in on a couple of individual equity movers. Bloomberg's Denitsa Sakova has those details. Hi, Denitsa.
Hi, Scarlett. Let's start with Walmart, which is up as much as 5% today. Obviously, some of the gains faded. But what we're seeing here is the largest retailer in the U.S. expect to increase its percentage of total retail business in the U.S. Obviously, the company is known for doing well in difficult times. And this is something investors are expecting from the company. It's down 6% year to date, which in the grand scheme of losses, it's not so bad. What we saw today is that the retail giant reiterated its full-year forecast, its sales forecast, and it's expecting revenue to grow, sales to grow between 3 and 4% this year. So continues to be strong. And what we're seeing here is this is estimate including the tariffs, which was a big worry just a couple of weeks ago. Similarly, Delta today suspended its full-year guidance, but investors are reacting very positively. The stock was up as much as 9%. Now the gains are a little bit smaller. Obviously, things are very volatile in markets. But what we're seeing that investors are focused on those better than expected first quarter results. And of course, we're seeing from analysts saying that they're excited about the diverse revenue streams, the cost management, and a lot of things that allow Delta to navigate through those uncertain times. Of course, what we saw today is coming off the global tariffs. It means that there are more outcomes from what comes here. And another factor here is Delta is down 40% year to date. So you can imagine there is a little bit of deep buying impulse in that stock. Another stock that surged a lot today, but we're seeing the gains fade, it's Peabody Energy. The stock surged as much as 20% in earlier trading. Now it's almost flat on the day. We have some news on the White House. Obviously, President Trump signed an executive order that is going to expand the use of coal. We also have news that the company is reviewing to buy Anglo American for about $4 billion. So that really drove the stock higher. The stock has had a very rough start of the year. It's down about 46%. So that was much needed relief. But in the volatile markets of today, it faded very fast. Back to you, Scarlett.
Great context. Thank you so much, Denitsa Sakova. Now, over the last few days, we have seen the 30-year Treasury yield soar, grabbing the attention of everyone on Wall Street. Earlier today, we asked Nuveen's Tony Rodriguez about what's driving this massive move. Take a listen.
Inflation is going to be significantly higher than we had expected prior to these latest rounds of tariff increases. And obviously, that's very negative. Number two, the inflation hit is up front. The growth drag is a little more delayed. So we don't expect to see any kind of rally in rates until we start actually seeing the hard data begin to reflect the slowdown. You also have, in our minds, foreigners that are backing away from the market, less confidence in the dollar, less confidence in U.S. policy. So you get that. And the third thing is the leverage unwind. With these kinds of moves and this kind of volatility, everyone is lowering their leverage. A lot of basis trades people talk about, et cetera. You're seeing that. So I think there's a bunch of factors, but they're all pointing in the same direction.
All right, he mentioned a couple of reasons, but he ended with the basis trade. So let's focus on that part of the story and bring in Bloomberg's Sonali Basak, host of Real Yield. I was just joking with you that every day feels like Real Yield this week.
Yeah, 100%. And the basis trade is an important aspect of this. Why, Scarlett? It might not be the only reason we are seeing unwinds in the Treasury market, but you even had Treasury Secretary Scott Bessent this morning on Fox Business say that that leverage in the Treasury market was one of the problems. Now, the basis trade has become enormously popular. A Apollo estimates that about $800 billion of the $2 trillion in prime brokerage balances outstanding have to do with the basis trade. That's an enormous amount of the leverage outstanding in the hedge fund system tied to this trade alone. The way it works is you have hedge funds that go long the Treasury spot market and short the Treasury futures market. Now, that's a very small differential, so you might wonder, how do they make money off this? Well, enormous amounts of leverage. That is the answer. That is 50 to 100 times in many cases from various banks. And while this has not become a systemic risk in markets, in prior occasions, we've had to see this become one of the reasons Federal Reserve intervention has come into markets. That does not mean that the Fed has cut rates in these instances. It means they've set up liquidity backstops. You saw it in 2019, before the COVID pandemic even began. You saw it in 2020 again, when COVID did take off, and this became something that amplified moves in the market.
So in a way, there is a Fed put when the basis trade really destabilizes the bond market.
Yes, absolutely. And there have been many financial regulators warning about it. Last thing I'll say about this as well is that you do see a need for the basis trade in a massive way when it comes to Treasury issuance. Hedge funds are massive borrowers, and without them stepping in this way, the 10-year auction today, the 30-year auction tomorrow gets really interesting.
All right, Shonali is going to stick with us because we want to bring in our next guest, Kelsey Barrow, fixed income portfolio manager at JP Morgan Asset Management. So Shonali brings up a lot of good points.
Yeah.
How much do you attribute the plunge in treasuries, the spike in yields, to the basis trade unwind right now?
So I think the basis trade is part of it, but I would just take a step back and think about it a little bit more simply, which is we've had a massive shock in VAR and volatility. And if you are, managing a portfolio and you see the shock and volatility, you typically have your risk manager come and tap you on the shoulder and say, hey, it's time to take down risk. At that point, what you do is you sell what you can, whatever is most liquid. That happens to be treasuries and agency mortgage-backed securities. So yes, this is a very technically driven market right now. I don't think that this is really about fundamentals. Again, I think it's about technicals and deleveraging, and also the fact that there are a lot of people who got caught up, I think, in the rally in 10-year yields. We got below 4%. A number of times, people got long at those levels, and now they're being stopped out. Because while the banks have all come and changed their forecast to recession, there is a void of hard data at this moment, so far this week, that I think is really exaggerating some of these narratives and making them self-fulfilling.
Scarlett, I was watching your team at the close yesterday, and it was amazing to see how quickly that unwind happened yesterday. A lot of the big trading desks point to not only the Treasury market, but the muni market, the mortgage spread. How much stress are those markets showing?
They are showing a fair bit of stress. I don't think that it's equivalent to the type of stress that we were seeing in March of 2020. So you can still get money invested. You can still get your money back if you're a bond investor. And I think that is very important. We continue to do what we do best at JP Morgan. We're investing clients' money. We're still making position shifts. But our bias now, really heading into the tariff announcement back in March, is to be biasing up in quality and biasing a bit more longer duration, because if you take a step back, if you look at our own Mike Feroli's forecast of 5 rate cuts this year.
और गाइस नेचुरल गैस में अगर ऊपर निकलता है तो इसमें भी एक रीटेस्ट है, यहाँ पर एक सेलिंग का प्लान हो सकता है रीटेस्ट पे वापस से नीचे आता है तो यहाँ एक बाइंग का प्लान कर लेना. बाकी रीटेस्ट ज़्यादा देर होल्ड नहीं किया तो फिर नेक्स्ट रेजिस्टेंस 334 के अराउंड रहेगा. बाकी क्रूड ऑयल लगा रखा है ऊपर, इसका भी रीटेस्ट है, यहाँ आता है तो वापस सेल करना. और नीचे कोई सपोर्ट नहीं है अभी क्रूड ऑयल में, हो सकता है 15 मिनट में हो, बहुत पीछे हो यहाँ पर, सो कुछ नहीं कर रहा है. इस चीज़ का ध्यान रखना.
led to the Fed stepping in the past. Do you see that happening again? Deutsche Bank, for instance, sees the Fed needing to step in with emergency purchases of treasuries just to stabilize the market. What are the odds of that happening, do you think?
I think I don't see that happening yet, but I will say that we are better positioned than we were back in 2020. So some of those facilities that were set up during COVID, like the standing repo facility, those actually still exist. So that backstop is already there. As it relates to when is the Fed going to step in, ultimately, I think what they need to see is hard data in the labor market, in an activity data.
But that's backwards looking.
Right. Well, not all of it is backwards looking. So you have weekly initial jobless claims. I think they're also going to be paying a lot of attention to the stuff that they hear from small businesses on the ground. So the Fed has a regional system where they're constantly collecting feedback from businesses. And I think when they start to hear from those businesses themselves, we're done hiring, we're pausing on CapEx, this is going to materially impact our margins and our revenue, they're going to pay attention.
Now, Kelsey, another thing that's happening in fixed income markets I think is interesting is watching credit default swaps for investment grade, that's safe debt, blowing out over the last couple of days. And yet, to your point, not at crisis levels, but it is a tick higher. Now, we're not facing today's recession unless you're one of the CEOs Larry Fink is talking to. But if you do see something start to turn more meaningfully in the environment, where do you look to across the credit markets that look very mispriced today?
So I think you've seen a rational repricing of credit spreads. If anything, given the extent of new information we know about this tariff regime, perhaps they have actually performed maybe better than expected. And I think some of that is because investors still fear a whipsaw from tariff policy potentially being rolled back. But there is still room for credit spreads to widen further if tariffs and the tariffs don't get rolled back. So each day that we exist in this environment of high uncertainty and tightening financial conditions does unfortunately raise the prospects of recession and suggests that credit spreads are probably not wide enough to compensate us for that risk.
All right, Kelsey Barrow with JP Morgan Asset Management and our very own Shonali Basak, who hosts Bloomberg Real Yield. Of course, as I joked around, every day is Real Yield these days. And of course, she will be here with the program on Friday. Now, coming up, drug makers are sliding after President Trump says the U.S. will announce a major tariff on that industry soon. We're going to discuss with Evan Siegerman, pharmaceutical analyst at BMO Capital Markets, next.
Asia is a continent of contrast. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Then, so give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "거미 불루, 화이 불치." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. And we're here where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
The sort of slowdown would come from trying to build enough capacity to meet the demands that people think AI is going to bring.
It's a good reminder that it's not just semiconductors that go into building out a data center. The other thing that you point out is distraction. All these big tech giants, the hyperscalers, need to focus on their main business, which gives them the revenue needed to be able to pay for a lot of these adventures in AI.
Yeah, absolutely. Now, I guess 2 or 3 weeks ago, if you'd have said to me, what's Tim Cook's biggest headache as CEO of Apple, I'd say, well, he's trying to think about how he can catch up with AI and how they sort of made a few missteps there. Now it's absolutely about how he tries possibly to move as much manufacturing away from China in particular to places like India, or, you know, contemplate the idea of a US-made iPhone, although that seems extremely far-fetched at this point. You know, and other companies like Meta, for example, Mark Zuckerberg, you know, they're going to be a big spender in expanding data centers like the other companies, and they can do that because Mark Zuckerberg in earnings calls can say, look at this, look at our advertising business. Isn't it doing it great? Isn't it printing money like it's always done? When the tariffs kick in, and if other companies across the broader economy are struggling, advertising is the first to go.
Yeah.
We know that a large part of Meta's advertising revenue is from China specifically, companies selling cheap goods like Temu and Shein. That all could retreat quite rapidly. And so then the ability to say, don't worry, our core business is firing on all cylinders, we can invest massively, I think that equation gets much more difficult.
Speaking of China, I mean, China proved that you can build out AI models without a whole lot of expense using the DeepSeek approach. Can't the hyperscalers do something like that?
Well, I think it's an interesting point, and I spoke to a venture capitalist yesterday who was talking about maybe what this would do if there's less availability of compute, as they say, in the AI industry. Maybe companies will start to think maybe we should be more like DeepSeek and build cheaper and more efficient models using less semiconductors. But the problem with that is I think, you know, the US advantage, and this was emphasized by Microsoft's CEO Satya Nadella, is that against China, they can actually build bigger with more advanced chips and do more. And so they'd be removing that advantage if this was to happen. And it, you know, puts them on the same terms as China, which I don't think is necessarily good for the growth of AI in the US.
Scale was their natural advantage when it comes down to it. All right, Dave Lee of Bloomberg Opinion, thank you so much. An excellent column by Dave Lee here. The title's great. This is a funny way to help US AI companies. All right, we've got the 10-year yield auction coming up right now. $39 billion worth goes up for sale in 4 minutes. This is Bloomberg.
news, technology news, geopolitical news,
economic news,
financial news.
Bringing you the latest news in private markets
whenever,
and wherever.
Wherever
it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this
is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
In case you missed it, on Bloomberg Technology.
This is the first event in history where a company CEO invites all of the guests to explain why he was wrong.
We have a vision about how quantum computing will be useful.
We're still at the beginning of a learning curve with respect to how NVIDIA and Jensen interact with quantum computing companies.
Don't miss Bloomberg Technology live every weekday.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Wednesday edition with a new test for the bond market just as reciprocal tariffs kick in and China hits back. I'm Joe Matthew alongside Kaylee Lyons in Washington. Thanks for being with us here on the early edition of Balance of Power on Bloomberg TV and radio. Kaylee, China put 84% tariffs on U.S. goods here, and the disconnect that we've seen between the stock and bond markets continues to widen.
Yeah, of course, they're continually jolted by each and every bit of tariff news, as it's not clear whether or not the U.S. and China are even willing to get to the table to try to negotiate a deal, or if this is something that could actually cut off effectively the trading relationship between the two largest economies, and that is a lot for financial markets to contend with. We have flipped, I don't even know how many times, between positive and negative territory on the S&P 500 today, and in the bond market, you're seeing once again incredible upward pressure on yields. So selling in treasuries too, no longer it seems seen as a safe haven asset, as we're up another 17 basis points on the 10-year today.
Saw 4.5% earlier. Sell everything American seems to be the charge at the moment. And we're about to experience this treasury auction that could bring a lot more noise here. Just what we need is more paper.
Yeah, well, it's going to be a real read on demand for U.S. debt, that's for sure. And we're going to have a readout of that auction from Ira Jersey of Bloomberg Intelligence in just a moment. But we also have to consider the wider economic ramifications here. Bharat Ramamurthy, who used to work in the economics of the Biden White House, is going to join us as we have the administration, of course, contending that all of this is about short-term pain for long-term gain.
That's right.
Bringing back American manufacturing is what it's all about.
Be cool.
Be cool,
the words of President Trump today on Truth Social. A great time to buy. I guess there's a little bit of a bid, but it depends on what minute you're looking.
Yeah, we'll see how long it lasts because this buying of the dip hasn't seemed incredibly persistent in the last few days. Charlie Pellet has been tracking each and every move for us. And he, of course, is in New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. Indeed, a lot of people on Wall Street, everybody glued to their screens, awaiting fresh news on tariffs and, of course, the Treasury auction of 10-year securities, closely watched as a further test of sentiment. Our Ira Jersey is standing by. He will have the latest for you coming up in just a moment right here on Balance of Power. Right to the numbers. We got stocks pushing higher. We're close to session highs right now on the S&P. Has been a volatile day, though, with the S&P up 52 right now, 5,035, up by just about 1%. We've got NASDAQ up 300, higher now by 2%. The Dow up 305. That is a gain of 0.8%. 10-year right now, 4.43%. The 2-year, 3.78%. Gold up 108 the ounce, up 3.6%. And West Texas Intermediate crude down 3.6%, 57.50 for a barrel of WTI. J.P. Morgan Chase CEO Jamie Dimon says a recession is a likely outcome of the turmoil tied to President Trump's tariffs. He made the comment on Fox Business. Recapping, S&P up now by 1.7%. Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. We, of course, had our eye on this 10-year bond auction. The pre-sale, when issued, yield 4.46 roughly. and the actual auction drawing 4435. So actually a bit more demand, it seems, coming through a lower yield. You're starting to see that ripple through the Treasury market. As I just mentioned seconds ago, the U.S. 10-year yield was up 17 basis points. We're now up by still a large amount, but less, 11 basis points, the 10-year yield right now at 441.
We seek insights from Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, and just the voice that we need right now. Ira, what's your reaction to this auction in the first moment of trading?
The market cheapened up enough that investors came in like bandits. In fact, this was 88% was taken by investors, and that's, if that's not a record, it's very darn close to a record. I think that all the cheapening that occurred recently was in a way to make room for this auction. So you probably had dealers who were very long treasuries got out of some of their treasuries, and at the same time you had investors that said, hey, we could have bought 40 basis points ago, but look at 4.35%, 4.4%. This seems pretty good. So yeah, so what we did, it stopped short 2.5 basis points, so lower than what the market was expecting right at 1 o'clock. And the auction internals were fantastic. So there was stronger demand than last month. There was very high demand from end users, and I'm not going to say that everything's great now, but this is definitely a positive sign, especially given yesterday's 3-year auction was so atrocious.
Well, so to that point, Ira, does this at least for now put a little bit of cold water on the treasuries are no longer seen as a safe haven asset thesis we've seen emerging in the last few days?
Yeah, I think it does a little bit. Yeah, the issue is, I think a big part of this move is not necessarily fundamentally driven. I think some of it maybe started that way, but positioning was so one-sided where a lot of people were long. The dealer community was full of treasuries. The foreign investors, they balked a little bit maybe at buying in the recent past. But we still see treasuries as a, quote-unquote safe haven asset. I think that the risk is that we could still see a lack of foreign demand because, do you want to be buying treasuries in a situation where, the administration is attempting to reduce the amount of dollars that we export to the rest of the world? So there could still be some volatility, and we still have to see, who are the actual buyers. Unfortunately, we don't find out for another week and a half or so who the actual purchasers were, whether they were foreigners, domestic investment funds, banks, right? Those things we find out a little bit later. But on the surface of this, it seems like some people at least made room or liked the cheaper levels that they were able to buy these treasuries at.
Ira, what does the last week mean for Scott Bessent's drive, his obsession with 10-year yields, his drive to lower yields? He says, don't pay attention to the Fed. We're worried about the 10-year.
Well, so there's a couple of pieces there. So number one is the 10-year itself is going to be driven by the front-end rates, right? So the whole term structure of interest rates starts with the Fed funds rate and where the Fed sets policy. So you can't disentangle that from the 10-year. The other thing is that in order to really get the 10-year yield meaningfully lower without the Federal Reserve cutting interest rates, you do need to reduce the deficit, right? And that's one of the big things, and maybe what the administration's hoping will happen. How much will that be worth? It's hard to gauge exactly how much that meaningful deficit reduction would have, but it would be worth something, right? It would be 25 basis points, like some number. We can only guess at what that would be. But on the other side, I think the thing is you want to make sure that there's strong demand for treasuries, and by decreasing the level of the deficit and having the deficit at least lower than economic growth, so you get debt to GDP lower, that makes the U.S. debt seem more sustainable. That can drive people into the market, and people would be happier to own treasuries in that environment, I think, and that certainly is something that could marginally keep rates lower. But ultimately, 80-85% of where treasuries are going to be is going to be based on monetary policy and expectations for where the Fed's going to go.
Well, so with that in mind, Ira, less than an hour from now, we get the minutes of the March meeting. Obviously, backward looking, no one knew at that time exactly what the reciprocal tariff regime from President Trump was going to look like. And we've heard Fed speakers since talk about them being more severe than anticipated. So is there anything really the minutes can tell us that might provide additional direction to the Treasury market?
Well, I think it's going to be more interesting than it will be market moving. And so it's things like, what is the Fed's reaction function? How much do they care about the inflationary effects on tariffs versus the growth effects on tariffs? And I think that that's the push and pull that the Fed's going to have going forward. You know, we're of the opinion that the Federal Reserve might be a little bit late to cut interest rates because they'll need to wait until they see meaningful shifts in the job market before they have a reason to lower interest rates. And at least so far we haven't seen that. Now, if we get a 75,000 job print in for April, and then for the May print gets like 50,000, that would give the Federal Reserve, I think, enough ammunition to think, okay, maybe it's time to lower interest rates in June because the job market has been hampered, maybe in part by fear over the tariffs, but nonetheless, like, our job is to make sure that we have full employment, and if the job market's falling out of bed, then it'll be hard to maintain full employment and by most measures. So then the Federal Reserve could actually cut rates. But we have to wait for that data to see exactly what animal spirits are thinking. And given the recent market volatility, that's one thing. Yeah. What's going on in the real economy is another. So the other piece of Fed information to look at that they look at very closely is the beige book. So look out for the beige book in a week or so. That will be maybe the key to how the Fed's really going to be thinking about the May meeting.
All right, Ira, thank you so much. Ira Jersey of Bloomberg Intelligence helping us look ahead to those Fed minutes, but also run through the stronger than expected demand in that 10-year Treasury auction, which again has brought yields off the highs of the session. We're now up just 12 basis points on the 10-year to right around 441. As we consider a bond market that, of course, like the stock market, has been roiled by President Trump's tariff policies. The implementation as of 12:01 this morning of reciprocal tariffs on U.S. trading partners, that level 104% on Chinese imports. China, of course, slapping back with 84% levies of its own today. But President Trump, when speaking at an event for congressional Republicans last night, was standing by his case for tariffs.
I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say. We're making a fortune with tariffs, $2 billion a day. Do you believe it? They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
So we'll get an assessment on those theories now from Bharat Ramamurthy, who is joining us, senior advisor for economic strategy at the American Economic Liberties Project and deputy director of the National Economic Council during the Biden administration. Bharat, welcome back to Balance of Power. It's great to have you back here on Bloomberg TV and radio. I guess you could kind of take which element of the president's words we should focus on first, but this idea that the U.S. is going to make a lot of money off of this, given the levels of just our tariff on China and China's retaliatory tariff back at the U.S., there have been suggestions that that is effectively going to choke off all trade between the two largest economies. What would that actually mean for import volumes and any revenue that you could raise off of imports?
Yeah, that's exactly right. You know, we have this concept in tax policy where if you raise the tax rate so high, you actually generate less revenue because you have less income or whatever it is that you're taxing. And the same idea would apply here, where if you are raising these tariffs at such a high level, which you are seeing in the new rounds of escalation between the U.S. and China, that the total amount of imports actually drops to the point where even with the higher tariff, you're not generating as much income or as much revenue as you used to. But, I think to the broader point in that clip that you just played from the president, he clearly thinks that if we have a trade deficit with some country, that country is ripping us off. And I think that fundamental misunderstanding about how the global economy works is underlying this whole charade, this whole attempt by the president to rework the global trade system so that the United States has no bilateral trade deficit with any country in the world. And I think it's just simply unworkable. If you look at an example like Madagascar, we have a trade deficit with Madagascar because we import a lot of vanilla from there, and they're not particularly wealthy, so they don't buy a lot of U.S. exports. Is that Madagascar ripping us off? And does it make sense for us to put a massive tariff on vanilla from Madagascar to make it more expensive for Americans who want vanilla just to eliminate that trade deficit? It doesn't make sense to me.
So let's go further down that road, Bharat. The president said last night, as we just heard, now it's our turn to do the ripping. So what does that mean for vanilla?
Well, look, it says to me that we're not anywhere close to out of the woods yet. And people always ask me what is going to pull us out of this. And my answer to them is I don't know if there is any way out of this except going all the way through it. You have a president who is clearly doubling down on tariffs and increasing them in many cases and shows no interest or willingness to back off. You have Republicans in Congress fully backing the Trump agenda. Just today, there was reporting that House Republicans are putting something into a bill that would prevent anybody in Congress from taking away the tariff power from Trump, even if they wanted to. There's been court challenges filed to challenge the ability of the Trump administration to impose these types of tariffs. We'll see how those go, but this is an area where the president does have quite a bit of flexibility, so it's not clear that the courts are going to be the savior here. And you had Jay Powell, the chair of the Fed, saying last week that the Fed isn't particularly interested in jumping into this environment. He's still concerned about keeping long-term inflation expectations anchored. So of all the actors in the system that could potentially stop this, it's not clear to me which one is going to be able to.
Well, and it, I guess, becomes a question of what else we are stopping, if it's just the policies themselves or the economic ramifications of said policies, Bharat. How quickly and easily could we stumble into a recession here?
I think you've already seen people raising their expectations for a recession this year. I think you're going to see it very soon. I mean, actually, if you look at the data from February and March in terms of consumer spending, retail spending, business investment, some of those qualitative factors that your previous guest talked about, with businesses saying that they were pulling back on plans for investment because they were unsure about how to navigate the tariff situation. All of that is going to be hitting the economy very, very soon. We haven't even started experiencing all of the price increases that we're going to get from these tariffs. And that's going to lead to a significant consumer impact. It's going to lead to more uncertainty among business community. And I would imagine that the odds of a recession as soon as the second half of this year, in my mind, are quite high.
We heard from Jamie Dimon a little earlier today, was on Fox Business, asked about the prospect of a recession. Bharat, here's what he said.
Are you hearing that from CEOs as well in terms of business managers? Are they now going to start pulling it in and cutting back on various expenses?
I think you're going to see a little bit of that, yes. Yeah.
But how significant would you expect that? Do you personally expect a recession?
I am going to defer to my economists at this point, but I think probably that's a likely outcome.
Larry Fink earlier this week on Bloomberg, Bharat said he thinks we may be in one already. Are we in a recession now?
Well, as I said, some of the data from January, February, and March, to my mind, was pretty concerning when you saw the pullback among both business investment and retail spending, very soft retail spending numbers for February, for example. I'm not sure if we're in a recession as we speak, but I think that adding all of this tariff impact on top of that pullback that we saw at the beginning of the year puts us on the trajectory for a recession in the second half of the year. And I think it would be one of the few recessions in American history, maybe the only one, that was completely the result of a single person's complete misunderstanding of how the economy works.
Well, he wants to reshape that economy, he argues, Bharat, revive American manufacturing. In our final 90 seconds here, what would actually have to happen to the wage structure, cost of living considerations in the United States if we actually are to bring back workers, in the words of the Commerce Secretary Howard Lutnick, who are actually screwing the screws into iPhones, doing work that has been, up until this point, outsourced to other countries in recent decades?
And look, as you noted, I worked in the Biden administration. If you look at the data, it's very clear there was a surge in investment in American manufacturing in 2022, 2023, and 2024 under the Biden presidency. That was accomplished by doing targeted investments in American manufacturing through the Inflation Reduction Act, through the infrastructure bill, through the CHIPS Act, bringing all of that onshore, paired with some targeted tariffs on China and on steel and aluminum and some other specific sectors. Doing this across the board in the way that they have done completely undermines the ability for American manufacturing to recover. Remember, American manufacturers, in many cases, rely on some inputs that come from abroad. So by imposing tariffs across the board, what you are doing is driving up the costs for American manufacturing which makes the value proposition for investing in American manufacturing worse than doing it in Southeast Asia or China or South America. So it's really, like I said, I don't want to overstate it, but it's really almost like an act of arson on the economy, and it's based on some theories about how the economy can and should work that really aren't grounded in fact.
Bharat, good to see you. Bharat Ramamurthy, Senior Advisor for Economic Strategy at the American Economic Liberties Project. Live with us here on Bloomberg TV and radio, the 10-year yielding 4.38%. We'll have much more with our panel coming up next. Rick and Jeannie on the way in here on Bloomberg.
The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. The world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
In case you missed it, on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
It's 1:21 on Wall Street. We do check markets all day long. Here at Bloomberg, we begin with a developing story. Federal agencies can fire thousands of probationary employees after an appeals court paused a lower court's order. Stocks are surging right now. Bonds recovering from session lows after that $39 billion.
ओके गाइस, ऐसा लग रहा है क्रूड ऑयल और नेचुरल गैस में कुछ सडनली हुआ है. लुक एट द कैंडल बोथ इन क्रूड ऑयल एंड नेचुरल गैस. 11 बजे पता नहीं कौन सी न्यूज़ आ गई. अब न्यूज़ बेस्ड मोमेंटम है लगता है और फॉल मोमेंटम कर सकता है. देखना पड़ेगा न्यूज़ क्या आई है. गोल्ड को देखोगे तो रुक ही नहीं रहा है, ऑलमोस्ट 4% के अराउंड ऊपर है। बिटकॉइन भी 3.5-4%, 3.5-4% ऊपर चला गया। सॉरी सॉरी सॉरी। जेलेंस्की सेज बीजिंग अवेयर मॉस्को रिक्रूटिंग चाइनीज सिटीजन। सॉरी। वाओ 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 गाइस, क्या न्यूज आई है। ओके, देयर इज अ न्यूज कमिंग फ्रॉम यूएसए अगेन। थोड़ी देर पहले न्यूज आई थी कल कि ट्रम्प ने 105% 50% टैरिफ बढ़ा के टोटल 105% टैरिफ लगा दिया है चाइना पे। चाइना ने उसके रिटेलिएशन में 83% लगा दिया था। फिर से यूएस की ओर से न्यूज आ रही है कि ट्रम्प ने वो 104% का जो टोटल टैरिफ था उसको बढ़ा के 125% कर दिया है। इनसेन। ट्रम्प सेज ही इज revising China's tariff to 125% effective immediately। ठीक है, इफेक्टिव इमिडिएटली न्यूज बेस्ड मोमेंटम है, रुकेगा नहीं अब क्रूड ऑयल मेरे अकॉर्डिंग। ठीक है, पॉजिटिव न्यूज ही है क्रूड के लिए तो ये। लेट्स सी थोड़ा कहाँ तक जाता है प्राइस, बिकॉज कंप्लीटली न्यूज बेस्ड मोमेंटम एंड वी कांट सी कहाँ तक मोमेंटम करेगा। हाँ, इसके अगेंस्ट अगर रिटेलिएशन कर देता है वापस से चाइना तो फिर से क्रूड ऑयल ट्रम्बल हो सकता है, अदरवाइज मेजर एस्केलेशन। मुझे लग रहा है दोनों एक दूसरे पर टैरिफ लगा लगा के इतना कर देंगे कि फिर टैरिफ लगाओ ना लगाओ बात एक ही है, क्योंकि ट्रेड ही बंद हो जाएगा। 125% इनसेन, मतलब 100 रुपए की चीज़ 125 रुपए में मिलेगी। कोई 100 रुपए की चीज़ पहले से $100 की मिलती थी यूएस में, वो सीधा $225 की हो जाएगी। मतलब $1000 की कोई चीज़ मिलती थी वो सीधा 2125। वाह। इस वजह से मार्केट भी बिल्कुल ही वॉलेटाइल हो रखा है। सडन न्यूज़ एंड लुक एट दिस। जीने नहीं देंगे मार्केट में लगता है दोनों। एक जगह पे आके रुकते तो कुछ होता बट आई डोंट थिंक सो दे आर इंटरेस्टेड। अब चाइना भी पता नहीं अभी और ना बढ़ा दे, उनका ही भरोसा नहीं है। वैसे जितनी इनकी फाइट होती रहेगी इंडिया के लिए तो सही है मेरे अकॉर्डिंग। 125% टैरिफ ऑन चाइना, और वो भी ऐसा नहीं है कि अगले हफ्ते लगेंगे, इमिजिएटली। ठीक है, गोल्ड को देखो, लुक एट द गोल्ड। वाह, लुक एट द गोल्ड। एक बार 10 ईयर की ट्रेजरी यील्ड भी देख लेते हैं, इम्पैक्ट पड़ा होगा डेफिनेटली। क्या सडन फॉल आया है गोल्ड में भी। डॉलर थोड़ा सा वॉलेटाइल हो गया है, ऊपर जाने की कोशिश लेकिन वॉलेटाइल है। एंड या यूएस डॉलर को देखोगे जंप किया है, यूएस डॉलर ने सिंगल कैंडल ने जंप किया है सीधा सीधा 1% के अराउंड। लुक एट द every commodity is going up. Copper is going up, aluminum is going up, zinc is going up, gold is booking some profit obviously, and silver also going up. Look at the गिफ्ट निफ्टी क्या कर रहा है। सडनली ऐसी न्यूज आ जाए तो फिर कुछ नहीं कर पाएंगे। वाव वाव, मेजर गुड न्यूज फॉर गिफ्ट निफ्टी। लगता है कल गैप अप ओपन हो सकता है। गिफ्ट निफ्टी को देखोगे, न्यूज आई, हमारा जो मार्केट था इंडियन मार्केट, उसकी जो क्लोजिंग थी क्लोजिंग से अप्रॉक्सीमेटली 77-78 पॉइंट डाउन चल रहा था। अब जो हमारी इंडियन मार्केट की क्लोजिंग है वहाँ से लगभग 2%, 3%, सॉरी 2% ऊपर चला गया है। गया तो वैसे 2.5% था, थोड़ी सी प्रॉफिट बुकिंग आ गई है, तो आप कह सकते हो गिफ्ट निफ्टी के लिए बहुत अच्छा है। कल का जो हाई बना था, कल का मार्केट ने जब रिकवर किया था, वो हाई ब्रेकआउट के काफ़ी करीब है। देखते हैं ये रिकवरी करता है या फिर और ऊपर जाता है। बट अभी अगर इसी लेवल के आसपास क्लोज होता है गिफ्ट निफ्टी तो कल एक बहुत बड़ा गैप अप हो सकता है। मेजर न्यूज़ गाइस, मेजर न्यूज़। लेट्स सी और क्या इस पे डेटा मिल रहा है।
A 90-day pause on the tariffs and a substantially lowered reciprocal tariff during this period, he says, of 10%, also effective immediately.
Every word that is uttered out of Donald Trump's mouth specifically to tariff policy. And this is big news to ratchet up your tariff war with the biggest trading partner and other largest economy in the world, China, and at the same time giving relief to those people who aren't arguing or aren't retaliating.
Okay, एक और मेजर न्यूज़ आई है गाइस, दैट इज़ वेरी गुड न्यूज़ फॉर इंडिया एक्चुअली, और इंडियन मार्केट के लिए। यूएस के जो प्रेसिडेंट हैं उन्होंने ये साफ साफ कह दिया है कि जिन भी कंट्रीज़ ने रिटेलिएटरी टैरिफ नहीं लगाए हैं यूएस पर, मतलब जैसे यूएस ने लगा दिया हर किसी कंट्री पे 10%, 15%, 20%, ठीक है, टैरिफ लगा दिया हर किसी पे। जिन कंट्रीज़ ने रिटेलिएशन नहीं किया है, लाइक इंडिया या और भी कंट्रीज़ हैं, उन सभी पर जो मैंने टैरिफ लगाए हैं उनमें 90 डेज़ का मैंने पॉज दे दिया है। मतलब अगले 90 दिनों तक वो टैरिफ नहीं लगेंगे। लेकिन जिन लोगों ने रिटेलिएट किया है, जैसे चाइना, कनाडा और आई थिंक यूरोप ने भी कर दिया है शायद, उन सब पे इमिडिएटली ये टैरिफ लगेंगे। सो मेजर डेवलपमेंट। वाह, लेट्स सी क्या क्या होता है। अभी तो बहुत मुझे लग रहा है मार्केट, इंडियन मार्केट के लिए काफ़ी अच्छी न्यूज़ है। कल मुझे लग रहा है एक बड़ा गैप अप होने को देखने के लिए मिल सकता है। मेजर न्यूज़ फॉर इंडियन मार्केट, गुड न्यूज़ फॉर इंडियन मार्केट, बैड न्यूज़ फॉर चाइना एंड ऑल दोज कंट्रीज जिन्होंने रिटेलिएशन किया है।
Investigations into market manipulation?
Oh, I think they absolutely are going to do that. I think that we will be hearing about that. The reality is that we have a president who has just, with the sort of stroke of a pen, but it's not even that, it is just going on Truth Social, can move this much of the market. And you bet that Democrats are going to be wanting to ask questions. The problem is, investigation is hard in Congress when you are in the minority. So that'll be trouble for them. But I do think that the president is hearing from these folks who have been hurt badly. And, you've mentioned Elon Musk. You've mentioned a few of these people. Bill Ackman, Dave Portnoy is a big voice, and he has been saying he would consider even voting Democratic if this continued. Ken Langone. So a lot of people very close to Donald Trump who've lost a lot of money. So I think we are certainly going to hear Democrats call for investigations.
All right, Jeannie Shanzano and Rick Davis, our political panel, Bloomberg Politics contributors, the both of them. Thank you so much for being with us as we contend with this breaking news from President Trump. Yes, maybe bad news for China, as that tariff is immediately going up to 125%, according to the president. But for those who have chosen not to retaliate against the U.S. measures, a 90-day pause will also be immediately implemented, and it has had an immediate impact on financial markets off of the dramatic highs of the session. But we are still talking about some very big moves here, Joe. 7.5% rally on the NASDAQ 100, more than 6% on the S&P.
Look at the Dow Jones, 5%, 2000 पॉइंट ऊपर चला गया सीधा सीधा Dow Jones. And look at the US 100, Nasdaq को भी अगर चेकआउट करोगे, look at the Nasdaq, न्यूज़ आई और almost 7%, 1600. Look at the Tesla share, I think going down maybe. Tesla share also recovered. Wow, look at this 12 point on profit side.
Look like we're bouncing around all morning, but this was kind of the signal that everyone mitigate some of those tariffs. What's notable here is President Trump's comments about, encouraging people to buy the stock market. I wonder to what extent he's trying to call the market bottom in the similar way that President Obama did back in March of 2009. Obama spoke on March 3rd, and just over a week later, the market hit its low point, and from that point on, moved higher.
We're talking about a social media post here, Scarlett. We don't have an actual piece of paper from the White House. We don't even know exactly what countries qualify as non-retaliatory.
Yeah, good point.
We do have to acknowledge the fluidity here in this market and the stakes after such severe losses. Why should investors have confidence in anything to do with tariffs right now?
I don't know that it's confidence to do with tariffs, but for now, this is a bit of relief. This is a respite from the constant selling and the bad news. On Wall Street, the projections that the U.S. economy would tip into recession have been steadily growing. A lot of people, including Larry Fink of BlackRock, were saying that many company executives are...
My voice is very low, not audible at all. I'm audible now. If you have any question, you can ask.
And it would be only a matter of time before the data backed that up. So this is a break in that bad news story. So far this week, we've seen the bad news really turn to the bond market. Last week was all about the stock market, kind of in collapse mode, and it's been a lot more fluid, volatile this week. But the bond market has really taken it on the chin this week. And there's a lot of question marks over whether this is fundamentally driven or technically driven.
I just want to point out for those who have been following the commentary of Bill Ackman in regard to tariffs, who, as Joe reminded us just moments ago, did push for the 90-day pause to begin with, which is what Donald Trump seems to have decided here. He posts simple message on X now, just thank you. Nothing else. So I guess he likes what he's seeing here, just as risk asset investors do. But Scarlett, it's remarkable that we get this news today after we already have learned today about instances of multiple companies making decisions or having to issue guidance that is unclear or pull that guidance because of these tariffs. Delta, of course, not willing to stand by a forecast. We had Bloomberg reporting of Amazon actually pulling orders of inventories on goods coming from China. Already, this is affecting corporate behavior, even if the president has now decided that there will be a pause, at least in some instances.
Yeah, absolutely. It's difficult for any company to go out there and say very much about how they anticipate the year to shape up when they don't know what's going to happen. At the end of the day, nobody knows anything. And to give firm numbers is just inviting scrutiny and inviting people to knock your stock down when it won't come to fruition. And I think that's pretty much the case. We were speaking with a pharmaceutical analyst who was talking about how this promise by President Trump to impose tariffs on the pharmaceutical industry is, of course, meant to encourage these companies to move their manufacturing back to the U.S. But because their supply chain is so complex and it would take years for them to do so, they're not ready to commit to anything else. They already have a lot of their manufacturing, their high-value manufacturing in the United States, but they are able to bring in a lot of their products from overseas, into their warehouses and work off of their inventory. They probably have a 2-year waiting period where they don't need to do anything and can see how this all shakes out.
Bloomberg's Scarlett Fu in the throes of the rally. Right now, the S&P 500 up 390 points, almost 8%. Kaylee, the NASDAQ is up by more than 9%. A powerful move here. 1,455-point rally as the Commerce Secretary takes to Twitter. Scott Bessent and he writes, retweeting or showing a screen grab of President Trump's post on Truth Social. Sat with the president, he says, while he wrote one of the most extraordinary truth posts of his presidency. The world is ready to work with President Trump to fix global trade, he says, and China has chosen the opposite direction.
Yeah,
interesting moment here for this administration.
It certainly is, and quite a split screen between what we're seeing the markets reacting to and the reception, at least the majority of countries subject to reciprocal tariffs seem to be now getting from the administration, which is a pause, versus the escalation of what is a trade war with the second largest economy in the world, as the president promises to raise immediately the tariff on Chinese goods to 125% after China slapped an 84% retaliatory tariff on the U.S. Many economists say that effectively is going to mean decoupling of this, and yet the market is seemingly looking through that right now. But when you consider the number of consumer goods that come from China, where like 80% of the share of imports on things like PC monitors, for example, comes from China, that's not easily replaced necessarily, but maybe the good news on what we get from other countries is enough to carry risk appetite through for now.
Interesting to see tech taking off like this, because the prospect of a $3,000 iPhone might not do a lot for Apple shares. But as the rally moves here, we want to go directly to the White House. The press secretary and Treasury secretary just walked into the briefing room. This is live now. Caroline Levitt alongside Scott Bessent on Bloomberg.
Secretary speak to that. We will continue with the tailor-made negotiations that I spoke about yesterday. In the meantime, there will be a 90-day pause on the reciprocal tariffs as these negotiations are ongoing, and the tariff level will be brought down to a universal 10% tariff. The secretary here has been a huge part of the president's trade team, of course, and will continue to lead these negotiations moving forward, to look out for the American worker, which is always President Trump's goal. So I'll kick it over to our great Treasury Secretary, Scott Bessent.
Good, thank you. And we saw the successful negotiating strategy that President Trump implemented a week ago today. It has brought more than 75 countries forward to negotiate. It took great courage for him to stay the course until this moment. And what we have ended up with here, as I told everyone a week ago, they're in this very spot, do not retaliate, and you will be rewarded. So every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
Ed, go ahead. Treasury Secretary, thank you for doing this. Let me ask you three quick things, if I could, just for the sake of clarity, because the markets are open and they're wondering. First of all, Mexico and China, are they part of this 10% universal?
Well, China, no, China.
Mexico and Canada, are they part of the 10%?
Yes.
Okay. Second, given then that you have the rest of the world essentially calling it, it's not China, is this now just all about China?
Well, it's about bad actors, and what we will see is some of the very early countries are China's neighbors. That we're going to see. I'm seeing Vietnam today. Japan's at the front of the queue. South Korea, India. So we will see. And as I've repeatedly said, and President Trump has been saying it for years, China is the most imbalanced economy in the history of the modern world, and they are the biggest source of the U.S. trade problems. And indeed, they are problems for the rest of the world, because what we've seen is that as the U.S. announced the tariff wall last week, many of those goods have already started flooding into Europe.
So as you see it now, this trade war is China versus the rest of the world?
Well, I'm not calling it a trade war, but I am saying that China has escalated, and President Trump responded very courageously to that, and we are going to work on a solution with our trading partners.
If I could just, excuse me, Raquel, if I could.
No voice is still now. Volume of news is much higher. मेरे को तो आ रही है voice पेटी. एक बार confirm कर लो. My voice is good or not, if I am audible or not to you. News की तो voice आ ही रही होगी, normal voice भी clear है. Please refresh the YouTube. अगर आप YouTube में देख रहे हो तो एक बार check कर लो refresh करके. मैं बोल नहीं रहा हूँ continuously इसलिए.
Is the best place in the world to do business, and as the president has shown great courage, as the secretary has said, in choosing to retaliate against China even higher. Elena, go ahead.
Hi, thank you, Treasury Secretary Bessent. Can you explain more of the decision making on what feels like a reversal here? I mean, just these went into effect less than 15 hours ago, these tariffs. Why the pause now? What led to that?
No, again, President Trump created maximum negotiating leverage for himself, and which tariffs went into effect 15 hours ago? The ones that we have lowered went into effect a week ago. They were announced a week ago, and we have just been overwhelmed by the response from mostly our allies who want to come and negotiate in good faith. So we are expecting them to come with their best deal. As I said a week ago today, don't retaliate, hold your ground, let's see what happens. And China, they kept escalating, and now they have 125% tariffs that will be effective immediately.
Mr. Secretary,
go ahead.
Mr. Secretary, thanks so much for doing this. The 90-day pause on the reciprocal tariffs, is that because of the whiplash that we've been seeing seeing across the financial markets? How much was, what we saw in the stock markets, a part of this decision?
No, it's because because of the large number of inbounds. We've had more than 75 countries contact us, and I imagine after today there will be more. So it is just a processing problem. Each one of these solutions is going to be bespoke. It is going to take some time, and President Trump wants to be personally involved. So that's why we're getting the 90-day pause.
Clarification, Mr. Secretary, there was that you and Secretary Lutnick were in the Oval Office with the President talking about this. Can you talk about what that conversation was like and what you guys said to one another that led to this decision?
Look, it's all the President's decision, and the President had a level in mind to raise the China tariffs, and then he had the 3-month pause in mind, and we were discussing the exact wording. Sorry? Of course.
It's the President's decision.
It's the President's decision. It was the President's decision to wait until today. And again, as I've said in the past, no one creates leverage for himself like President Trump.
Mr. Secretary,
Shelby, go ahead. Mr. Secretary, what does the President want to see by this, I think it's July 9th deadline to keep things paused? Is it just trade barriers coming down, or is it more than that?
These are trade negotiations, but if countries want to come and offer other things, I talked about yesterday that we are thinking about a big LNG project in Alaska that South Korea, Japan, Taiwan are interested in financing and taking a substantial portion of the offtake. But again, in essence, that is trade because it will decrease the trade deficit that we have with those countries. So everything's on the table.
Mr. President, Secretary, a clarification on the 10% on the pause. What happened to those countries who just had 10% baseline tariffs, like Brazil and others? Are they still going to have this 90-day pause? Because you were saying that there will be a tariff of 10% from others. So what happened to those who just had a 10%?
Yeah, that's going to remain.
Mr. Secretary. And do you call this an embargo to China?
Pardon?
You call this an embargo to China, a trade embargo?
I'm not sure what you mean by the word embargo.
125% tariffs, like on those, and then impose 84%. Isn't this an embargo?
Well, it's not. It's China's decision that we have the deficit with them. They sell us almost 5 times what we sell them. So again, I think it's an own goal by China.
Mr. Secretary,
Mr. Secretary,
does this signal that you're confident that you're going to be able to strike a satisfactory deal with all these 75 nations that approach you?
It signals that President Trump cares about trade and that we want to negotiate in good faith. And as I said, each one of these is going to be a separate, bespoke negotiation. So we are confident that having seen the other side of where this could go, and it was like I said last week, the market didn't understand. Those were maximum levels. The countries can think about those levels as they come to us to bring down their tariffs, their non-tariff trade barriers. We're going to discuss currency manipulation, subsidy of labor, and industry.
Secretary, as far as you, will the pause also apply to the sectoral tariffs that the president has announced, pharma, lumber, anything else?
No, it's on the reciprocal.
So those will still be coming here soon, right? Mr. Secretary, as far as the negotiations with the 75
Andrea, go ahead.
Mr. Secretary, so I want to ask you about what you're doing here. So the market is reacting crazily, right?
I haven't seen it.
Do you think that this move is going to change and calm down the market reaction?
What?
The markets have tanked, right? There's been a lot of volatility in the market, not just in terms of stock markets, but also in terms of bonds. So will this move, in your mind, do you anticipate that this is going to calm the markets down?
Well, I think what we've seen, I think the willingness by more than 75 countries to come and negotiate, I think now the market understands that everything they saw last Wednesday was a ceiling, and now we have a 10% the temporary floor. And I think the market, my 35 years in the market, I always wanted certainty, so I think we've got more certainty.
But Mr. Secretary,
Maggie, go ahead.
Mr. Secretary, why do people assume this is the last word? The president began this morning saying, be cool. 5 hours later, he announces a new policy. Why will investors in the market assume that this is it?
Because, again, as I said, we've given 90 days, and the only certainty we can provide is that the U.S. is going to negotiate in good faith, and we assume that our allies will too. And in terms of certainty, we will see what China does. But what I'm certain of is that what China is doing will affect their economy much more than it will ours, because they have an export-driven, flood the world with cheap export models, and the rest of the world now understands, because when we put up our tariff wall, those exports were already flowing to the rest of the G7 and to the global south.
And you think
Mr. Secretary, how much of this decision was driven by the bond market cratering overnight? What is happening? Is China selling their bonds?
I have nothing that says that, and we actually had quite a good 10-year auction today, and all this was, again, this was driven by the president's strategy. He and I had a long talk on Sunday, and this was his strategy all along, and that, you might even say that he goaded China into a bad position. They responded. They have shown themselves to the world to be the bad actors. And we are willing to cooperate with our allies and with our trading partners who did not retaliate. It wasn't a hard message. Don't retaliate. Things will turn out well.
What's your message to
Politico articles saying that the countries were getting called back.
These negotiations with these 75 countries, how long will that take? Will it be a matter of weeks? Will it be a matter of months? Do you expect financial markets to be stable during that time period?
Well, we've started with a 90-day pause, and we will see if more countries turn up, what will happen. But we have a meeting with Vietnam today, and we have one of the largest trade deficits with them, so I'm hoping it will move in a good direction. I was at the Japanese ambassador's house last night for the Cherry Blossom Festival, which was quite festive, and he and I had a good chat. They are going to send a deal team over. So we'll see. These are complicated negotiations. These are imbalances that have taken decades to create. But I think having seen the maximum level that Donald Trump is willing to go to, President Trump has created this negotiating leverage.
Excuse me, everybody. Excuse me. The secretary is obviously a very busy man. As he has said, he's had more than 75 countries that the trade team has to respond to. I'd just like to end with this. For decades, Republicans and Democrats have said that these unfair trade practices are ripping off the American people, are ripping off our country, but nobody has ever done anything to address it. We finally have a president here at the White House who is playing the long game, who is doing what is right for the American worker and our industries here at home, and he has put together a fantastic team in Secretary Bessent, Secretary Lustnick, the entire trade team who will be focusing on negotiating these good deals to put the American workers first, and we're going to get to work to do that. Thank you.
What about the EU? What about the EU? They retaliated this morning. Why are they being...
Live from the White House, the press secretary and the Treasury secretary in the driveway outside the West Wing, sparring with reporters there, answering questions after Donald Trump made clear that the 90-day review period would begin for countries not retaliating to reciprocal tariffs placed by the United States. In fact, took effect at 12:01 a.m. There's a big exception here, and that's China, now facing a 125% tariff. Markets taking off on news of this review. Scott Bessent just now saying we have a 10% temporary floor, and something we've heard him say before, Kayleigh, the initial Trump tariffs are the maximum level. The idea would be engage with this White House, we start to pull them back. Interesting to hear him suggest the president goaded China into this position.
Suggesting this was his strategy all along. And interesting to hear as well, the press secretary telling the media assembled to speak with these two that they misunderstood or were missing Trump's art of the deal, despite characterizations initially of these tariffs being non-negotiable and not a negotiating tactic. Maybe it all was for the deal at the end of the day.
You wonder if Peter Navarro read that book, because he's been projecting $6 trillion in revenue over the next decade from these tariffs that are, in some cases, maybe never going to take effect.
Well, certainly the market is hoping maybe that that's the case. At the very least, they're satisfied. Investors seem to be with this 90-day pause. Again, the NASDAQ 100 nearly 9% higher on the day. It's a 7% gain as we speak for the S&P 500. And it's on that note we turn to our colleague, Joe Weisenthal, who, of course, is the host of the Odd Lots podcast. Joe, is this just proof that investors were waiting with bated breath for the opportunity to buy the dip?
I mean, what I'll say is I think it's evidence that it's a huge relief that there's at least some impulse to take an off-ramp here. And last night, when we saw Treasury yields blowing out, when we saw the 10-year hit 4.5%, these are dynamics that happen when there is like extreme stress, illiquidity, run dynamics happening in financial markets. That can't persist very long. When you see moves like what we saw last night, I know the Secretary Bessent there said this was not a response to what we were seeing in market volatility, that it was all, art of the deal, et cetera. Nonetheless, clearly the markets were under extreme distress. And I'll just say a couple other things. The market is, I'm looking at NASDAQ 100 futures. They're still down 5.5%. The China tariffs are still huge. That's going to be, a huge effect on lots of American companies. There's the 10% sort of floor tariffs. Those are still in place. So, look, I think it's a big relief that obviously some of this has been delayed, but I think there's still quite a bit to work through here at a very minimum before there's some sort of like true all clear. Every major index is still like deeply in the red on the year. S&P is down 9.6% on the year.
Yeah, wow. Joe, it's great to have you with us here as this evolves before our eyes. One of the reporters in the driveway asked a really important question of the Treasury Secretary. Why should investors have confidence that this isn't going to change again in the next 12 hours? This just took effect at 12:01 a.m. Speak to the psychology at this moment on Wall Street.
I mean, I think there's two things. It's like, one is like, yes, we've now seen that these headlines can change all the time. I guess like it seems plausible that, okay, for the next 90 days, you get some sort of respite on the non-China companies. But I think even outside of the stock market, you have to think about actual business investing, hiring, et cetera. And we've seen the business side sentiment surveys absolutely horrendous. We haven't gotten a lot of hard data that really speaks to what was happening economically in the middle of March. Earlier in the week, we heard Larry Fink. He said every CEO that he talks to thinks the recession has already begun. Jamie Dimon talked about recession being the base case. So even with the 90-day pause in the non-China countries, it's worthwhile to think about like what the last several days have done for the business community in terms of saying like, wait, you don't know the rules. Now we don't know what the rules are going to be for like 3 months probably. And so we continue to have this environment where, if nothing else, the trading relationship is highly uncertain, which at least in the short term is not conducive to investment. But they would probably argue, there's short-term pain for long-term gain.
Well, it's incredible that these headlines hit in the 1 o'clock hour ahead of the Fed minutes, which are due to come out just a few minutes from now, Joe. I guess whatever news we might have seen in them probably overshadowed by these developments. Keeping in mind it's backward-looking minutes, and they didn't know what the tariff levels were going to be in the first place, let alone that they would be pulled back. But it speaks to the kind of uncertainty we keep hearing Chairman Powell talk about as to why the Fed isn't enticed to move in any direction, because so much is so unclear.
There's so much that's so unclear. Short-term market-based inflation measures going up, long-term ones going down. So much uncertainty, soft data going down, hard data still going up. And the other thing is, speaking of uncertainty, look, we all heard, the White House's presentation there about the art of the deal, and China has now been goaded to being revealed as the bad actor, et cetera. And okay, that's a fine story. However, last week at the Rose Garden, those reciprocal tariffs were very specifically presented in such a manner that every country that runs a bilateral trade surplus with us, which is almost every country, was per se engaged in bad acting. That's the whole premise because of reciprocity. And so, it's clearly not presented that China was anything particularly special last week. The story has evolved. The story has evolved whether it's negotiations versus non-negotiations, et cetera. So, again, I'm not surprised that there is this sort of massive sigh of relief. We actually knew that there would be a massive sigh of relief on Monday when we got the fake headline about a 90-day pause. So we knew the market was looking for something like this. But I think there's still a lot of question marks about the sort of what any negotiations would look like and what kind of economic degradation we see in the meantime.
I'd love to hear the Trump interview on odd lots, I have to say. We've only got a minute left. And we want to clear out in time for Fed Minutes, Joe. But we heard the president said last night, this is a great time to buy. Said that this morning, in fact. Everything is going to work out well. Is there a world in which you're allowing him to eventually be correct?
Yeah, of course. No, I hope so. There's a few things. It's one is obviously you hope to have a prosperous global economy, which would be fantastic. Even prior to the Trump administration, there's been a lot of anxiety about the nature of both the U.S. and really everyone's reliance on China for domestic manufactured goods. Obviously, the Biden administration tried to effect change on that respect, at least with respect to sort of cutting edge tech, semiconductors, et cetera. There is a lot that could be better about the world. Again, when you look at how much the markets sell off, that's really indicative of investors are much more pessimistic than they were about the state of the world than they were at the beginning of the year. But, look, like I said, I understand, and I think it makes total sense why there's this massive sigh of relief happening in markets right now.
Yeah. What a great chance to spend some time with Joe Weisenthal. Next Odd Lots ought to be a riot. It's great to see you,
Thank you.
At World Headquarters in New York. Kaylee, imagine what has taken place since we took air at 1 p.m. This has been a remarkable period of time.
Well, and a remarkable rally we're seeing in the markets right now, up nearly 10 percentage points on the NASDAQ 100. That index heading for its best day since March of 2020, nearly 8% gain on the S&P. They're going to have more coverage of this on Bloomberg Business Week as we await the Fed minutes just moments from now as well. Carol and Tim will take it over from New York.
All right, guys, thank you so much. Of course, Joe and Kaylee there. And folks, yes, we are taking over here on Bloomberg Business Week. Carol Massar along with Tim Stanovic. And here we've got, a rally. We've got stocks surging the most since 2020. Tim, safe to say that we are living in, I feel like, a week of superlatives.
Yeah, the S&P 500 up 7.6% right now. The NASDAQ composite up by 9.5%. The Dow Jones Industrial Average higher by 6.5%. We did hear earlier from Treasury Secretary Scott Bessent, who describes that initial Trump tariffs as maximum level. He, though, denied the bond market was impacted by a tariff change.
I got to say, it was just about, 30 minutes ago that kind of the game changed, certainly on Wall Street, as the president announcing a 90-day tariff pause on non-retaliating countries. Right now, though, our focus goes to the latest Fed minutes, and we do have them crossing, so that means off to Mike McKee at the Federal Reserve. Mike.
Well, facing an economy that was slowing but still growing with sticky inflation and a relatively solid labor market, it's no surprise that Fed officials spent most of their March 19th meeting discussing tariffs. Stagflation was on their mind with, quote, almost all participants viewing risks to inflation as tilted to the upside and risks to employment tilted to the downside. Several noted the planned tariff increases were larger than their business contacts had anticipated, and some companies were already reporting tariff-related price increases. Contacts also indicated a willingness to pass those price increases along to consumers. A couple of the participants noted it could be difficult to determine whether inflation was caused by persistent price rises or by tariffs. The labor market remains strong through the middle of March, but federal government layoffs had begun to affect employment at contractors, universities, hospitals, and other organizations. Many participants noted that business survey respondents to them reported pausing hiring because of elevated policy uncertainty. Everything considered, participants felt the net effect of government policies on the economic outlook was high, making it appropriate to take a cautious approach. And given the current state of policy and stance of policy, the Fed was well positioned, they said, to wait for more clarity on the outlook. Though some observed they might face difficult difficult trade-offs if inflation proved to be more persistent, while the outlook for growth and employment weakened. On the balance sheet, although Fed Governor Christopher Waller was the only one to vote against a slowing of the balance sheet runoff, the minute shows several participants said they did not see a compelling case for a slowdown. There's no indication whether the participants felt that this would be a permanent move or a temporary move. Guys?
All right. On a normal, ordinary Fed Minutes day, Mike, we would have some more for you, but we got to get back to the markets because we are seeing certainly a rally underway. Of course, our Mike McKee there at the Federal Reserve in Washington. Just a reminder, folks, we've got up a gain of about 395 points on the S&P 500, a gain of about 8%. We've got the NASDAQ 100 up almost 10%, up about 9.7%, 1,665 points to the upside. We've seen that momentum in the equity trade build even after those Fed minutes. So let's get to it with Gina Martin Adams.
Gina Martin Adams is from Bloomberg Intelligence. She's chief equity strategist. She's here in our Bloomberg Business Week studio. Gina, the NASDAQ 100, in fact, did soar more than 10% at one point, its biggest gain since October 2008. This is like a generational move on a daily basis for equity markets. How are you watching a move such as this based on the president's 90-day reprieve?
How much do you want to just go home?
Yes, please.
You're stuck with us.
October 2008 was obviously a very, very difficult time in the equity markets. You don't see these kind of moves unless the equity market is extremely, extremely nervous. And upside and downside moves to this extent are bad news. And I think if you think about it, October 2008 was followed by devastating declines in the equity market into March 2009.
Right, that was the low, March 2009.
Yeah, we didn't hit our lows till 2009. Unfortunately, the reality of today is just more volatility, more volatility. I don't know when this slows down. This maybe removes the Armageddon scenario. It does not remove the recession scenario that stocks still have to contend with. And that's troubling because we don't know where we're going to go for the next 90 days. The first pause of 30 days was hard enough for the economy and the equity market. A 90-day pause, I know that we're supposed to trust that this is going to turn out better, but businesses have to make decisions in the short term, and their hands are tied for making decisions, and that means a slowdown in activity. Consumer behavior had already started to shift in anticipation of these tariffs. So that it just infuses more uncertainty into the equity market, unfortunately, maybe removes the maximum downside risk, but does not altogether remove downside risk, which is a bit troubling.
I got to say, I thought about that even just personally. I was like, whoo, yay, right, market up. And then I thought, yeah, but let's see what tomorrow brings. We had a CEO on who plays in the auto parts world, and he said this environment reminds him of the great financial crisis, the COVID shutdown, and a union walkout, like among the auto sector.
Yes, Swami Konagiri of Magna.
Of Magna. And so all of that together, that's what he said this environment reminded him of. I mean, that's pretty heavy.
Yeah, it's very, very tough because decision-making in an environment where the headlines drive what it could be the economic outcomes is very, very hard, especially when the headlines change on a day-to-day basis. How do you plan for the long-term future? I think companies would be right to plan for the worst and hope for the best. When companies are planning for the worst, that generally is going to mean a slowdown in economic activity in the short run. They can't plan for the best and disappoint their investor base, right? So I think this is going to be really interesting to see how companies address it in the first quarter earnings season, because they're going to have to guide investors or at least provide some context as to how they're thinking about this environment of we don't know where things are going.
Gina, I know you don't cover individual companies, but I got to get you to weigh in on the move that we're seeing from Apple right now. It's its biggest move higher going back to March of 2020 at this point. At its highest, it was biggest move since 2008. Stock's up 12% right now. I don't understand this move because Apple relies so heavily on China.
Yeah.
China is retaliating. There is no change in tariff policy against countries that are retaliating.
President
in fact,
Trump actually
minutes before, we heard on Truth Social that the president was doing this 90-day reprieve. We saw tariffs upped on China. So why is Apple higher?
Well, a couple of reasons. As much as Trump would like to be able to tariff China specifically, China can filter a lot of goods through those companies, those countries that are not getting tariffed, that did not retaliate. So there's a little bit more flexibility in the supply chain if you can filter some of the goods through some of Southeast Asia. So, the skeptic in me says, good luck actually tariffing China, when there's a global trade is a global phenomenon, not a country-to-country phenomenon. The second thing I think is this is a bounce into deepest oversold gets a bounce back to the strongest degree. So if you're deeply, deeply oversold, you should see the deepest oversold stocks ultimately bounce back first and strongest. So I don't want to totally suggest that this is really fundamentally based. This is by the most oversold stocks on a bounce back.
Having said that, 493 names in the S&P 500 are higher as we speak, only 10 are lower. Having said that, looking at the charts of the major equity averages here in the U.S., Gina, and the straight line up, is that also an indicator, yes, of oversold, but also it is tariffs. It is tariffs that is weighing so much down?
Yeah, because tariffs have so many implications for the economy. They have implications for the currency. They have implications for the appetite for U.S. debt. This is all intermingled. This is a big, big macro phenomenon. And going from a less than 5% average tariff rate to a 20% average tariff rate would have been catastrophic. And there's no doubt about it. So if we're anywhere less than 20%, there is at least, we're removing that downside tail risk that was really weighing on stocks. Is this actually going to emerge, this kind of tail risk? And so we've removed that to some degree with today's trade.
I think one thing that really had investors concerned and had executives concerned was that they didn't see an off-ramp to tariffs such as these. This was what the president wanted, and it's what the president talked about, and it's what he implemented. Does the pause just mean we're kicking the pain down the road 90 days?
This is the concern. We don't know where we're going to be 90 days from now. Just like we didn't know where we were going to be 30 days from now, and the tariffs ended up getting imposed on Canada and Mexico, and then we sort of reversed out of some of that. Where are we going to be in 90 days?
The second quarter will be over.
We will have tariffs on somebody. Tariffs are moving higher, incrementally higher, which is eroding the profitability outlook for the S&P 500. How much it erodes it is now the question mark. How much does it erode the economic outlook? How much does this create really difficult conditions for the Fed to try to ease? Because in the short run, we will have inflation. We know this. Consumers are already pulling forward purchases. So we know that we're going to have inflation, and growth is probably going to look kind of okay. But companies can't plan on that into perpetuity. They can't plan on stability. And until they can plan on stability, it is growth eroding.
Two things, and you mentioned the Fed in those minutes, and Mike mentioned this, that the Fed said it may face difficult trade-offs if inflation is more persistent, and this is something we've talked about, especially if it's a slower growth environment or a recession. You mentioned, though, earlier the connection between tariffs and U.S. debt, right? And we've all been watching the U.S. Treasury trade and, the auctions today, which the auction today seemed to have gone well. Explain that connection and why that's such an important one.
Yeah, so companies that export a tremendous amount into the United States need some place to put the earnings from the exports. The countries that have tremendous exports, that ultimately drives demand for dollars in U.S. Treasuries. So to the degree that we are going to cut off the trade, we are going to say we no longer want your imports, they no longer have a reason to buy U.S. Treasuries, U.S. dollars. So it just removes that source of support, that source of demand. It doesn't mean you can't find it elsewhere. You can find it domestically. You can find it in other trade partners. But it's incredibly complicated. If we move to an environment where we're not an importer of goods, the need for U.S. dollars, U.S. financial assets is more limited. Right. And I think that we're going to have to work through those dynamics. We've already seen this occurring with China over the last 10 years. They've reduced the degree to which they owned U.S. Treasuries. They've shortened the duration of their ownership of U.S. Treasuries. As they've pulled back from trading with the United States, China's dependence on the U.S. is much, much lower today than it was 10 years ago. They recognize that the U.S. is pushing back against them and has reacted accordingly.
Carry that through. What are the implications of that?
Yeah, the implications are if we can't find another buyer, we can't find more demand for U.S. Treasuries, U.S. yields ultimately end up higher. U.S. borrowing costs are higher. The cost of, levering up to grow in the U.S. is higher. The hope is that this doesn't happen. We can rebalance, right? We can also rebalance the U.S. fiscal situation, which is another leg on this overall scheme. But in the near term, it means we've got to find a new buyer for U.S. debt if we're going to reduce the demand, effectively force reduction in the demand for those securities and U.S. dollars through trade policy.
Gina, before we let you go, you've shared with us your concerns a lot over the last week. And I'm wondering if you're more concerned, less concerned, or unchanged, given the move that we saw today in the news from the White House, than you were when you walked into the office this morning.
It's very, very early. I'm fairly unchanged. I'm still very concerned about the signal effect. I'm very concerned about, this such volatility and signaling to the international investment community about the sustainable investment aspect of the U.S. economy and the U.S. financial markets. The dependency on a single person decision making is, I think, disturbing to the international investment community. We have no understanding of where we're going for the next 30 days. We're just supposed to trust that it's going to be better. I think that's really tough for decision making, for investing in portfolios. Long term, equity investment is about investing in the companies, but the companies are being battered around by policymakers at this moment in time, and that creates a lot of distortions. So I'd say I'm kind of neutral with where I was this morning, still concerned about downside risks, still hopeful that companies will find their way through and navigate their way through the turmoil. Still looking for opportunities to emerge in global equities as they do. Certainly we've seen gigantic movements to the downside, and especially some global equity markets that are not as overpriced as the U.S. equity market is. And so there still are a number of opportunities that are emerging, but it's tough to see through a lot of these clouds right now.
And the risk is in 90 days, we could be where we were yesterday, essentially, right? Or how we started off the morning.
Yeah, I hope that's not the case, because it does seem that, we started off the morning assuming that this is our reality. And now we at least have some opportunities for maybe negotiations or some differences, or maybe not quite as much near-term spike in inflation and disruption in the economy. So net, hopefully this improves conditions, but it's a hope, and hope is not a strategy.
Good stuff, as always. Gina, thank you so much. So appreciate. She she creates our equity strategy here for our Bloomberg Intelligence team in the U.S. market. So appreciate it. Gina Martin-Adams, she's been pretty busy as of late and keeping us up to date on the markets. Gina, thank you so much. We're going to stay, though, with the markets, Tim.
I do want to bring in Bloomberg News senior editor Ed Harrison, who joins us from Washington, D.C. this afternoon. Ed, I'm just looking at the S&P 500 up 7.8%, the NASDAQ Composite up 9.8%, the Dow up 6.6%. We were talking to Gina Martin-Adams just now. Days like today do not come around often when you're looking at the history of single-day moves in U.S. equity markets. Your immediate reaction to the moves that we're seeing right now?
My immediate reaction is fairly similar to what Gina was saying, Tim, and that is that nothing's really changed dramatically. In fact, if you think about what the market expected before Liberation Day a week ago, they expected across the board tariffs at the most, say, 10%. And we've gotten that right now, even with the reprieve. And we have more than that, meaning that China, which is the one of the U.S.'s largest trading partners, we're effectively in a trade war, the U.S. with China. And so all of the downside risks there in terms of growth are still available. All of the upside risks to inflation are still there. And the uncertainty that creates basically means that there's no reason to invest for companies over the near term. So all of the things that are keeping the economy weighed down are going to continue to be weighed down even after this. So we've just had a relief rally, but ultimately the economic paradigm is effectively the same.
I mean, the economic paradigm, right, Ed, doesn't change unless President Trump says, roll back, we figured it out with China. Happy trade, everybody. Let's go back and forth to kind of where it was. We've worked it out, and we're going to leave it there. And I promise for 4 years, we're going to leave it there. I mean, that's a big ask.
That is a very big ask. And even if he were to do that, we would still have the 10% tariffs, which legitimately were the worst case scenario that people were thinking about ahead of time. And, you know, it's interesting as this is all developing. I'm looking down at my phone, and I saw at most 30 basis points up in the 2-year Treasury bond. And you know, you saw a massive flattening of the yield curve because the 10 and the 30-year are up much less. What we see now, especially after the minutes from the Fed, is that people are starting to recognize not only has everything, we've only taken the biggest risk off the table, but now we get a little bit more clarity about what the parameters are. That is that the Fed is so worried, according to their minutes, about inflation that they're going to be on hold for a considerable period of time unless we get into the most dire situations like recession. So to the degree that equities are rallying, bonds are really selling off in a big way.
Well, and it's interesting because one of the things like Tim brought to my attention, and we've been thinking about this, is the chatter that is kind of out there on Wall Street. You know, I remember so often when the Fed felt like things were getting stressed out, you know, in terms of credit markets and the financial situation, that it would surprise us with a rate move. And so there's some chatter out there based on those Fed minutes, and they're based, of course, on the last Fed meeting, which was about 3 weeks ago. That's not what they're thinking. They're thinking we still got to be on the inflation fight.
Yes. And, you know, I would add this piece to the discussion. I truly believe that we are going to very soon have, the next fight is not between China and the U.S., it's between the Fed and Donald Trump. That is that Donald Trump has already said that he wants interest rates to be cut. To the degree that we see interest rates going up the way that they are now, that's going to put the Fed right in the bullseye for Donald Trump, and he is going to take action in the way that he has in other instances. So this is going to be a crisis of confidence about the Fed's independence, and that's what's coming next.
I've also had a couple people just in the last hour, Ed, and this is not by any means your area of expertise, but I do want to get you to weigh in on this. They've raised the question about the president sending this post on his social media network earlier, quote, "This is a great time to buy DJT." DJT is, you don't know if he's signing it DJT or if he's actually alluding to, the ticker of Truth Social. He sends this out this morning, and then we get this announcement where we see this massive, massive rally. Is there concern about the president doing such a thing like that?
You know, I don't think that there is any concern about that anymore because, let me just be honest, the emolument clause, everyone was talking about that in Trump 1. No one's talking about that in Trump 2. We have a completely unfiltered Trump. And the reason I was talking about the Fed being in the bullseye of the Trump administration is because Trump basically can do whatever he wants at this point in time. There's no filter. There are no guardrails.
Well, the reason I bring it up is because critics would say this looks like market manipulation.
Right. There's nothing we can do about that. I have no opinion on that. I'm just saying that this is what's going to happen. This is the world that we live in now.
Yeah, and I should point out that Trump Media and Technology, it is soaring. It's up about 18% in today's trade, so along with the overall move to the upside in U.S. equities. And so you're seeing about $708 million added to the market cap. It's now about $4.5 billion in terms of market cap. Ed, so appreciate getting some time with you. We know it's busy, a lot to keep track of. Bloomberg News senior editor and author of the Everything Risk newsletter. Check it out on the Bloomberg and at Bloomberg.com. He is Ed Harrison joining us from D.C.
Well, let's stick with our coverage and specifically talk about China because President Donald Trump said he would pause higher reciprocal tariffs for 90 days on dozens of trade partners while raising duties on China to 125%. I want to bring in Bloomberg News global economy reporter Enda Kern. He joins us from our Washington, D.C. bureau. And I feel like this part of the story is being lost a little bit. It's being buried a little bit with the equity market reaction here. China, obviously a huge trading partner to the United States. 125% tariffs are incredibly significant. Why do you think that part of the story is not getting through?
it's because we're just being conditioned by the news flow, I think, to look for relief where, where markets want it, so to speak. And this news that President Trump is putting that pause on the global reciprocal sounds like a great thing, but to your absolute point, we have extraordinary tariffs now on goods between the world's biggest two economies. It would now be over 125% on Chinese goods coming into the US. China is the third largest source of goods for the US after Mexico and the EU. And then, of course, China is retaliating with 85% tariffs, 85% tariffs on US goods, but also lots of warnings there about non-tariff retaliatory measures as well. So the point is the world's biggest two economies are locked in an extraordinary trade war. We haven't seen this before. It is, of course, going to impact prices more so in the US economy, and growth and economic activity in both economies. And the key point is that there's no real sense of an off-ramp just now. I mean, we've had the officials out this morning, Jameson Greer, Trade Representative, yesterday and today, Treasury Secretary Scott Bessent yesterday and today, making the point that they're not saying there's any olive branches coming from Beijing. And of course, Beijing certainly would make the point that it's up to Washington to come and talk to them. So no hint of an off-ramp, very new territory and very, very serious stuff for the world economy.
Well, just give us some numbers here and about how crucial of a trading partner China is. I was telling Gina Martin-Adams earlier that the move in Apple confuses me to the upside of close to 10% at this point, because it is a company that relies so much on China. We had Dan Ives on earlier this week from Wedbush, and he basically said, if you look at the Mag 7 companies, if you look at all the tech companies, this is the one that is most exposed to China. So why, in your view, are we not seeing a reaction negatively to Apple?
Yeah, well, look, in the case of Apple, I don't know the idiosyncratics, but it might be the case that people think they can diversify out of China, and they will do. I mean, they've been flagging, investments in other parts of the world, India, for example, some in the US. So it might be a diversification story. But to your broader point, the big issue is that the US remains, China remains a critical source of both consumer goods and intermediate goods for the US. And I think the figure is around 30% of all imports into the US really rely on coming out of China, right? They depend on China. There's stuff that's made there that isn't made anywhere else in the world. And when you speak to businesses here, manufacturers and others in the US, they will tell you time and time again they buy certain components from China because it's A, the most competitive place they can source them, and B, some of that stuff is not made anywhere else in the world. These kind of industrial intermediate goods are made in China, that's what they do, and that's where they source them. So this is going to be very complicated for US business. It's going to be very complicated for US households and consumers. Remember, also getting lost in the tariff news on China is the de minimis changes.
Good point.
The lower income, and there's literature that suggests lower income households rely on the de minimis purchases. They're going to get hurt. That's about 90% now. So yes, a big relief on the global trade story today, but the China-US story is only getting started.
Well, that's where I want to follow up, and something you said that, there's no looking for an off-ramp between U.S. and China. Is that because, Enda, there is no off-ramp? I mean, we have talked about decoupling between the United States and China for a long time, but they need each other. Is that correct?
No, they do need each other. We wrote about this. We wrote about this today. Decoupling had gone off the agenda. It was all about de-risking. And by coincidence, by the way, 1 year ago this week, then Treasury Secretary Janet Yellen delivered remarks in Beijing saying the US and China would never decouple. To do so would be disastrous for both economies. 1 year later, here we are talking about 125% tariffs in one direction and 80-odd in the other direction. So they can't fully decouple, but we're a lot closer to it than we thought they were. You will start to see supply chain shift. Companies will have to move their production around. There's no question about it. Consumers will start changing up where they're buying their stuff from. And then in terms of where can there be a deal, we can't necessarily speculate, but we know President Trump talks about China has to bring down all of their barriers to allow more US investment and trade in China. So that's around IP protection, the currency, the exchange rate, that kind of thing. I'm not quite sure what China would be demanding per se, but it's not. And of course, I should also say part of the mix could be more Chinese investment in the US is one possibility people talk about. But either way, those are talking points. We're at extraordinary levels of tariffs. The rhetoric from both sides. China says they will fight to the end. President Trump showing no signs of a climb down on the China side either. Right now we're still at the retaliatory phase. Negotiations seem some way off between the both of them.
And what's the impetus, or what's the motivation for a company that has a supply chain based in China or significantly exposed to China to move to another country right now, when just last week we heard tariffs announced on pretty much every single country in the world? Trump 1.0, I imagine, and during Trump's first term, we saw that, and we did see that with many companies. But just last week, they were punished as a result of these tariffs. I guess what I'm saying is, since there's no certainty there, and those other, tariffs could come back if there is retaliation, why would a company make an investment such as that?
And that's completely the issue. Companies are confused. I speak to companies all the time. They say, we'd love to move out of China, but nowhere else offers the scale and the infrastructure that China has, or the costs. And anyway, even if we did move, what happens if we get caught up in a tariff dragnet, which is, to the point you're talking about? And by the way, a lot of these manufacturers that we speak to also make the point they would love to come back and produce in America, but it is just too expensive, too costly, regulatory environment, environmental burdens, skill set, all the rest of it makes it very hard to do so. So there's a kind of school of thought out there among corporate executives that let's just hang tight, ultimately see how this goes over the next year, 2 years before they make real big capex decisions. But if you're a smaller company on thin margins, which a lot of these operators are, you can't cope with a 125% tariff.
What does the president, I am curious, the president has talked in the past about being kind of a friend with President Xi, right? A great relationship. What does he really ultimately want from China and President Xi here?
Well, we have to get that articulated, but as you say, over the years, President Trump has veered between something of China Hulk, obviously, to willing to do business with China. We saw that, of course, during the TikTok back and forth. Again, one would expect the ask from the US side is around better market access into China, freer market access. IP theft is a big issue there. The exchange rate, obviously, President Trump says they keep the exchange rate too low. Treasury Secretary Bessent warning about that this morning. That's one side of it. And maybe also, sometimes there has been a hint from the administration that China could come and invest here more. That would be seen as a positive. But, we can't go too far down the world of the speculative route because we don't quite yet know what the specific asks are. But one would assume it'll be around trade and investment. But as I say, we're not at the negotiating stage yet. We're still in the retaliatory stage.
I am curious, too, what you guys are hearing there at the D.C. Bureau about what is going on inside the White House when it comes to U.S. and China. I think there was a headline overnight from Reuters about maybe U.S. and China talking today, or China planning to talk with the U.S. Do we have any clarity around that or any transparency around that?
I don't think certainly the signals from the White House in terms of the public commentary does not lend itself towards anything meaningful near term in terms of negotiations. As you say, both sides have retaliated. China only yesterday, the US again today. We're still in that tit-for-tat stage. That will have to cool down before real talks get going. And I think there's no sign of anything meaningful on that front just yet, Carol.
Okay.
And what are the positions of the United States and China from a bargaining perspective, from a leverage perspective? Take us through what position the U.S. has, how much leverage it has, and how much leverage China has. What's the matchup here?
Well, if you think of it in terms of tariff tennis, it's advantage U.S. in a significant way because the U.S. buys a lot more produce, a lot more stuff from China. So think of the U.S. as being a big customer of China, and now the customer wants to change up things, doesn't want to buy as much, wants to change up the pricing, change up the order book. So there's a lot of levers the U.S. can pull to make things difficult for Chinese manufacturers, exporters, producers, all of that. Now, that doesn't come without cost to the US because the US will have to source products and material from somewhere else. That will be expensive, and the stuff they continue to buy from China will be expensive, so there's a hit to the US there. On the China side, obviously there will be a hit to their manufacturing base. There will be a hit to their economic activity, no question about it. But China can mix things up a little bit. They can start buying more of their own produce, something a lot of countries call for anyway. They can start looking for other markets to substitute. So leverage on both sides. but also pain on both sides, and that's why economists warn ultimately this won't get anyone anywhere.
Hey, I am curious too about the Chinese economy. President Xi, as you write today, has shown his willingness to gamble with the Chinese economy in the name of consolidating power. I mean, is he willing to gamble a lot here? Because we know exports, Chinese exports, and selling to the world is crucial to that economy.
Well, he's probably willing to take a stand against the US. That's no question about it, and he's showing that so far. I think it's a question of how much pain can the economy withstand, how long will this trade war go on, when or will there be an off-ramp, and then also this diversification point I made earlier, can China meaningfully look for other markets? Can they buy more of their stuff at home? You know, those are the questions. So China still has some cards up its sleeve as well. It won't be all one-way traffic, but as I say, both economies will feel an impact from this, Carol.
All right, we're going to leave it there. Hey, Enda, thank you so much. So appreciate it. Enda Curran there in D.C., of course, following the global economy. Just if you are just tuning in and watching us, President Trump announced a 90-day pause on higher reciprocal tariffs that have hit dozens of trade partners after midnight. But keep in mind, at the same time, President Trump raised duties on China to 125%. We've had some retaliation ahead of that from China against the United States. And on the back of this, we have seen a rally, certainly in the equity market.
A rally is one way to put it. Maybe Vince Signorella would call it a rip-your-face-off rally. The NASDAQ composite higher by 10.9%. The S&P 500 up by 8.5%. The Dow Jones Industrial Average up by 7.4%. I do want to bring in Vince Signorella. He's Bloomberg News macro strategist. He joins us this afternoon from White Plains. How do you describe the market action, the tape today?
Ripping your face off is a really, really good way to put it, Tim. I mean, this is, you know, I've often get asked by traders, what was it like trading in the 80s? And this is about as close as I've seen it in a very, very, very long time.
So for those who weren't around in the 80s, we were.
Yes.
What does that mean?
The volatility was fantastic. I mean, you have to remember this is pre-Euro, so you had every country had their own currency, and there were days where you could see the German mark move 10 big figures up, 10 big figures down, then 5 or 6 up again, back and forth. Like, I mean, you could see a 30 big figure day in one day back and forth. I was trading cable during the 80s after Maggie announced her reelection, and sterling went from this very sleepy currency to moving 3, 4, 5 big figures in a day. And to put that in perspective, just a £1 million position on 5 big figures is a $50,000 change in P&L. So when you're trading 50 to 100 million pounds, you can imagine that if you get that wrong, you could give a bank away in a heartbeat. So, you know, we haven't seen anything like that until literally this week, and I'm tired.
Well, it's only Wednesday, Vince, so you got a couple more days to go here. Hey, Gina Martin-Adams said a move such as this concerns her, whether it's to the upside or whether it is to the downside. This doesn't make her any less concerned about the direction of the U.S. economy, about what earnings we're going to get as companies start to report. We heard from Delta earlier today, the company suspending its guidance for the year as a result of concerns over tariffs in the economy. We're going to hear from J.P. Morgan on Friday, among other banks. Are you concerned about a move higher like this?
No, I'm sure what Gina was referring to, whose analysis is brilliant, by the way, that the difference between Main Street and Wall Street. I mean, this is just Wall Street. Main Street it needs to react in a completely different way to this, what the tariffs really mean to them, what it's going to mean for earnings. A move down or move up in the stock market doesn't necessarily change the scope of what it does if you're the CEO or CFO of a company trying to source trade and look at what your cost price analysis is going to be going forward. And again, obviously, earnings are a big picture. I think it's going to be interesting is to see what sentiment indicators look like on Friday. And of course, we got inflation in terms of CPI, PPI coming up in the next couple of days as well. I wouldn't worry so much about the stock market. This is just a lot of back and forth on headlines. It is completely separate from what the real economy is going to be doing. I was encouraged, though, by Bessent's comment earlier this morning, where he said he was going to take sort of front and center of the trade negotiations. And that seemed to put both Navarro and Lutnick on the backbench, which I think that was the real encouragement, I think, for investors, and that sort of the sound mind, the sound voice coming from Washington is going to speak. And then later today, basically saying he was going to try to get an alliance together, if you will, try to make individual trade agreements with all different allies, and then form a consortium of sorts against China, which really would put China in a box if he were able to do that, because that would be a really, really strong negotiating power. You're not just talking about sort of NATO or Canada and Mexico. You're talking about Latin America. You're talking about Japan, talking about Asia, Europe, the whole lot now facing China and saying, this is where we stand. We're tired of, patent infringement. We're tired of the non-monetary tariff situation. We're standing up to you now. What are you going to do? And if you don't capitulate, we're all just going to play nice with each other. And that's going to put China, I think, in an extraordinarily difficult situation. I know what Enda was saying about it's not an all one-way street, but I think in this particular trade war, if Bessent pulls off what he's trying to do, it puts China in an incredibly difficult situation and one they can't win.
Yeah, exactly. And I keep thinking of the interview that Sonali Basak had with Boaz Weinstein, and the whole idea of the one thing that's difficult is that President Trump presumably will be in the White House for 4 years in total, and that the uncertainty genie is out of the bottle. And we have seen that this is a president, and I think it's fair to say this is truthful, is that he can change his mind on things, and that level of uncertainty, and it's ramped up more than maybe we saw in the first administration. And there are not the guardrails necessarily. I know you talk about the Treasury Secretary, but it's taken a while, I feel like, for maybe a potential guardrail to come forward. So I just wonder, Vince, traders like volatility, but CEOs don't, right? And consumers don't. They need things to be, certain at this point to make decisions and to spend money. So I am just curious that this trade, we could see another sell-off tomorrow. I mean, are there any guarantees at this point?
No, I don't think there are any guarantees whatsoever. And I think you make a really, really good point. Corporations, CEOs, CFOs do not like this. Consumers certainly don't like this. I think what you're going to see is probably a little pullback in investment, particularly CapEx. From corporations, particularly the larger corporations. You're going to see mid-sized small businesses be very, very cautious about how they spend money. One of the big things that, I ran a small business, and one of the key things about running a small business is cash flow. And the last thing that you want to do is put yourself in a situation, it's a difficult situation. You want to spend money on inventory anticipating, price increases, but at the same time, you need to preserve cash flow, because you could buy all this inventory and then nobody comes in to buy it from you.
Correct.
Because they're worried about the future. And so now you're stuck with shelves that are full of lower price items, but still nobody wants them. So, for a smaller business, it's a really, really tough situation. For mid-sized businesses as well, the big companies, PepsiCo's of the world and such, they can withstand this for a while. Apple's of the world, they've got the balance sheet to eat that inventory for quite a long time. But other businesses do not. And that is probably going to weigh on both sentiment, spending, and the economy. We're still looking at first quarter growth pegged from the Atlanta GDP at minus 2.4%.
Right, down, but not as bad as it was, but still down. And
from 2.8 to 2.4. You're absolutely right.
But we just have a headline crossing: Goldman Sachs rescinding its recession call after this move by the president on tariffs. I feel like it's like bing, 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 ricochet rabbit. Yeah. Like you are just seeing people who just
and only you and I know who that is.
Google it, everybody. No, but it's just right. Like so that's the world we live in, right? And so that's a difficult environment.
It's totally, Goldman made this call literally before the announcement. So they couldn't have timed it any worse. Not that, it was their fault. And so, of course, they're pulling it back now, and it speaks exactly to what you say as to how businesses are trying to find their way in this world, and they're constantly changing their mind. And when you have that uncertainty, if you're running a business, you're going to basically say full stop. We're not investing. We're not hiring. We're not moving forward with plans at the moment. Let's shelve everything. We're going to keep looking at the situation. We're going to wait and see. And then, more likely than not, they're going to wait and see for things to really develop before they step in. You don't want to step in on day one thinking, again, maybe somebody changes their mind. Right. You're going to want to see this develop. I think in the long run, this will develop positively. I think that China will eventually. Trump is going to need to look for a way to give President Xi a face-saving way out, to give him an opportunity to come to the table to have this conversation. If that happens, I think you can just, wipe all of this away, starting from, the beginning. Things are going to move positive. I think you'll see a lot freer trade, a different form of globalization, if you will.
Vince, to the point that Carol just brought up, this headline crossing that says Goldman Sachs rescinds its recession call after the Trump tariff pause. I'm confused about what fundamentally changes here, because as we heard from the Treasury Secretary, as we saw in that post from the president, this is a 90-day pause on countries that are not retaliating right now. This doesn't seem like a fundamental shift in the way the president is thinking about tariffs. Why is the recession risk removed then? At least according to Goldman.
Yeah, but if you think about the countries that are retaliating, it's really just the European Union, Canada, and China.
Those are big trading partners.
Yeah, no, but Canada's in a different situation. Carney's running for re-election, so you expect him to talk tough. One would assume he is the front runner at this point. He is the odds-on favorite. Will he change his tune after he is elected? I think he will. I think he's going to look to do something positive for Canada, and that's going to be, listen, we're allies. Let's cut this out. We're not enemies. We're allies. Let's put this aside and let's figure out what our differences are. Similar to what Scheinbaum is doing in Mexico.
Right.
I think
that's a good point.
I think the EU is definitely going to come around again because they're not in great shape right now.
There was a question shouted at the Treasury Secretary as he was walking away. What about the EU? What about the EU? Because they have retaliated. So we'll expect to hear maybe something on that, and we will bring it to you when we do get an answer. Vince, thank you for jumping in today. Vince Signorella, he's a global macro strategist. He's joining us from White Plains.
Tick by tick, great analysis. Hey, also great analysis if we head back to D.C. because that's where we find Bloomberg News senior White House correspondent Josh Wingrove. Josh, as I like to say to you, nothing going on. Oh my God, whiplash. So what's the read on here? 90 days, this is a big reset, but we're all waiting to kind of hear what happens with China.
Yeah. So there's a couple of details hanging in the air here. They said 125 on China. It's not entirely clear to me yet what that means. The combined rate was 104. That was 84 as of today, plus the 20 from fentanyl. So it's a little unclear.
Poor Josh with the math.
Cumulative. We're working on that still right now. Secretary Besson seemed to indicate some sort of change for Canada and Mexico. It is unclear what he meant by that or whether it was sort of a garbled question. So we're working through that as well. But it seems like 10% global tariff with perhaps some change of Canada and Mexico included in that or left on their previous regime, and certainly a higher rate on China, although the specifics TBD, but like a rate that is so high that it is almost prohibitive to most trade there. And then from there, negotiations, and we'll see where that goes. Now, I'm old enough, which is to say I'm at least 2 days old, to remember when a 10% global tariff sent markets in the other direction, and here they're going pretty upwards. So, there's a lot of moving parts here right now. So I guess investors have come to peace with the notion of a 10% global tariff. You guys tell me, where are we on that?
Context, relativity. I don't know. It's kind of wackadoo. I guess what's weird is I don't have to tell you, right? The president can change his mind. Who's got his ear right now?
It's a great question. So we reported yesterday that the range of this internally was Peter Navarro on the hit everything with a hammer as big as you can kind of end, and Scott Besson on the be careful what you break end. And today, it was Secretary Besson who came out and spoke to the press. It was Secretary Lutnick who said that he and Secretary Besson were in with Trump when he issued his statement on Truth Social. Secretary Lutnick did not mention whether anyone else was there. That invites the speculation that it was those two in the room with him when he made this decision. We'll see right now. The White House has said repeatedly that no matter sort of the palace intrigue of who is in what room and what position they are taking, that they're all on the same page. And that is true. In some ways, that's been one of the remarkable things about it. Even as markets were reacting the way they did, every single member of Trump's cabinet and his economic aides were singing from the same song sheet and really not allowing themselves to express any sort of doubt publicly about this. So publicly, they are aligned on this. Internally, there were deliberations. The White House sees that as sort of a feature and not a bug of the way Donald Trump does business. But if you believe Secretary Lutnick, it was him and Besson, at least those two, perhaps only those two, who were in the room for this meeting on lunchtime, which appears to also have been somewhat hastily announced, and that Secretary Besson was scheduled to be on Capitol Hill, scrapped that, did the meeting with Trump instead.
What about the other folks, some who have been supportive of the president and recent supporters of the president, those like Bill Ackman or Ken Griffin, maybe Jamie Dimon early this morning with his call and concerns about a recession? What do we know about how influential those outside voices have been?
We should put that down.
It's evolving, but certainly the voices of dissent from Trump world started with those like key market figures. Elon Musk, of course, signaling sort of pro-free trade, anti-tariff stances in a very conspicuous way, and then very explicitly, having personal criticisms of Mr. Navarro, the trade hawk and Trump advisor. And so I think it sort of emanated from that. I think we'll see some questions in the coming days also about the president's tweet this morning that, people should sort of stay cool and that it's a great time to buy. People that took that advice will have made a pretty good return in the following few hours. So lots of dynamics here to pull out, I suppose. But I think the top line is that President Trump is refocusing, reallocating his attention and his tariff sort of push on China squarely. The question is, of course, how China will respond, if they will respond further, and that in the meantime, we're going to get this sort of procession of delegations and trade delegations, coming to Washington to try to strike some deal, to defer any further tariff hike. I will note that Trump has consistently signaled that they don't want to go below that 10%. I think whether that has changed is now an open question. But for instance, Australia, where the U.S. has a trade surplus, kind of checks all the boxes that Trump wants to check. They had 10%, and people in Australia were wondering what gives with that. It felt like 10% is the floor. They've been treating it as the floor. And so I think the negotiations that are coming in the next 90 days are aimed more at staying at that floor than, finding a number below 10. But again, it just remains to be seen. And then as for China, we'll see. The TikTok deal is also something that Trump has sort of linked to all of this. A lot of uncertainty swirling.
Hey, listen, one of the things, too, Josh, overnight, I keep asking about this. There was a Reuters headline, China plans meeting on U.S. tariffs as early as today. I'm assuming that's internally that they meant a meeting. I mean, I am just curious if we're getting any more specificity when it comes to China specifically and conversations between the two nations on that.
Well, allow me to pay tribute to our friends at the Atlantic Council who had a briefing briefly this lunch hour, which I had to drop off of to deal with this tariff news shortly after. But they were talking about the notion that China has more room to run here than maybe Trump officials realize. And I think this is an open question. White House officials have been telling me, look, the president believes he has the leverage. China is trying to dump its way to recovery. Their economy is very weak. And if we're building a tariff wall around the U.S. that is going to put China in a bind, they reject the notion that U.S. tariff uncertainty and U.S. aggression in terms of tariff policy toward its allies will drive countries sort of into the arms of China. On the contrary, they think that they can wait it out and that China cannot. Of course, a lot of China analysts will tell you that they think Xi Jinping is as better, as well positioned, if not better positioned than Donald Trump to wait out a tariff war. But right now the market reaction is like, we still have a major tariff war between the world's two largest economies and a 10% global baseline tariff by the Americans on everyone else. This is still remains a significant tariff action.
Yeah, it seems like maybe not getting the attention on Wall Street right now that a lot of people would argue it deserves, Josh. It raises the question, too, and I know you're still doing the math on this, but what would be an off-ramp for this trade escalation, this trade war between China and the U.S.?
But I think
think we're at?
That's a good question. I'm sure you guys can find smarter guests than me to answer that one. But Trump wants to see negotiations. One note in a story that we ran this morning talked about how China customarily will do these negotiations sort of mid-level and upward. Trump doesn't like that. He likes to start at leader level, and I think that story smartly noted that that is a barrier here. In other words, Trump would love to sit down with Xi Jinping at some point and, hash things out. He likes leader-level discussions. China doesn't really appear interested in that. And so we'll be looking for any sort of smoke signals between the two countries of whether there is any sort of pause in it. But right now, fundamentally, the ball is in China's court, because every time the U.S. has raised its tariffs, China has responded in kind. Trump just raised the tariff. And so I assume we'll see, for instance, perhaps a 21% tariff increase from the Chinese. And then, tomorrow will Trump raise it again? We'll see. We'll see where this goes. But right now, the message that Trump is trying to send is refocusing on China as the target and de-emphasizing others. Other people who've been alive longer than 2 days will note that this sounds a lot like the Trans-Pacific Partnership. We've been talking about that internally. The U.S. had sort of spent years talking about ways to strike trade deals in the Indo-Pacific in a way that created a bloc, a de facto trading bloc of some kind to counter the clout of China. The U.S. walked away from that. That deal kind of, stayed in place to some sort of partial degree without the U.S. And so now I guess we're going back to striking trade deals in the Indo-Pacific to counter China, just with the new brand, I suppose.
I am wondering, too, listen, Josh, for a while we said the president keeps a watch on the equity market. Do you think any of that had to do with it? I mean, we even just looked at DJT and how much that one popped. His own company, his own Truth Social media and technology company. I mean, everything is up, to be fair. But I'm just curious if we can make some of that an assumption as well, that he's back to what?
I think it's impossible to say that the market reaction wasn't a factor in the overall calculus here. But until now, Trump had been saying, hang tough. And, the pain is going to be worth the gain. But whether, I don't have reporting to say that is specifically what made him change course today. I will note that they downplayed the impact on the bond market, and they talked about the fairly strong Treasury auction that we had today.
Yeah.
Secretary Besson talking about that in particular. But, there obviously are questions about whether the pain in the bond market, in particular in Treasuries, was sort of changing the calculus as well. Remember, of course, Besson set the 10-year as his sort of like North Star objective. And so, right now, it's an open question, but generally speaking, yes, in the history of Trumpland, market reaction is a big factor.
Josh, last question, top of mind for you right now, and what's already been kind of a shake your head kind of day in terms of the news flow and the headlines, and we still got a few hours or another hour to go before the market closes. Top of mind in terms of what you would love to hear from the president right now, or what you would ask him.
I think it'd be news if he signals he's willing to go below 10%, but right now they haven't. I think people are forgetting that he's talking about sectoral tariffs, additional ones on pharmaceutical drugs, on lumber, on semiconductor chips, on critical minerals. Will they slow walk those? They have elbow room to if they want. They haven't specified a timeline. Or will they continue to do that? And if they do that, are investors going to be surprised by a continued sort of drumbeat of tariffs from this administration? But people need to remember that those are coming. And of course, then I think the third leg of that stool that we're looking for is whether China retaliates, and therefore, if the U.S. retaliates again towards that, although I will note people are, analysts out there are crunching the numbers and saying that at the current tariff levels, Trump is already declining his tariff revenue because now tariffs are so high that they're going to really materially curb the actual volumes that they're being applied to. And so it does beg the question, if you're already at 125, how many goods are sort of marginally moving between 125 if he goes higher than that, or is this already effectively a substantial barrier where anything above that doesn't really make a big difference?
I feel like my head's going to explode. Everybody, you're up to date, courtesy of Josh Wingrove. Josh, thank you so much. So appreciate it. Bloomberg News senior White House correspondent Josh Wingrove there in our D.C. bureau. We got to talk markets again.
Yeah, the S&P 500 higher surging right now by 7.4%. The NASDAQ Composite up by 9.6%. So off our best levels of the day, at least when it comes to the NASDAQ Composite. The Dow up by 6.3%. I do want to bring in Scarlett Fu right now. She's been watching the market action for the last 90 minutes. And in fact, I know is curious about today's trade, but I'm going to go to her for answers as well. My big question for you is, yes, we've talked about the tape and what we're seeing today. The fundamental change that this is based off of, how do you view it?
I think what it goes back to show is that the president is willing to negotiate. There are real serious doubts about whether that was the case, whether he was going to stick to his guns, ignore the stock market, ignore what investors were telling him, ignore what a lot of his Wall Street friends were telling him, and just follow through on his threat to impose tariffs.
He opened the door a little bit.
But he opened the door, right. And a 90-day pause, I mean, that opens the door for longer pauses, because as the Treasury Secretary reminded us, they're talking about bespoke bespoke trade negotiations. Can you get all that done when you have 75 countries lining up outside the White House to talk to you? Probably not. I mean, 90 days is just where we stand right now. It could get extended and extended over time.
Right, unless you go back and say, oh, okay, maybe not 10%, maybe I'll go down to 8% or something, right? Like, unless you just cause a blanket one. But it really does come down to these important trade relationships, whether it's U.S. and China, a huge one, as you well know, Canada, Mexico, our big trading partners, even Europe, if you throw into that. Like, these are important, what these agreements ultimately are about.
Absolutely. And what amazes me right now looking at the trading is the indiscriminate buying that's taking place. You look at FXI, the ETF that tracks Chinese stocks, or the NASDAQ Golden Dragon Index, both are soaring, even though we have a higher tariff imposed on China. Apple is climbing. It's
what do you make of that? That's been, I'm so confused by
I
this.
know, because the biggest and most important product of this company is the iPhone, and it's pretty much made entirely in China. Bank of America had that note out that said if you wanted a U.S.-made iPhone, it would cost 90% more to make. So Tim Cook, the Apple CEO, still has to go back and figure out the supply chain for the iPhone. He wants to move things to India, but that's not going to happen tomorrow.
But let's say he does. You know, let's say Apple's we'll play this out a little bit. Let's say Apple is successfully able to move more production outside of China. If they're not moving to the United States, then that doesn't satisfy the president.
Right. The cost will still be higher no matter what, because as long as it's made outside the U.S., we're looking at right now 10% tariffs, right? And over time, that can change. Who knows whether he's going to come back and say, okay, 10% was the baseline. Now we're going to tweak it and adjust it higher because I'm looking for something else from you, country A, or you, country B. I mean, really, again, what this afternoon has shown is that there's going to be lots of negotiating going forward. And if that's the case, with earnings season coming up, how as a company, how as a CEO of a company, are you supposed to give any kind of guidance that includes the impact of tariffs? You can't. How do you make a spend? How do you hire people, right? How do you hire people?
Right? Like, going back to Apple, though, you know, Mark Gurman had even put out that Apple has been working on diversifying its supply chain, India, Malaysia, Vietnam, and yet all of this, right, has been hit with tariffs. So even as they've diversified, you know, the policies.
They were able to negotiate an exemption last time around, but they weren't able to do so this time because it's clear in this trade war in 2025, it's really the U.S. versus China.
Going back to what you said about earnings, sentiment's going to be really key, right? You know, Tim and I talk about this in terms of, you guys do too, consumer sentiment, CEO sentiment. Do I spend? Do I build plants? Do I hire? Like, maybe I don't. Maybe I hold off until the dust settles.
As a consumer, I know I'm going to be sitting on my hands a little bit. Why buy something if you have no idea what's going to happen? And as a CEO, that is your fiduciary duty. It's no longer about impulse purchases at all, right? Or what makes you feel good. It's about, this is what I have to do. And you would be remiss to do anything but wait and see what happens. And hiring, of course, is top of mind here as we look at the strength of the economy, or, you know, perhaps seeing it not go into recession.
And that's why we are going to wait to hear from all these companies that are reporting starting on Friday. We heard from Delta earlier today, but we'll hear from some of the banks, including JP Morgan Chase, on Friday.
It'll be really big. Right now, folks who are watching on TV, YouTube, and Bloomberg Originals, and for those who are listening on radio, just monitoring President Trump at the White House. I believe I saw a race car before, and some kind of press event, but we're going to be monitoring it, of course, to see if he does make any comments about his news in terms of this 90-day reprieve, if you will, at least for those in terms of reciprocal tariffs. But yeah, big day. Scarlett, thank you so much. We'll be talking with Scarlett in just a moment. Hey, for those watching on TV, the close is coming your way. In just a moment, we continue on Business Week.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Minimum versus maximum, or maybe nothing at all. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Talk about an unbelievable hour and a half in the market.
I stepped out of the office for an hour. When I came back, apparently we're in a whole new tariff regime.
Literally in entirely different scenario. Let's just check it out here. The S&P is now up 7%. At one point, we hadn't seen this kind of move for the S&P since 2020, of such a large move higher. You look at the VIX here, kind of crashing down here at 36. The NASDAQ 100 at one point, the biggest move higher since 2008. I can go on for hours with these superlatives, Romaine. And the 2-year, 20 basis point move to the upside. Again, we haven't seen this in decades. Romaine, short covering or what have you, some serious moves in the market.
And in fact, the extreme volatility you're seeing today is actually going to now earn this rally, something that we haven't been able to call it up until this point. Unprecedented. Monday saw the biggest intraday point swing in history for the S&P 500 and second biggest percentage point swing since the GFC. Today, Wednesday, April 9th, is surpassing those metrics and more. The NASDAQ having its best day since 08, the Philly Chip Index up the most since 2001, and a basket of airline stocks rallying the most in history. As for the S&P 500, at one point in the day, all but 2 of the stocks in that benchmark were in the green. In fact, you have to go all the way back to December 26, 2018 to see that type of breadth. That was the day that all but one S&P stock rose. And funny enough, that 2018 rally was also during the Trump presidency, where his comments on policy leading up to that had contributed to a 19% S&P 500 drawdown before he finally jawboned a massive rebound. This time in 2025 is deja vu all over again. A 19% drawdown, also spurred by White House policy, and a massive rally today spurred by a shift in White House policy. The good news is that 2018 rebound did stick. The S&P went on to rally an additional 8% over 4 months, and about 35% through 2019 before the pandemic, of course, brought things to a halt at the beginning of 2020. But one big asterisk remains, and that is, well, the tariffs are still there, the minimum floor at least, and the threat of maximum tariffs, that lingers over the negotiating table.
Every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
Scott Bessent, the Treasury Secretary there. Alex, he didn't seem very excited, but that chart behind you shows the market certainly is.
Ooh, the market was very excited. Let's visualize what Romaine was talking about. This is intraday moves for the S&P. This is where we sit right now. This massive range for the S&P where we were down earlier and then a huge spike up by 7%. Now, a lot of you watching weren't even in the market the last time we saw this kind of spike, and that was all the way back to 2010 during the financial crisis. And you can see here we haven't seen anything of that magnitude, not even back in COVID, Romaine, have we seen this kind of thing. Now, you take a look at the SPY, for example. So that's the ETF that tracks the S&P. Shorts were already increasing. We hadn't seen these kind of shorts in about a year. So you could say, okay, maybe it's just short covering. But regardless, an historic move, no doubt.
Absolutely. One that maybe I think we'll probably be telling our grandkids about, because that's what we do here at Bloomberg. Kicking us off to the close is Barry Knapp, Director of Research over at Ironside's Macroeconomics. And Barry, I have to start off with the obvious question. Were you actually surprised at how quickly we saw the market rally on the back of that effectively social media post?
No, I wasn't. 6.5 weeks or so ago, we wrote a note cleaning up the industrial policy mess, which was a version of what Scott Bessent described as Treasury Secretary Bessent, that is, of detoxing from the addiction of government spending. And our idea was, as government spending slowed, as we went through this awkward policy sequencing, trade before tax policy and spending cuts, that we were likely to see a decent pullback. 10 to 12% was our call. Obviously, it went beyond that. The tariffs were bigger than we thought. But over the weekend, and by late last week in particular, we made the decision that we'd pretty much fully priced the risk of a recession, that measures of volatility, the VIX, the VVIX, the term structure, the VIX futures, all those things were priced for an extreme event, and that the policy outlook was likely to bottom out, that it just wasn't going to get any worse. That we thought it was time to take a stand and put some money to work. So, it's obviously been a really hairy couple of days with having made that call. But no, I think this all makes sense. My explanation for why they pivoted. Bessent would lead you to believe that this was the plan on Sunday. And to be fair, we thought we'd wind up with a 10% baseline tariff. And we'd start negotiating with everybody but China. But that said, what's going on in the Treasury market, and one of the things we were concerned about in our note this weekend was that the trade policy could derail what we consider to be the absolute utmost important policy initiative, which is cutting government spending and getting it back on track to 20.5% of GDP. It's the only way to stabilize the debt and deficits.
Well, I'm sorry, Barry. When is that happening?
No, please.
But when is that happening? Because this has been a big topic of conversation over the last few weeks as we focus on tariffs, and prior to that, all the DEI nonsense here. We had a president who ran on a policy of being pro-business, deregulation, cutting spending, and getting the budget in some sort of order here. That seems like that was on the back burner as he dealt with these other issues. Do you have confidence now that he, and more importantly, Congress, are ready to tackle this?
Yeah, it's a great point. So my policy priorities as an investor is, number one, cutting spending, getting it back on track to 20.5% of GDP. It's 50-year median level. Number two is pro-corporate supply-side tax policy, reinstating immediate expensing for equipment investment, R&D spending, those initiatives. And then number three is deregulation of the energy and financial sector. Trade policy is really on the low end of my list. Obviously, President Trump got elected partially in 16 and 24 because of that particular issue. So that's the Main Street, Wall Street dynamic. But what I think happened over the last couple of days, Romaine, is, it's a little bit arcane, but one of the trades that was very big with the hedge fund community and bond community was the so-called Bessent put. And it was swap spreads, this idea that swap spreads would tighten relative to future, or relative to cash. And we would get, because of less.
Hey, Barry, hold that thought for just 1 second. We do want to go and listen to the president right now speaking outside of the White House.
China wants to make a deal. They just don't know how quite to go about it. It's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal. And we have many other countries, as you know, many more than 75. And they all want to come, and they want to come here, or they'll go to Commerce, or they'll go to Treasury. We have our great senators here and congressmen. They'll call John, they'll do somebody, they'll go through somebody, but they're all calling, how do we do this? They all want to make a deal. Somebody had to do what we did, and I did a 90-day pause for the people that didn't retaliate, because I told them, if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible. A man like Roger Penske, I don't want to get him in trouble with China, so I won't, but he would know that someday you have to cut the bow, and you have to do what you have to do, right, Roger? And that's what I did, and I'm very happy to have done it.
The Prime Minister of Greece just told Breitbart's Matt Boyle that he thinks absolutely the European Union and the United States could work out a trade deal that's win-win and, quote, mutually beneficial to both sides.
I agree.
What do you think about the Prime Minister's comments, and do you think a deal could be struck with the European Union?
First of all, I know him. He's a good man, and I appreciate his comments. Yeah, a deal could be made with every one of them. A deal's going to be made with China. A deal's going to be made with every one of them. And there'll be fair deals. I just want fair. They will be fair deals for everybody. But they weren't fair to the United States. They were sucking us dry, and you can't do that. We have $36 trillion of debt for a reason. We don't have it there for fun. They have it for a reason. And people took advantage of our country, and they ripped us off for decades. I've been thinking about this for decades. If you ever saw me on television, I was young like these guys. And it was the good old days, I'll tell you, Roger. But I was like these guys, young, and I was talking about it. Nothing changed, and nothing was done about it. Then I did it. In my first term, I did it, and did it well. We took in hundreds of billions of dollars from China and others, and I started the process, but then we had to fix up from the COVID mess caused by China. we had to fix up from that, and we did a good job of doing it. And when we handed back the reins after a rigged election, and when we handed back the reins, the stock market was higher than it was before COVID coming in. So, you know, we did a great job, but we didn't have time to do the big thing, which we're doing now. And it's, you know, it's like a patient is sick. You have to do surgery. Patient is very, very sick. And Joe Biden handed us over a country that was in very serious trouble, economically and in every other way. They let China run away with things. They let other countries run away with things. And maybe worst of all, in a certain way, is what they did at the border. We had people pouring into our country by the millions. Many of them were murderers and drug lords and thieves and people from prisons from all over the world. And there were people from mental institutions, insane asylums. They were taking them mentally insane, and they were dumping them into our country. And I'll tell you, Tom Homan and Kristi Noem are doing a fantastic job in removing them. And now the courts, the Supreme Court just gave us numerous good rulings where we have to be able to get them out. You had other judges trying to take over the system. And think of it, they take over. They want these people coming back, Tren de Aragua from Venezuela, the Venezuela jails that cut off the fingers of a man in Colorado. They cut off his fingers because he called the police looking for help. They said, "Did you call the police?" He said, "Yes, I did." "Put your hand down," and they cut off the fingers. This is what they want to bring these people back now. And I want to thank the president of El Salvador for the job he's done, because that is that's the way it has to be done.
Mr. President.
Yeah, please.
Chuck Schumer and Nancy Pelosi, they've been talking about tariffs for decades.
That's right.
When these Democrat elites want tariffs, everything's hunky-dory, but when President Trump wants tariffs, all hell breaks loose. Do you see this double standard?
I love this guy, whoever the hell that is. That's really nice. I appreciate that question. No, Chuck Schumer, Nancy Pelosi, everybody knew you had to do it, but they never had the guts to do it. It does take guts. It even takes guts for our country to go through it. That's why I say be cool. They were saying about, I said, just be cool. It's going to work out. It's going to work out, and it's working out. I can tell you, working out maybe faster than I thought. But I said it's going to take a little conditioning. It's a transition to. It's really, I think it's a transition to greatness. It's going to be greatness. Our country is going to be. There'll be nothing like it. And people investing in our country, they're going to do better than they've ever done before. We have more car manufacturers, Roger, coming into our country now. Speaking of cars, we've never seen anything like it. And they're coming in because of the election, but they're coming in because of the tariffs, because they don't want to pay 25 or 50 or whatever it may be. They don't want to pay that. They can't pay that. We had 3 cancellations in Mexico, building a plant. They're all coming into the United States. Canada, they're coming in. From China, they're coming in from everywhere. And that's just cars. We have chip makers come. We're the biggest chip maker in the world, from Taiwan, coming in, spending $3 billion to build plants, and mostly a big plant. This is a hell of a plant when you spend the kind of money that they're going to go $200 to $300 billion, not million. You know, you'd say million would be the right number. It's not $200 to $300 billion. $1 billion. Think of that. $300 billion. If you look at Apple, Apple is going to spend $500 billion building a plant. They wouldn't be doing that if I didn't do this. They'd just keep building them in China. And that's unsustainable. It's not a pleasant thing to do, but I appreciate the question. And, you know, interestingly, Chuck Schumer and Nancy Pelosi, Crazy Nancy, they've wanted to do this for years, but they never had a president that had the guts to do it, because it does take guts, believe me.
Was it the bond markets that persuaded you to...
No, I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But, yeah, I saw last night where people were getting a little queasy. I think everything had... Well, the big move wasn't what I did today. The big move was what I did on Liberation Day. We had Liberation Day in America. We're liberated from all of the horrible deals that were made, all of the horrible trade deals that were made. And I was helped by people just like this, senator, congressman, and friend, right? And we had great help in the Senate. Our Republican senators have been amazing. They stood tall. And likewise in the House. And John Thune has done an amazing job. Barrasso has done an amazing job. I mean, I can't think of a senator, really. We had tremendous support. We got a bill passed the other day with almost unanimous support in the Senate. And I think we're going to get that in the House, too. And I have to tell you that Mike Johnson is a great speaker. He's done a fantastic job. We had a majority of 1. Now we have a majority of 7. And you don't realize how big 7 is until you have a majority of 1. And 7 sounds like so much. But we're doing well. But Mike Johnson and John Thune have done a really great job.
Mr. President, was there anyone who influenced your decision? Did you speak with anyone? You know, Jamie Dimon? Did you speak with?
Well, I watched Jamie Dimon on Maria Bartiromo's show this morning, and he was very good. He said that actually made the statement to effect that something had to be done with the tariffs and trade. He said that. He said, look, you know, at some point, but he said something has to be done with tariffs and trade. He understood it. He's very smart, very genius financially. He's done a fantastic job at the bank. And he knows that. Everybody knows that. Anybody that's even a little bit smart knows it. It wasn't sustainable what was happening. Somebody had to pull the trigger. I was willing to pull the trigger. This should have been done long ago. Just like Biden should have stopped the border long ago. I mean, allowed 21 million people plus into our country, many of whom should never have been allowed out of prisons and jails. They came out of prisons and jails from all over the world. And now we're getting them out, bringing them back to their countries. But it's should have never been done.
And where does the TikTok decision stand?
Yeah, go ahead, please.
Sir, would you consider exempting some U.S. companies, maybe some larger companies who have been hit hard in the markets last few days?
Well, I'll take a look at it as time goes by. We're going to take a look at it. There are some that have been hard. There are some that, by the nature of the company, get hit a little bit harder. And we'll take a look at that.
How will you determine that over the next 90 days?
Just instinctively, more than anything else. I mean, you almost can't take a pencil to paper. It's really more of an instinct, I think, than anything else.
Mr. President, what is your credibility like? Because you said that these tariffs would go into effect on Monday. You said no pause. Today there is a pause. So,
no, I think you have to have. It's not a question of that. You have to have flexibility. I could say, here's a wall, and I'm going to go through that wall. I'm going to go through it no matter what, and keep going, and you can't go through the wall. Sometimes you have to be able to go under the wall, around the wall, or over the wall. These guys know that better than anybody, right? You got to go around them sometimes. You're not going to go through them. So I consider, you know, I think in financial markets, because they change. Look how much it changed today. We went from, you know, pretty moderate today, but over the last few days it looked pretty glum, to, I guess they say it was the biggest day in financial history. That's a pretty big change. And I think the word would be flexible. You have to be flexible. Like he's asking the question about some companies. Some companies, through no fault of their own, they happen to be in an industry that is more affected by these things than others. You have to be able to show a little flexibility. And I'm able to do that. I'm going to say hello to these champions because they are great champions, I got to say.
Mr. President, plans to talk to Xi Jinping.
Thank you, Mr. President.
To avoid more escalation.
You've been listening to President Trump speaking on that 90-day pause on countries that did not retaliate. A couple headlines coming out here. He thinks the bond market is now beautiful. He was watching the bond market. He will take a look at exempting some U.S. companies from tariffs using instinct. Also talking about China, that China did retaliate and that China's in the process of figuring it out, and that China doesn't know how to go about it yet, but that China does want to make a deal. Want to get more on this from Mike Froman, president of the Council on Foreign Relations. He also works in the Obama administration on trade as well. Hey, Mike, really good to get your perspective. Where does this leave China?
Well, I think the good news is that the president articulated a willingness to be flexible, to exempt certain companies, albeit by his own instinct, and to negotiate. And there's been a lot of confusion up to now with some members of the administration saying there will be no negotiations, these tariffs are permanent, and there won't be any exemptions, to now the president saying the opposite. So I assume that will be the policy going forward, at least for now. You know, with regard to China, whether it's a 50% tariff, 100% tariff, 125% tariff, at some point the tariff is prohibitive, meaning you won't import the good at all. And that means Americans who rely on those goods will either have to find them from somewhere else, whether they're produced domestically or from other countries, or do without. And we've already seen some manufacturers saying they're going to have trouble getting the parts or the inputs they need to continue, and it may force them to shut down their business. So there we have to see how that gets resolved. The Chinese have listed a long group of products to retaliate against, including many in the agricultural space. Last time this happened, the U.S. government ended up subsidizing farmers for the losses that they suffered from retaliation. They collected about $70 billion in tariffs from China and gave about 92% of that back to the farmers. We'll have to see whether that happens with farmers or other affected industries going forward.
So when we talk about, Mike, the negotiations that could potentially come, and I definitely put could up there as a huge qualifier, who are the main nations that you think will sort of be first in that queue to try to strike a deal over these next 90 days?
Well, look, I think as the president and the administration have said, there's a long line, whether it's our neighbors, Canada and Mexico, Japan, Korea, the EU, Australia and others, where we actually have a trade surplus with Australia, and they still have a 10% tariff that they're facing. They all want to try and reach some sort of negotiated solution. The EU announced retaliation, but they'd really rather not implement it if they don't have to, because they don't think it's good for themselves or for the United States. They'd like to try and reach some sort of agreement. The question is, what is the president willing to negotiate? Because if the result is a 10% tariff, so we get rid of all the extra so-called reciprocal tariffs, but we end up with a 10% across-the-board tariff, that is a 500% increase in the current tariff rate. Countries like Venezuela, North Korea, and Iran have 10% tariffs. Those aren't known for being the most successful, wealthiest countries. And so I'm not sure, while the markets may view that as a very positive sign, that we're only going to have a 10% tariff, that is not a great place to end up.
Well, positioning definitely offside, contributing to the massive market reaction that we've seen. Mike, when we talked about exempting U.S. companies from tariffs, and President Trump said he's going to think about that and do that on instinct, how would you do that? Like, if you're going to put pen to paper, how does one manage that?
So normally when there's a trade action of this sort, there's a process where people can come into the U.S. government and make their case, and they submit for the public, and the public can see all of the requests, what their call for exemptions are, and then there's a process led by the U.S. Trade Representative, Commerce, the International Trade Commission, where they review them and figure out who really needs an exemption and who doesn't. The risk is you sort of leave it to special pleading, so whoever has the best access to the White House may get exemptions while others may be left behind. And oftentimes it's small businesses who aren't very well organized, don't have the kind of clout in Washington that big corporations do, and who are going to be adversely affected and need those exemptions. And the key thing is how to create a process where they can participate as well.
I do wonder, Mike, given that this clearly is unresolved, and you make a good point with those 10% tariffs effectively being new, because let's face it, they weren't there a little while ago, it raises the question as to how businesses, and particularly those small and mid-sized businesses, even sort of plan for what's next. I mean, if the president can sort of change his mind on a dime like he did today, why am I to believe that somehow he won't reinstate some of those more extreme maximum tariffs, as Scott Bessent put it?
I think that's a very good question. And this uncertainty, if you're sitting in a boardroom, or even if you're just a small business trying to figure out, do we deploy capital, do we try and open up production in the United States, you're looking for some degree of certainty, because those are expensive decisions. They take a long time to relocate your supply chain, to build out factories here in the United States. And you want to know that what the regulatory environment is going to look like. Is it going to be 10% across the board? Will there be peak tariffs? If he's going to be flexible, and some industries are going to be exempted, you're going to want to know whether you're exempted before you make any decisions. So one of the challenges of being flexible is that it creates more uncertainty, and that uncertainty may well delay the kinds of decisions that the president is looking for in terms of reshoring production back to the United States.
Mike, really appreciate you taking time for us. Mike Froman, a wealth of knowledge, president of the Council of Foreign Relations, and of course, formerly working at the USTR under the Obama administration, as we keep an eye on what is a breathtaking rally here with the S&P up 9%, the NASDAQ up more than 11. The worst case scenarios that were being priced into this market just a few hours ago, now apparently being priced out. Torsten Slok joins us right now, chief economist and partner at Apollo Global Management, on a day, or quite frankly, and we should point out, Torsten, on a day where we came in, where we still had a lot of folks on Wall Street predicting recession. At least a couple of those folks on Wall Street over the last hour or so have rescinded those recession calls. Is recession still a risk?
I do think that recession risk has been removed now, because it ended up that this shock was a lot shorter than what we expected just a few hours ago. What, of course, is still very important is that there's still uncertainty about what will happen in 90 days. As Mike Froman also was just saying, there's also uncertainty about the 10% tariffs. What would that still imply in terms of the impact? And there's certainly also uncertainty in terms of what is the impact of tariffs on China of this significant magnitude. Let's not forget that surveys show that sellers on Amazon, you have about 70% of them, they source their goods in China. So that means that there's a significant amount of price increases coming on a broad range of consumer goods coming into the U.S. So now we all in the economics profession have to go back to our spreadsheets and try to quantify what that means for the growth outlook. And it's clear that the implication is that there is likely to be still some negative outlook for consumer spending.
Yeah, Torsten, to your point, Bloomberg broke the news that Amazon actually canceled some orders for like scooters, deck chairs, things like that because of tariffs. Why is recession taken off the table? Because this doesn't remove any uncertainty. It just provides, if we believe that, a floor and a top for potential tariff risk.
Well, that's right, Alex. And I think you're absolutely right. I do also think that markets will still have this cloud hang over it with saying, well, what about capital markets? What about loan markets, IPO, M&A? We'll probably still have some level of uncertainty around, okay, so maybe there may be a window now where markets could open it up a little bit in terms of financings, but the risk is still, broadly speaking, that if there is still uncertainty about what is coming and what might the implications be, and even when these deals begin to come out, are we going back to the level of tariffs that were in place up until here now a few hours ago, in particular against a lot of different countries that are the major trading partners, such as Canada, Mexico, and Europe. So you're right, uncertainty is still elevated, but let's just agree that it's significantly lower than what it was before. So I still think that overall, this cataclysmic risk of a recession in the very short term is no longer the case.
Well, how are financial conditions, Torsten? And I know that that's probably a question that changes depending on what day of the week I ask. But we came into today where we saw a huge amount of foreign selling of U.S. debt, a huge amount of foreign selling of the dollar. And it was raising a lot of concerns about liquidity or the lack thereof that we've been seeing in the fixed income and FX markets, and the potential for another blow up akin to what we saw in that carry trade blow up in August of last year. Is that still a risk?
That's a very important question, Romain, because exactly if you look at the rates reaction after this 90-day delay come out, you saw that short rates have gone up a lot, but short rates have come down a lot, but long rates have not moved that much. So in that sense, it is a very significant development that there are some important differences across the yield curve in terms of how markets have responded. So you're right, the change that we have seen in financial markets, especially this unique feature in the last few days where the stock market was going down, and exactly as you're highlighting, interest rates were going up. That is something that, of course, has created a lot of attention to why was it the case that financial markets suddenly saw what looked like forced selling, where someone was forced to sell long-term treasuries. And exactly as you're saying, watching what the dollar is doing is particularly critical, namely to watch whether is this foreigners selling, is this domestic investors selling. So now markets will settle down now for the rest of today at probably levels around where we are at the moment, but watching exactly what is the response from foreigners and from domestic investors will become very important.
Yeah, and like you said, the move is really in the 2-year today. The back end not moving that much necessarily on this news. Hey, Torsten, last question. Did the markets win?
Well, so that, of course, as usual, depends on what side you're on in the market. But I do think at least that it must be a huge sigh of relief in markets at the moment. At least it looks like now we have more steady pace of negotiations coming. You could hope that there will begin to be some negotiations with Canada and Mexico first, so that could be settled, and then other parts of the world will come subsequently. So the more clarity there is in markets about what is the sequencing, what does it look like when deals come out, I think that will be most helpful for markets in terms of some of the fogginess that we've been going through here more recently beginning to clear.
Torsten Slok, chief economist over at Apollo, as we keep an eye on the broader markets, now right around near fresh session highs, and some of the biggest gainers today in the S&P 500 airlines. That includes Delta, up more than 20% after posting an earnings report that, well, not great, and of course guidance that was also pulled, but a lot of folks did find some encouraging statements out of the CEO. Stephen Trent joins us right now. Equity analyst and managing director over at Citi, has a buy rating on Delta and a price target of 7,200. And Stephen, we should point out the stock was already rallying even before the Trump tariff comments. It was up like 8% and then got a nice boost after that, up to 20+%. What was your reaction to the earnings report, and more importantly, what Ed Bastian had to say about the business? Why did we see such a positive reaction?
Yeah, and thank you for having me on. So I think the earnings report, all things considered, was pretty good. Mm-hmm. We saw, for example, the booking curve showing some strength after you did have a dip on the Liberation Day announcement. And with the exception of domestic main cabin, the verticals overall look pretty good. International strong co-branded card remuneration. And I think that the street had some rightful sympathy for the suspension of the guidance, given the great lack of uncertainty. Now a little bit better, maybe. But,
well, I was going to ask, would their call have been different if we had gotten this announcement before their earnings call?
I'm not necessarily sure it would have been different per se. I think perhaps the early reaction and the early price action could have been even stronger. But I think we move down 90 days from now and what happens, that's still a little bit up in the air, no pun intended. I also think that when one looks at the asset price reaction today, we're probably going to see some consumer reaction with a delay. So when we look at sort of the broad picture, I'm not 100% convinced that domestic main cabin is suddenly going to boom, but they've been doing a very good job on all the other verticals, and that's been enough to move the business forward.
So this sounds like it's more about good management execution rather than a good operating environment.
Absolutely. I think this is really good execution on Delta's part, and it's certainly not their fault we've had all this uncertainty with respect to policy coming out of Washington, which does create some difficulties in consumers trying to plan discretionary spending and companies trying to plan investments for the year. But they've done everything they can, and I think they've done a really good job.
Do you have optimism about the other U.S. airlines carriers when they report?
So we're constructive on the network airlines, and I think if you look at the lower socioeconomic strata, that segment's been under pressure. I'm not necessarily sure that comes off, but I think if you're a network airline looking at the paucity of new equipment per capita, there's ability to put that into price. And if you're a discount airline, it's a little tougher road.
All right, Stephen, thank you very much. We appreciate it. Stephen Trent, equity analyst and managing director over at Citi. All right, let's get more insight now into the bond market as you have equities fly and you have the front end yields just popping as well. Stephen Lapley is global co-head of iShares fixed income ETFs over at BlackRock. What a day to have you join us. What has volume, what has movement been like in the past hour and a half?
It's been pretty incredible. You guys have seen the whipsaw in equities, and then we also had a bit of that on the curve too, particularly at the back end. So we had some retracement of yields in the back end. We're still elevated, kind of in the front and the belly, but it's been quite a volatile day. And I would say in general, the week has been something else, and we've seen very, very powerful volumes on the back of this, record-setting volumes in bond ETFs in particular.
Well, prior to today, where was the money going, or where was it maybe not going?
Well, I think the trend has actually been been fairly up in quality. So, this year we've taken in around 30 billion, 31 billion in the U.S. In iShares bond ETFs. Over half of that's been in treasuries. And the majority of that has actually been in the very front end of the curve, SGOV, which is our T-bill fund. So there's been a lot of flow into quality. The second, I think most popular category would be multi-sector investment grade and just pure corporate investment grade. So it's been an up in quality trade.
Well, speaking of that, we had started to see the high yield and investment grade market really, the spreads really start to widen out and move.
Yes.
Clearly that's been rebated a little bit in the last hour and a half. What have you noticed in terms of flows and sort of risk on, risk aversion?
Yeah, so we did obviously see a lot of spread widening in high yield the last few days. I mean, I think we were at about 125 basis points, which is a lot. About 25 in investment grade, and some of that's retraced today. We did see high yield outflows in ETFs. Investment grade's a little more mixed, but probably you'll see some of that snap back after this reprieve.
I am curious. There was a lot of talk, particularly during the last few days where we saw this huge uproar in markets, that a lot of investors, particularly on the retail side, were actually utilizing ETFs more so than they were utilizing any other instruments, whether it was single stock or indexes or anything else. Do you think that is sort of a ratification of your job, congratulations, but more importantly, just a ratification of the structural shifts in this market, and that is something going forward we should also look to maybe a little bit closer to for signals going forward?
Well, Romain, I think that's exactly it. I think it's not only retail. So what we've noticed, we saw this during March 2020 as well. Even in the treasury market, right, the most liquid market in the world, you're seeing institutional investors trade bond ETFs for risk management. So TLT, as an example, prior record was during 2020, it was around 13 billion in a single day. Just traded 10 billion the other day. HYG, our high yield fund, set an all-time record on Monday. It was around 14.4 billion. That represented actually about 60% of the entire over-the-counter volume in the high yield market, which is an incredible stat. And it just goes to sort of show just how much these products have become ingrained into the markets, particularly in credit.
Before we let you go, have you noticed anything, any signs of liquidity stress or anything in the treasury market that we need to be worried about here or thinking about?
Well, there was obviously a lot of discussion around, the back end of the curve and swap spreads and all of that. I don't think we particularly saw a lot of funding stress. And again, in treasury ETFs, they were functioning very, very well, high volume, tight spreads. So, it seems to have held up very well.
Yeah, and I just want to point out, too, I mean, that on near record we saw on TLT the other day, and we should also point out Monday we did see record volumes. Right now, looking at volumes on TLT, looks like we're going to surpass that record on a volume basis today. Stephen Leipley, Global Co-Head of iShares Fixed Income ETFs over at BlackRock as we keep it moving towards the market close, setting up for what could be one of the more monumental closes